Hello and welcome to another episode of the officials for the Singapore market on close. Today it was the second day of the Dubai trading window for this month, and it has started already looking a bit clearer of what's happening in both sides. So we had Totside and Glencore in the buy side and Exxon and Unipec in the sell side. It was slightly a bit of more interesting window. We saw around 20 trades, but remember folks, we're still very, very early, and the number of trades doesn't remind us anything from the September or last month's opening. So if we were to dive at the physical premium to see what happened this morning, it was assessed by our team just below 150, around 147.5. In the last 2 days, we've came down significantly from over $3 to below 150. So it's big drops. Obviously, we expected that because of the around the end of the month funky businesses that we saw in October's trading. But yeah, this is all news. If we were now to look at what's happening in the price action, it was pretty much all types of crudes are going down. Mainly, we saw Brent, as we can see here on the chart, is currently trading the low 64s. It has come up significantly since yesterday evenings. And as we can see here, we're way below our 65 range, 65.50 range that we were trading comfortably at the around last week, at the start of the last week. Brent spreads remain significantly weak as well. As we can see here on the chart, yesterday we were trading from the upper 50s range or around 60 cent range to around 40 cents right now. We even dropped below 40. So there is some stress in the market right now, and we can see it here also on Brent Dubai. Dubai has weakened significantly over the last few sessions, and here, as we can see on the chart, the Brent Dubai spread rallied this morning. This is the prompt December. This is the December Brent Dubai swap, and we went from the minus 78 cents, as we can see here on the chart, and we found a ceiling at the minus 58 cents. Now, over to market updates. We're hearing from Indian sources that the refineries have already switched and the market has still not realized the impact yet. The estimated impact is around 1.5 to 2 million barrels per day of Russian crude that the Indian refineries are switching. And reportedly, Reliance, according to our sources, has bought over 17 Middle Eastern cargoes. So that's a big shift. That's a big shift. And if we were to think about that in market terms, we shouldn't be trading in the low 64s that we saw Brent. It should be around 70, 75 bucks. So the market needs to digest that. Apparently, also some Chinese refineries, as in Unipec and Sinopec, have already trimmed their intake. But as we saw here in the window, Unipec remains an active seller in the Dubai. So that's an ongoing progress. We're going to monitor, and our sources will keep us updated. And obviously, on the window here updates, you're going to find the latest news, as well as our Twitter and Flux page on LinkedIn. Thank you very much.
Hi, welcome back to another episode of Trading Corner. So we're just going to touch upon the market, see where we've moved from last week.
Yep.
Seems like, 5 trading days feel like a month recently.
It's definitely felt that way, yes.
Yeah.
Especially coming into the changeover of the month and
Yeah.
all of the physical interests changing and what's been going on with Russia. It's been
Yeah, tiring to say the least.
exhausting.
Okay, so let's start with Brent, I guess.
Yeah.
Last time we spoke, we'd had a lot of short covering, although I think we were suggesting that perhaps not people hadn't 100% covered, given the sanction news that was coming out, a $4 rally in Brent flat price wasn't that aggressive.
Yeah.
Since then, we've softened quite a lot. Interestingly, on the whole curve as well, typically when you hear news like this, what you'd expect is perhaps the back of the curve to normalize a little bit because it very much is a supply shock in the prompt. But actually all the spreads have given way a little bit. So it's been quite interesting. I think the market still is fairly confused.
Very confused. I was going to say, prior to the Russian news and prior to even our conversation last week, we moved from proper contango on crude spreads to proper backwardation. And now we've kind of settled, the prompt's still a bit backward, but on the future side certainly. And the rest of the curve it's super flat.
Super flat. It's quite interesting. You're totally right. Like before the sanction news came out, there was aggressive, sell side flow. Even the front spread was threatening to hit around flat at one point.
Yeah.
And since we bounced back, I think the markets found it hard to believe that the sanction is going to be a long-term or even medium-term issue.
Yeah.
I mean, the way the market's behaving at the very least, you would think that we're pretty good on oil around and there's no real shortage.
I think so, and I mean you're seeing that with the amount of oil that's on the water, which is significant, which is keeping a proper bid on freight.
Yeah.
But let's just step back to what we talked about last week with India being the swing barrel, right? Because the rhetoric out of India has been also mixed. Like there's been some chat saying that they're not going to buy barrels, and then there's others that are going to buy barrels, and so it is a bit confusing.
Yeah.
But oil-wise, we have oil.
We have oil.
Yeah.
But, we're coming out of maintenance now.
Correct.
So we should be picking up on these crude purchasing. And that's still, from the looks of it, that has still not happened. I think we still have a lot of refiner buying to come into the market, especially in dated. I mean, if you look at the curve right now, so before the news hit, we were pricing around minus 20 cents on the physical diffs. We have rallied there about 50 cents up to 30 cents. But the whole of the forward curve is really quite depressed.
Yeah.
Given a strong backwardated market and the potential of the refiners coming in with the margins where they are and the Russian oil offline, the forward curve looks undervalued, 100%. So
the only thing I would challenge to that is that I think the forward curve on a relative basis has been undervalued for a long time. Do you not agree?
Well, yes, for Brent, but actually usually for dated it's the opposite.
Yeah.
So typically for dated, our forward curve is always overpriced.
I see. Okay.
Because of the forward hedging.
Yeah.
And then when it kind of comes to pricing, typically this year at the very least, we've had the roll down. Whereas this time we've got the opposite. And it could be because the refiners are still waiting to potentially get the cheapest barrel that they can possibly do.
Sure.
But typically what we find when they do that is they will all come in at the same time and they won't, it's
And
hard to buy the lowest,
Correct.
Even if you have some great foresight. But
they'll be chasing.
It typically
It feels that way.
creates that environment. So it's hard to really look at data and say it's a sell. You just have too many supply shock risks, I think, and with the margin where it is.
Yeah.
I think the margin is extraordinary. You talk to any refiner, they're the ones that have won this year, right? We've had sustained, very strong margins.
Super strong margins. Just whatever crude is done, product demand is there.
Yeah.
Right, products being absorbed. All the refiner margin hedging, any margin hedging is just getting absorbed daily.
Exactly.
Almost, it feels like.
So it's quite hard to look at the dated curve where it is, with margins where it is, You know,
to be short.
Even regardless of what's going on with the Russian barrels, and if India needs to come and fulfill a short, it's difficult to say that there is downside.
Correct, and also it's interesting. I mean, over the weekend you had the OPEC meeting, and you know, it was quite
right?
super non-aggressive tone
Yeah.
of increasing supply, which has, you know, certainly been their strategy, or certainly been the tone for the last 3-4 months. So everything was in line as expected, and what was interesting was that there was some chat about not potentially increasing supply come Q1 because of the plentiful supply around.
Yeah.
Right. So, yeah, it's not clear. I'm with you on the margins. Like, the margins are strong. We're coming out of maintenance, and you could see refiners coming in to buy crude.
Yeah, I mean, yeah, on this curve, they definitely should be doing that. And then also we look at the other regions. You know, TI is doing okay. I think you know, all the stats last week were very
Correct.
Constructive.
Correct.
So we were having really big crude draws. You know, let's see what happens with Venezuela, if that is, you know, material in any way really to the crude supply there. And the Dubai curve is back to normal as well. We priced 148 on the front spread today. First day of pricing, very, very strong.
Yeah.
And the Brent Dubai is, you know, kind of back to normal levels of like minus $1.
Yeah.
So every other region looks okay. It looks like dated is the undervalued curve at the minute as it stands. Now,
sorry, go ahead.
no, I was just going to say the other thing is with freight where it is, the arbs are shut. Every arb is pretty much shut, and so if the demand comes from Europe, which I suspect it will in the next 2 weeks, it's going to be very hard for them to buy Midland, which is, you know,
move it over even,
but with the freight where it is, or anything out of Northwest Europe. I think it's going to be very expensive for them to do that, which means the local grades, Brent, 40s, Osberg, Ekofisk, I think they will clear very easily.
Okay.
So let's see.
Yeah.
It is interesting. So I just wanted to actually show you this graph really quickly. So I've spoken about it before. I love to look at it. It's essentially the margin, which is, you know, this kind of 3D block line against the GFL. And it totally makes sense given where we are in the maintenance season that, you know, the GFL is a bit more suppressed.
Yeah.
But I do expect this relationship to start converging a little bit. You know, I think we still will see strong margins.
Yeah.
The reason for that is because the core of the barrel, so to some extent gasoline, but gas oil mainly, is very solid.
Correct.
We're going into high demand season for gas oil, so I think we will probably maintain those cracks there. And so it's the peripheral kind of cracks that's going to move the margin, so the waste products.
Or crude, which
I do suspect that, you know, potentially NAFTA, I mean, this is from a crude perspective, so
sure.
Give me your 2 cents
I'll give you
as
the
well.
product perspective. Yeah.
I do expect that the waste products will probably be the ones to soften the margin rather than the middle of the barrel, as I was saying, just as we start running rates a bit stronger. And I think crude will start picking up a bit, which will help the margin as well. But I do expect that convergence there.
I think from the product side, it's important to note that a lot of the tightness is coming out of the U.S. You know, heating oil is tight, gasoline in the Atlantic coast, it's tight, it's strong. So there's an enormous amount of U.S. related strength in products, I would say. Tightness exists across the world, but if you look at it on a product specific basis, gas oil, we are, as you said, coming into peak season, but we've priced an enormous amount of that strength already. And as we price it in the turnaround season, it'll be interesting to see whether over the next 6 weeks or so refiners come out to hedge further margins and how that would be absorbed in the product market.
Is the market long gas oil?
It's difficult to say.
Yeah.
I think the market's long gas oil structure.
Yeah.
And it would be, I would find it surprising I would find it surprising to hear if the market was short gas oil, because I think that would be.
Also, they've been burnt trying to do that relative value trade all year, right?
All year.
Yeah.
All year. Although I would say that, you know, it could. You you could see an improvement in balances, and even if you drop a few dollars on the gas oil crack, we're still extremely strong.
Yeah.
Right. So I don't think it's going to
That
weigh.
is the thing, you
it's
know.
just, we're still so strong.
Yeah, the difference between margins at $7 and $10, you know, the refiners will still be running 100%.
Absolutely.
So you're totally right. We can give up a few dollars on the margin, and nothing should change from an operational perspective.
Correct.
Okay, so it'll be interesting, and also we're coming into Thanksgiving, so potentially local gasoline demand in the US will have that additional support as well. So yeah, I don't see the product demand going anywhere into the year end, personally.
One thing which I wanted to talk about last week, and I actually forgot, but it's super interesting because we're talking about crude structure being relatively flat outside of the front 3 months of the curve, certainly on a futures basis. You know, it's been, you got to remember that it's actually been a very, very long time, probably 4 years, maybe even 5 since COVID, that the market saw deep contango and product spreads, right, across the back of the curve. And if you're a physical trader and you're looking at any available contango, you're probably hedging any storage or pre-hedging any storage requirements. So I think a lot of the product strength can also be driven off just the flows at the back, and what's implied, which is super interesting. So that's actually keeping strength on the prompt margin as well, is the fact that the rest of the curve is offering storage economics for a lot of products that are at levels where physical traders haven't seen that for years.
Yeah.
Right. So it's a flow factor to keep in mind that's keeping strength at the prompt.
So the guys that, I mean, I'm assuming this contango that they're hedging is Cal 26, or is it further back?
It's not Cal 26 yet. It was 2 weeks ago when we were a lot lower on Brent, you know, near the 60 mark, and crude structure was a bit lower. But yeah, definitely Cal 27.
Cal 27.
Yeah.
So I wonder, you know, they've locked in certain levels. That volume should get exhausted, though. You know, they only have so much storage that they can put this product into.
Correct.
And so if the levels go through there, will they have to stop out and look for better levels, or?
Unlikely. They're probably going to scale. I can't imagine all of that hedging is done.
Okay.
I think it was there for a brief while, and it's already repriced higher. So I think you'll get weight on contango product spreads for a while until the product markets can actually, the demand stops in the prompt, I suppose. You know what I mean?
Yes. Exactly. Yeah. And I don't think we can really go into a truly bearish market until we see these margins low. It's really hard to play, you know, a really short crude view or whatever off margins at $10. Like, it's really hard to justify.
I agree, and also if you look at the products independently, as I said, we were looking at them last week. A lot of these products are trading quite independently now, particularly during that short squeeze when everyone was trying to cover short. But even after the market settled down a little bit, if you look at high sulfur fuel, things are pretty tight. I think if you look at and continue to remain tight in Europe and in the US. Asia is actually fairly balanced, I would say, in high sulfur. In VLSFO, we've had a big leg up in VLSFO, mainly probably due to freight, I would imagine.
So are we seeing East-West come off?
In which products?
Like gas oil, like the ones that will be exported out of the East? It's mainly gas oil, I assume.
Yeah, I mean, but there's Eastern strength in gas oil as well.
Okay.
So I think East-West is still negative.
Yeah, something does need to help the freight, right?
Yeah, correct. Yes, exactly.
Yeah, interesting.
And then, so we, you know, the fuel complex still remains tight. Gasoline it's still, I would say, fairly healthy. We've dropped a little bit. Naphtha, we've dropped a little bit, but again, fairly balanced, I would say.
And nothing material to the margin.
Correct, and a lot of fears around Dangote, obviously being a large driver of the moves in the gasoline complex, and distillate is strong.
Yeah.
And so where are we going to give way in the margin for it to come off? And so it'll be interesting. I think you'll have to see something change on the product demand side to really, like you said, have a high conviction short on crude, which is I'm sure you've made this argument well before you and I started talking, and we're going to continue saying the same thing.
Yeah.
Yeah.
Okay.
Yeah.
So, I mean, other than that, other than the retracement in, well, I guess across the barrel, but predominantly in crude, it's been a fairly quiet week, I would say. I think volumes have really dropped off. It feels like the market is fairly risk off.
I would say so, yes. Especially with the uncertainty about what's going to happen.
Yeah.
And I think a lot of the product markets actually last week and this week were really driven off crude.
Yeah.
And crude volatility has dropped off a little bit.
Crude's dropped off, exactly.
Yeah.
The price action in data is getting a little bit more volatile because the liquidity is not there so much. But we had expiry on Friday, which was fairly constructive. We priced 65 cents roughly on the cash spread, which, given this forward curve at the minute we're seeing on deck barrels, we're pricing in around 30 cents. Mm-hmm. It was a strong expiry. We also had a lot of Jan EFP transactions. So I think the market does think it is worth owning barrels here with the margins where they are. It's just not come into the forward curve on the dated side yet. So for me, the only trade that makes sense is to go long Novdek. Okay. I think we're going to have, as I said, margin support purchasing from refiners. We're going to, any potential supply disruption, knock-on effects from Russia, like if India come in purchasing, and also all the arbs are shut. So it's going to be really hard for TI to land competitively and fulfill some of the shorts. I think it's the only thing that makes sense.
Yeah.
Obviously, unless margins get crushed, but I just do not see that happening.
Yeah, I mean, look, last week I said I talked about being long general, Q1, Q2 product crack rolls, which is fine. I think I like that. But actually, having looked at the curve a little bit more across all products, the deferred margins like Q4 26, Cal 27 margins, those all look obviously significantly cheaper than the front, as we say, and actually the front is a little bit of a difficult one. Like you said, is it going to be products that correct down or crude that corrects up? And for me, it actually doesn't surprise me that the back end of the data curve and the crude curve is a bit depressed, because I feel like with all of the rhetoric around the oversupply next year, it feels like it's more of an aggressive prompt roll-up than anything. So if there's buying in the prompt because of margins, as you say, it can just be prompt strength, and then we'll see next month.
Then we price that, exactly.
You know what I mean?
Yeah. The only thing that I don't love about it is everyone is short Q1 DFL.
Yeah.
And they're going to have... we saw some stopping out last week with the sanctions. A lot of deck Jan, Feb buying. People were definitely covering positions there. But I'm very much a contrarian trader, so I don't enjoy getting into the same position as the market. But sometimes you just have to. I mean, it's... especially when it's behaving
sensibly.
Not so much sensibly, as in just numbers do not matter. It's flow, and flow is dominating the curve. People need to enter or exit a position. That's it. They don't care where the value is.
I 100%.
So I think that's very much the scenario we're probably going to remain in.
Over the next 6 weeks or so, into the new year, I would say. I think flow is going to dominate into the new year.
For sure. Okay, well, saying that, I think we know what my trade suggestion is. What's yours?
I actually am going to say that second half 26 cracks. I would say across second half 26 margins buy.
Oh, buy. Okay, cool. Yeah. And mine is Novdek dated. So let's see how we are in a couple of weeks' time. Thank you.
Cheers. Thanks.
Hello and welcome to another episode of Macro Mondays. I'm James Todd, Trader Performance Manager here at Onyx Commodities.
I'm Will, Research Analyst here at The Officials.
And I'm Spiros Kokas, Research Analyst here at The Officials as well.
So, as always, we'll be taking you through some of the key market data, charts and risk that we've seen over the past week, as well as looking forward. And we'll be discussing some of the key headlines over the past week, including the US and Chinese are looking at a new trade deal. Trump is potentially going to be reigniting US foreign policy, maybe attacking Venezuela. Questions over the Fed to restarting quantitative easing, despite US debt rising at record rates. Euro area, we'll be looking at some of their issues, and we'll be looking at the S&P as well as they continue to gain despite it being a mixed picture there. So let's start off first with that US-Chinese trade deal. So we saw Trump and President Trump and Xi announce a trade deal, and this has been quite bullish overall for global sentiment.
Definitely. I mean, I think it was kind of quite a long time in the making, really. China and the US have been really kind of butting heads on the trade front. Both think they have the Trump card, if you will. But I think, yeah, so far the signs are looking better. You know, we've had some soybean shipments go over from the US to China, which they had not been buying any US soybeans for many months, much to the frustration of the US agricultural sector. And we also saw the Chinese pledge to lift any, not implement more export restrictions on rare earths. And that had been a big kind of pressure point, I think, in the trade dynamics moving into the talks, and markets enjoyed that news, I think.
Yeah, definitely. I mean, as we can see here on the chart, many countries are heavily reliant on rare earths, but the US is almost 80% of the reliance comes from China. Yep. So it's very significant. And from their side, it was very notable to highlight that they agreed to lower the tariffs until November of next year. Yep. And the addition of that came today in the news in the market that they would lift the port fees on Chinese ships. So it seems like this last trade war, economic war that we saw between these two big countries is slightly easing now, which, you know, the markets obviously we're really happy about it, and we hope that at least this is gonna stay for now, because it's never been consistent between these two countries, right?
Of course, and you know, as the chart shows there on the screen, it's this US dependent upon rare earths. It's going to be very important for US production and manufacturing going forward. That's one of the reasons why I think it's so notable that we've come to a bit of an agreement and a retracement from this stalemate. And so, yeah, just to talk through the headlines, the US are going to be lowering tariffs on China by 10 percentage points and extend the expiration of certain Section 301 tariff exclusions until November 26, as you said. But this has been married with more deals being made with South Korea and Japan. So South Korea agreeing to invest $350 billion on the US to lower tariffs, and the Japanese similarly $550 billion into US energy and industrial projects. So it's not just China that they're making progress and deals with, it's a lot of the larger Asian economies.
Yeah, and of course, you know, Trump came out of the meeting saying, you know, what a success it's been. But at the end of the day, you know, we've just had a reversal from tariffs that have been incredibly damaging throughout all facets of both West and Eastern economies. I mean, to me, it looks more like an admission of, well, him saying he's lost, really, in the tariff debate. The rare earths proved checkmate.
Yeah, definitely. At least with China. With Japan and South Korea, obviously the US had the upper hand. Japan is heavily reliant on specifically auto exports to the US. So the manufacturers there had been struggling recently. But again, the South Korea and Japan deals are very short on detail. It was mostly with China. The rest deals are just words, basically, of what Trump said on Truth Social.
Yeah.
And then, whilst we're on the topic of US foreign policy, let's look at one of the headlines that obviously came out on Friday last week about rumors that Trump was going to be attacking Venezuela. They seem to be reactivating, basically in the Gulf of Mexico and just south of it, and their military base in Puerto Rico. It's the most active they've been since 1994.
Yeah.
So what are our thoughts on this?
Yeah, they moved a carrier group from the Med down towards Venezuela as well. It seemed like things could get a bit more kinetic, but Trump was pretty quick to actually dismiss those headlines. I think it's just more noise, right? Trying to colour the narrative a little bit. I think Trump's in a place now where he's maybe not seen to be quite as hard on the trade side. So maybe he's looking for somewhere else to flex his muscles. And we saw another headline over the weekend about potential escalation and military action in Nigeria.
To my mind, the fact that we've got Venezuela and Nigeria, both huge oil exporters as well, it's not necessarily, we're not necessarily seeing active action in those countries. But, he's moving his pieces around the board and positioning himself there. Yeah. So I think people are definitely going to be taking note of that.
Yeah, and, the Venezuelan Air Force, they did a flyover of the carrier group as well. So there's definitely kind of tensions on both sides.
Absolutely. And Venezuela have reached out as well to Russia, basically asking for reinforcements and additional sort of defense mechanisms. So, it does seem to be percolating a bit, and maybe we won't see any immediate action. But yeah, to see both of these sort of quite warmongering headlines over the weekend, I think it's very interesting. And perhaps, well, as you said, if he is seen to have lost ground in this trade war against China, having some very active military foreign policy, other US presidents have done it before, especially close to oil countries. So.
Exactly.
But then let's talk about something that has gone Trump's way. He's got a bit of he would have probably asked for more in terms of a rate cut from the Fed, but he's got a bit of progress there.
Yeah, it was an interesting FOMC, really. I think we had two dissents in both ways. So we had Schmidt wanting no cuts, and we had Moran wanting 50 bips. So you have kind of quite a divergent committee there, and I think that's particularly tough for markets to read. Obviously, markets are also starved of data currently with the government shutdown, which we'll speak about in a little bit. So there's not really that much for even the Fed to go off, right? They're missing a lot of data. So I think it was another one of Powell's kind of insurance cuts, right?
Yep.
It's damage control, it's risk management. He made sure to emphasize that December is not a done deal. So they're not committing to any sort of prolonged and sustained easing cycle here. And the markets are repricing that. It's 17 bips now for December. Could go either way.
Yeah, definitely. There's 3 cuts priced in right now. Obviously, the rate on the 2-year bonds will come down significantly, but with inflation around 3%, this will put some upward pressure on 10-year yields. So we should see some steepening, in my opinion, in this chart. We obviously have a lot of room to go relative to other years in the past. What do you think about that?
I think that's the key point as well, is that even with inflation at 3%, we still have a Federal Reserve that's cutting rates. And that to me says that there's been a bit of a shift in objectives. The 2% inflation target is becoming a little bit more flexible. And I think that, you're completely right, is going to lead to perhaps higher break-evens over the longer term. And yes, steepeners might be in play, especially with the 10-year now around 4% or lower. There's definitely move to the upside there.
Good analysis. Yeah, you mentioned the US shutdown. So we're now 34 days of these walkouts. In 3 days, it will mark the longest shutdown in US history. Do you think we're going to have an end to this? It sounds as though people at the top seem to be sort of play on.
I mean, we were hoping the shutdown wouldn't be that long. I don't think anybody in the markets was pricing for something like that. You were seeing bets even on the poly market of around a week. The odds were very low. So it's very significant what's happening right now, especially data. We've been Fed is heavily reliant on data, and even markets not being able to trade on. Basically, they trade on closed eyes. They don't trade on reliable information. And on the other hand, you have the US still, the government is shut, but they're printing money as is coming from trees. In just 4 days, they print more than Croatia's GDP. So, we have to put some things into perspective. The debt is a major issue, and that adds up significantly to the long end of the curve.
Yeah, and the US fiscal strategy was in some ways what triggered the shutdown. So, I mean, it seems like they're completely unwilling to pivot. And yeah, the printer has not stopped yet.
Well, and if you are talking about, hawkish military policymakers at the top of where we're going to be looking at Venezuela and Nigeria, if they're going to be putting their money where their mouth is, that's going to cost a hell of a lot of money, and that will only make the national debt, spiral even further.
Of course, yeah.
So yeah, it's a cycle that they're in, and it's probably quite a poisonous cycle, of course. How are they going to get out of it? Well, is it going to be QE?
Well, the Fed is restarting. I mean, not necessarily QE, but they will put an end to the quantitative tightening. I think QT has been, let's say, a tool that everybody agrees hasn't been that as effective, especially in the Bank of England. We saw they're going to stop, reduce the QT this year. In Europe, they're struggling and they're asking for QE, as we're going to cover later. And now the Fed said not any mortgage MBSs are going to be reinvested into US Treasuries. So, and that was the issue with the repo market recently. Banks are screaming for cash because when you have a big buyer of bonds stepping back and actually selling bonds, you have all these big banks that have to absorb the absence of a big player like the Fed. So it will be interesting to see how this is going to play.
Yeah, I mean, the difficulty is with QT is, after the GFC, the central bank reaction function changed a bit. It wasn't just interest rates anymore because we were stuck at the zero lower bound. So they had to come in and use open market operations to ease monetary policy. That obviously leads to an accumulation on the balance sheet, which at some point has to be sold because you can't just buy indefinitely. So it, by definition, necessitated this period of QT. What that has also coincided with is now very loose fiscal policy kind of globally, right? As well as a kind of a distrust in that fiscal policy. So we've seen yields down the curve across most developed economies rally, right? Yeah. Yields have gone up a lot, and that obviously has a high incurs a bigger cost of financing for those governments, and also a big FS risk in some ways. If you're a bank and you store a lot of your capital in treasuries or gilts, and suddenly the value of those gilts has plummeted, then it poses risks. So from an FS perspective, the Fed should probably think about stopping QE, but that's not QT. Sorry, that's not QE. Yeah. Is the clear distinction here? They're not adding more liquidity to the system. They're just not removing liquidity from the system.
Yeah, definitely. But it seems like this we've reached that floor around 6.6 trillion right now. That's the Fed balance sheet. The Bank of England is less than $1 trillion. So we're talking about very big numbers. If 6.5 trillion is the floor and the banks are screaming for cash, to me it doesn't sound like we're in a really healthy environment right now. Definitely. We saw the repo rates had a big spike recently last week, and we can see here how much money they stockpiled into the SRF, which is the Fed's repo facility, was the highest since the 2019 spike. So to me, it doesn't seem that healthy of an environment right now.
Definitely.
Cool. And how's this affecting US consumers overall? I mean, we can obviously forecast, how tightening credit conditions and actually the easing of credit conditions at the top line will do. I mean, the data this week has been, very much in line with everything we've seen over the past definitely 2 years economically, where US consumers are struggling. The chart here showing home price to income ratios yet again higher still. Do we need more credit to be available? Do we need more QE to be able to make lending more affordable, or what's the take?
Well, I think this is probably a function of one, the huge asset price appreciation in the US, right? If you're looking at a 401k that's just had 40% returns over the past year, then it kind of makes sense that people are willing to pay a bit more for their house. Consumers are also, their appetite for leverage is increasing. So that's only going to increase your appetite for a bigger and bigger mortgage. At the same time, we are on the cusp of an easing cycle. So credit is becoming cheaper finally after many, many years of people holding off going into big home purchases. And so there's probably a pent-up demand effect here as well that's now being unwound.
Yeah, you raise an interesting point, but to me the concerning thing here is that asset prices are rising on a faster pace than income that what families can afford. And we've seen recently lots of corporates are buying those homes for not for residential purpose, but mostly for commercial purposes right now. But it's interesting where we see this can go to. Obviously, we had around the crisis. We saw on the chart this dropped, but to me it doesn't seem like this is gonna drop anytime soon. And we're at the highest level ever, 4.5x to buy a house. That doesn't scream a healthy consumer. It screams that the asset prices are rising steadily, but consumers cannot keep up with the pace.
And then, turning our attention away from the US, but in Europe, we're seeing Q3 GDP not doing particularly well. We saw a rise of just 0.2%, whereas inflation is sort of outstripping that. It's around 2%, which wouldn't necessarily be the most alarming thing, but coupling this with a very meager GDP rally, we're worried about the European Union ultimately.
Yeah, definitely. I mean, the Euro area, the European Union they have many countries heavily reliant on exports to the US. Germany is one of them, and they stagnated in Q3. We've heard about automakers like Volkswagen, Mercedes-Benz. They are struggling right now. Their sales have plummeted. The revenues are down. Cash flows are down, and this is feeding straight away to the picture. Even Ireland, for example, which is a really interesting case because I think a third of their exports are going to the US. They actually shrunk in Q3 in the third quarter. So it's in my opinion, as we're gonna discuss later as well, the ECB, the markets are pricing not even a cut for the next 12 months, and that doesn't look right to me. Inflation is around 2%, obviously, but the market is not progressing as good as other big economies, right?
I mean, it's a very stark kind of divergence between the Fed, which is now shifting to a slightly more dovish rhetoric, and the ECB, which remains resolutely hawkish. Inflation at 2.2%, 2.1%, something around there. That's not far from target. If I was looking at GDP at 0.2%, and Germany were flat, were they?
Yeah, Germany
and Italy.
Yeah. And inflation at target. It's confusing to me why they're not cutting. I think you also have to be mindful of policy space, right? So Europe have done a lot of easing already. They're not like the Fed, which were like hold off for a long time. They started cutting a while ago, so their policy room to the downside is limited. So they're probably a little bit mindful of that. They don't want to be back at the zero lower bound.
No.
And yeah, I think it's concerning.
Yeah.
I mean, yeah, just to note on that chart as well, the Irish retracement is perhaps, contextually makes more sense given their ridiculously good performance in Q1, about 7.5%. But, yet again, as you say, Italy, Germany flat, a lot of countries sort of flat to contraction, even France kind of outperforming a lot of other countries. They're in a political situation that makes them very undesirable. But
also just on Ireland, they typically have very volatile GDP prints because they are seen as quite a beneficial place to have your tax office. So they have a lot of big US companies like Apple and Google that will have offices in Ireland, and that means that their GDP can be quite volatile.
But obviously it's a pretty dire situation in Europe, and we've seen Italy's deputy prime minister urging the ECB to cut rates and restart quantitative easing. So, even if we're not concluding that the US are taking QE, I mean, their retracement on quantitative tightening is coming to an end, and there are certainly some people calling in Europe for more QE. Do you think it's likely that we get it?
I think, relative to how cautious they've been with rate cuts, restarting QE would be a very big call to the market. I would see it as a shock. Now, the ECB has a different mandate than many economies to try to work their way through, because unlike the US, we're talking about economies like Greece or like France or Germany. So you have to explore different economies with many different risks domestically, and to try to accommodate everyone's needs will be really hard. I think they're slightly more skewed to what Germany and France are doing. Italy, though, is calling for at least a weaker euro because it's hurting exporters, as we've seen. And we can see here on a historical basis, euro is pretty strong right now. I wouldn't be surprised if we see euro dropping around 110, even by, not year end, by Q1 next year for sure.
It also strikes me as, any potential quantitative easing that we would see in Europe would probably be plastering over cracks in terms of supporting, private corporate bonds for companies that are, basically suffering and are likely to collapse. It may well not be at that stage yet if you're looking at big German and French manufacturing companies, that they're quite on the risk of sort of defaulting yet. So I'd be surprised if you were to get QE with the sort of purpose of supporting them. And if you were looking at investment, well, sure, QE does make, credit more easily available for investment, but I don't think more investment alone is going to be enough to sort of save these economies now. You need a really joint effort with availability of credit, affordable energy prices. You need to really start attacking any trade deals and all of that thing. And so, one round of QE alone is basically not going to do anything, I would have thought. You need, if it's going to come in order to really revamp what is a flailing economy, it's going to have to be in tandem with a huge overhaul of a lot of structural economic issues.
Yeah, for sure. And interestingly, on the euro dollar side, which in this chart, what triggered that kind of rally initially was people being scared of holding dollars, right? Everyone was selling their treasuries, selling their dollar, buying euro and bunds. Now that kind of that has changed a little bit. We've seen the dollar has gone bid again. We're closing on 100. US Treasuries, the 10-year, like I said, around 4%. That's catching a bid as well. So I think, we're kind of potentially on the precipice of a move to the downside in euro dollar here.
And then Bank of England, what are we seeing there? It's not that much prettier.
Yeah, it's not pretty. As we say, the dilemma here is either to defend the currency or the bond market right now. Obviously, the Bank of England is expected to hold rates at the next meeting. There's still a 30% probability, so people have to be slightly cautious. We had big banks like Goldman calling for were they expecting a cut for this meeting, but with inflation at 3.8%. I would be really surprised. Now the question is, you have to balance weak consumers because the domestically consumers here in the UK are struggling. Smaller companies are struggling, and in my opinion, I think they will just wait for the budget release before they make any new decisions. What do you think, Will?
Yeah, I'd agree. I think there's a lot of uncertainty over the budget at the moment. We've seen a lot of banks. I mean, gilts have had a great month, best month in 2 years, and a lot of banks are saying gilts are going to improve as well. So I think everyone should really be cautious over the budget. We don't know what's going to happen there. We've heard rumours, but we know the Labour government likes to float rumours to markets before they come out with any news, do a bit of damage control ahead of the announcements. I think more broadly though, inflation at 3.8%, that's still far off target. You know, the Bank of England has a plus or minus 0.5% wiggle room. So I would be surprised if we have much more of an aggressive easing cycle.
Yeah, because if we do, we would have this divergence in the pound basically against the dollar and the 10-year yields, which are mostly anchored to inflation expectations. And you know, that's basically the dilemma. If you cut rates right now, pound will go down, but the bond market will go up, and you have to try to obviously forgo something for the other one for the sake of improving the economy. So we'll see how this is going to play.
And then moving swiftly on, OpenAI, we're looking at a potential IPO here, potentially the largest IPO since Aramco a few years ago. I mean, this is one of the most significant companies worldwide at the moment. Questions over whether it's actually going to be, you know, the thing that takes us through in the next 50 or 100 years or something, they remain. I personally think it's a bubble, but yeah, I mean, OpenAI's potential IPO would be huge for investors, wouldn't it?
It's a big thing. I mean, you have average people, you have even corporates are now using ChatGPT, so it's definitely a powerful tool, but obviously you have to be slightly cautious. We see though the AI surge everywhere has been pretty significant in the market. AI is just the leading sector in the S&P. Anything else is doing relatively badly, as we're going to show later. So, you know, this huge news, 1 trillion valuation. I think this is slightly optimistic in my view. This seems too inflated, especially when you consider against huge majors like Aramco, which are backed by, Saudi.
Yeah, I mean, one of the things, obviously, to any potential valuation that you'll have to look at is the cash flows, and to see some of this funny accountancy work where they're, you know, getting investments from Microsoft, and then they commit to invest in Microsoft back and that sort of thing. That seems to be slightly fishy. So whilst it might make a balance sheet look pretty on the frontline page, digging a bit deeper, you'd have to question that. And similarly, I mean, you know, we can talk about OpenAI further in the show because it's now 16% of the GDP of the US. But to see these collaborations between Palantir and OpenAI, and when these two buzzwords combine, it creates this huge price effect. It seems crazy to my mind, but and you know, I don't think I'm the only one that thinks it's crazy. Berkshire Hathaway, we're now seeing them holding, you know, all-time high cash reserves. Warren Buffett doesn't like the S&P at the moment, clearly.
Yeah,
definitely. I mean, you know, Buffett's investment thesis has always been grounded in fundamentals, and looking at any sort of fundamentals on pretty much any components of the S&P is looking pretty overvalued, especially those big tech companies. But I also think, you know, part of this is Buffett's taking a step away. So we've got new management coming into Berkshire Hathaway. So perhaps they're slightly more risk averse. Maybe he's looking to take some equity out. Who knows? It's hard to tell. But for someone who historically has had a fundamental view, cash is probably where they'd be placing their money right now.
Yeah, definitely. They've been selling. They've been net sellers of stocks for the last 12 quarters. So that's 3 years, 3 consecutive years of being net sellers. There were rumors even last year and at the start of the year that they've been very cautious in the market. I'm not surprised, but this cash balance over 380 billion. That's huge. That's massive.
Then I mean, on a technical basis, in terms of the blowouts, whilst maybe they naturally are a bit more risk averse and Buffett's taking a step back, if you were to be looking at putting a long or short S&P trade on, I think the technicals are probably supporting your short hypothesis here. I think we're at crazy price to earnings ratios and everything here. You look at price to sales ratio, price to book ratio, forward price earnings ratio, 12-month dividend yield. Everything is just screaming, risk off or get short S&P.
But I mean, then again, we've had funds going short S&P time and time again this year and getting wiped out time and time again. And I come back to it every time. It's a flow story with the S&P. Returns are almost self-fulfilling because retail are just buying the all-time highs. And, looking back in history, if you have Fed easing whilst the US is not in a recession, there's never been a significant drawdown in equities. So, I mean, it to me, it's almost self-fulfilling. There needs to be a catalyst for a drawdown. And
looking at historicals is only so good so long as the environment is the same. So if retail is the big buyer and it's never been this easy to trade the S&P, 2025 putting a long S&P position is a lot easier than it was in like 1985. So to have these historic earnings ratios, even on a technical basis, it provides some value, but how much do you want and need to look into it? Then Nvidia. So we're seeing a blowout there. Nvidia's market cap now equal to 16% of the US GDP. Obviously, huge dependence of OpenAI and all AI companies on Nvidia's chips. Still, Trump also puts the headlines out saying he's not going to allow exports to China of, Nvidia's absolutely top AI chips and this sort of stuff. So we're seeing some absolutely, crazy stats about Nvidia, aren't we?
Yeah, Nvidia it's skyrocketed. It's even larger than obviously majority of the global stock markets. Even I think from memory, I think they're pretty close now to the Japanese stock market. Just Nvidia's market cap. So crazy valuations on AI. And the question is if this is going to burst at some point, then they will drag everything down.
I mean, the dependence of AI upon these great chips is such that, if we're having a booming AI sector and they are totally dependent on this one choke point, cool, it works. If AI starts to be questioned and people are thinking, well, either it's not going to be what it's promised to be or what it is at the moment is not good enough, and you see a burst of that bubble, then of course Nvidia goes with it. Similarly, if you have other chip manufacturers who are able to in stealth mode compete, then that would, relatively unlikely because these things take so much infrastructural investment. But if you see a dependence not on these chips as much, then Nvidia will go.
And in a way, kind of Trump's non-export policy towards China that's kind of setting the scene really for China to come in and build their own chips. And they have been investing heavily all the way down the supply chain. They have the rare earths, they have semiconductor manufacturing capabilities. I wouldn't be surprised if in a year's time, in the same way they launch their DeepSeek AI, that they'll have a competing chip that is outperforming even NVIDIA's top of the line for cheaper. Yeah,
also with DeepSeek as well, the hypothesis is it's going to be, requiring less computing functionality. Exactly. So even if the chips aren't as good that China's able to produce, as long as they're fit for their purpose, then,
Yeah, because we saw with China, they don't care if, they short term they buy or invest something less valuable than they could get elsewhere. For example, with soybeans, they were really happy to not buy cheaper soybeans from US and to here the country and buy elsewhere, buy from Brazil, have record purchases. So there's this growing appetite from China to just do whatever they want, and also issue to the companies domestically specific industries or players they can import from. So it's very significant.
And then, looking at the S&P 500, the S&P 499 seems to be struggling somewhat. I mean, it's definitely not a sort of green market all round. We're seeing a lot of red.
Yeah, it's all happy days everywhere. AI is obviously leading, but consumer-facing stocks are really down, are struggling everywhere, even up to 80% down over this year to date. So, in some sense, you could argue, in my opinion, why we see this appetite from the Fed to ease, because consumers are definitely not strong. We had obviously these rumors over the last few weeks. Not rumors. That actually these car credit agencies went bankrupt because consumers are not even repaying their loans, and quite frankly, they're really struggling right now.
And Will, we saw another company doing particularly badly this last week, Chipotle.
Yeah, well, I mean, the company signaled that younger diners are cutting back their purchases, and the stock fell 19% on Thursday's open. I think this is, again, a clear sign of weakness in the consumer base in the US. Typically in a slowdown, the first kind of sectors to get hit are those consumer services, and we saw that in COVID because of the lockdown, but more broadly, that's the first chunk of the disposable income that consumers will substitute. So I mean, this is clearly a bad sign for the health of consumers.
Yeah, I wonder if there's a hybrid. I don't disagree with what you're saying at all. I wonder sometimes whether we get into, when you look at a specific company like this, you can get into a bit of the gamified trading side, the Wall Street bet side of things. Yeah. But I do fundamentally agree that the value add of Chipotle in your life is arguably higher than the value add of Nvidia in my life. But that is a bit preposterous, but to see these, widespread food companies and service companies being taken, especially huge short positions, are obviously taken out on companies like this in order to push it down. It's a bit of an anomaly, but I think it does have some forward guidance of what we're going to be seeing going forward. And we mentioned the French economy earlier in the show, but we saw France's index closed down on the week. So despite not a disastrous GDP print, equities aren't looking fantastic over there.
No, I mean, I think it's, again, it's a distrust in the French government really that's driving all of this. Lawmakers have voted to set a 33% tax on share buybacks, and lawmakers are also passed surprise tax hikes on global firms. I mean, it's an attempt for France to kind of claw back a little bit of fiscal sustainability and a bit of fiscal responsibility, but markets are not going to like this sort of intervention. They want to see spending get cut, and France, they can't do that.
No, and spending cuts also, lose votes, as you say. So it's going to be. They're stuck between a rock and a hard place, I think. And, it's not going to be a good place for a while.
And the CAC 40 was doing pretty well earlier on in the year when we had that massive exodus from US capital markets over to Europe. Now it seems like capital's flowing the other way again, and that's gonna hit all of those European bourses as well.
And if we look at commodities, we're seeing, in the precious metals, gold seems to be hovering around this $4,000 mark. Yeah. It had, quite a significant down week last week and maybe the sort of 10 trading days before.
Yes.
It seems to have found a bit of a floor around $4,000 per ounce.
Yep.
Silver, palladium, similarly, they weren't having a great time. why do we think the optimism has run out and this will come off, or are we going to now be perhaps in a range between the gold $4,000 and $4,300, for instance, or?
Yeah, well, I think there's a few reasons why gold sold off so aggressively. I mean, for me, a big reason was it was no longer a safe haven. Volatility was way too high. The call put skew was heavily in favor of puts, and it looked like markets were getting nervous. So it just needed a little move to the downside, and then you suddenly get the panic selling. And I think, we've reached that kind of $4,000 psychological floor. I think that's going to stay in place for a while. We still have the fundamental kind of bullish gold thesis. Central banks are still buying. We still have reasonably hot inflation. And the only thing that's lacking there is it's become so volatile.
Yeah, definitely. I mean, central banks, some of them have already started stopping the gold purchasing. Some have already started actually selling those gold bars they had, and even jewelry demand is down year on year. So from a physical supply, also from a physical demand perspective, it's some things scream that this demand is not there, but it's mostly the investors in the financial side that are still interested in buying that.
Yeah.
And then, Will, talk us through Brent. We've seen a bit of volatility over the past week, a general softening. But OPEC were up to their usual business when there's been a price movement.
Exactly. So, I mean, we've had a bit of the market's been dragged in two directions, really, because we obviously had the wave of sanctions on Lukoil and Rosneft, which the market panicked. That would take off a huge amount of Russian supply. Obviously, things are more complicated, and that's not necessarily super likely, but we also have this kind of super glut narrative building, and that's what a lot of people have been paying attention to at ADIPEC and all the conferences, and that's been dragging the market in both ways. And then we had OPEC come out on Sunday, and they're going to continue with their cut unwind. So we're going to get an additional 137,000 barrels, most of which will be coming from Saudi. And they also updated their compensation schedule for those members that have been overproducing. But interestingly, they gave a bit of guidance about Q1 next year, which is that's not typical for OPEC. OPEC typically will just give a month ahead. Yeah. But now they're saying they're going to pause the unwinds.
Yeah. After December, they're going to be pausing it. So I think it's a bit of a mixed picture, and they are also prone to, number one, leaking things, but also leaking incorrect information. So there can be a lot of sell the rumor by the fact. But it's a bit of a hard one, and I suppose they wouldn't necessarily look for it to cause that much support at the front right now, especially if it's going to be a delayed impact. But it provides a bit of support into what is, not a super bid market, but is less offered than it was only a short time ago.
Definitely. We saw that contango creep forward pretty aggressively in the Brent curve, in the Dubai curve too. And they'll be looking at that, right? They'll be seeing how this market is pricing the supply and demand dynamics forward. And this is probably, in my view at least, a bit of damage control. Yeah. OPEC member states want to pump more, Saudi included. And they're really the only ones that can, in a way. There's UAE maybe a little bit more. But Saudi, they want to turn on the taps again. They've been having to issue more debt to fund their mega projects, and if they could avoid it, I think they'll try to.
Perfect. And then just to round up the show, we'll talk you through the central bank interest rate pricing. So as we mentioned earlier, the Fed currently forecast for 3 cuts over the next year or so, the next 12 months. ECB flattish, despite what everyone at Macro Mondays at Onyx is advising to the European economies. Bank of England forecast between 2 and 3 cuts, currently nearer 2 cuts. I wouldn't be surprised if we were to see slightly more aggressive monetary policy there, and Bank of Japan's steadily creeping up. We're at 2 raises forecast for the next 12 months. So the differential, obviously, in interest rates between Japan and the rest of the world will actually be, ultimately it will be narrowing because Japan will be steadily raising and the rest of the world will be cutting. And we have a relatively big week of data up ahead. So we've got a lot of Euro area manufacturing PMIs for the European area, UK, US, India, and Canada on Monday. Japanese manufacturing PMI and French budget balance on Tuesday. And Wednesday, yet again, we have services PMI. So towards the end of the week, we'll have a full picture there.
Yep.
France industrial production. And then, Will, can you talk us through Thursday and Friday?
Yeah, on Thursday we'll have the Bank of England interest rate decision and the monetary policy report will be released. We'll have Euro area retail sales, Japan and India services PMIs, and Euro area construction PMIs. On Friday, we'll then get China, Germany, and France trade data. So that'll be pretty pivotal in the narrative, I'd imagine. We'll get the US Michigan survey data, as well as Japan's household spending PMI.
So yeah, there's a lot of, especially on the manufacturing side, we're seeing a lot of data come out this next week.
Yeah.
And yet again, given the US shutdown, this is probably going to have it's going to inform a larger percentage of people's trading decisions. So I wouldn't be surprised if we do see some headlines off the back of it. But to keep a tab of all headlines, please make sure you go to Flux on LinkedIn. You'll see the daily updates that we provide there. And in the meantime, thank you very much for watching and listening, and we will see you next week.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined once again by Harry and Julian. This week we're going to take a slightly different approach. We're going to look at benchmarking and why it's important and how you can use the Flux platform to make better informed hedging and procurement decisions. I think last week we were talking a lot about diesel, and I think it's particularly important for that market, but probably even more so for the biofuels market, where it's particularly opaque and difficult to get an idea of where spot and forward prices are trading. So yeah, just if we kind of recap last week, Julian, you gave us a bit of a breakdown of what makes up the price of diesel at the pump. So maybe we'll recap that briefly, and then we'll go on to talk about HVO as well. And
absolutely, Tom. So this pie chart actually you can find on our website if you navigate to Flux Markets /diesel. We're taking government data here and then blending and decomposing that government data to give you this pie chart. And I think one thing that's really important, if you subscribe to Flux Markets, you can dig in and see this value changing in the future, which is really important. Some people are aware and other people aren't aware that the pump price is one thing, that's today's price or the spot price, i.e. for immediate delivery, but actually this price evolves over time, and at the moment actually it's getting cheaper the further forward we look. And in this time of where everyone's very acutely aware of affordability, it's really important. As you say, that's much more difficult to do with biofuels. And actually on this pie chart, there is a sliver there. Let me just see, it's the RTFO costs. That's the cost to be compliant to blend in biofuels. So that yellow sliver there, it looks very thin. It's about 7-8p. It varies. It's been as low as 0 and it's been as high as 12-13p. So it's very variable. It's a substantial amount of the fuel price at the pump. And that is driven by the cost of blending fuels into diesel. And we're going to look a little bit more at that today. So just looking at that pie chart in a different way, in terms of thinking about affordability, that dark blue part is the raw cost of diesel. Then the green part's that renewable transport fuel obligation, the RTFO compliance cost, the cost of blending in the amount of biofuel to meet the RTFO mandate. And it's really important here, B7, when you're filling up your car with diesel, you might have noticed that it says B7. Diesel cannot be more than 7% bio, physically. So the actual RTFO mandate, if you look at it, it's today around about 14-15%, and it's increasing over time. So in terms of affordability, that cost is that yellow sliver is going to increase, right? And that is being driven by pressure, various different pressures, feedstock pressures. We can cover that a little later. It's pushing that cost up.
So that's an important point, actually, just to kind of reiterate. So you're paying for 14% biofuel component, but actually only 7%
is actually going into your car. Yeah, it is a really important point. You're absolutely right to pick that out. But it actually, the grid is decomposed. Well, I view the network, I should say, that's the entire sort of fuel pump network, whether it's physically large bulk fuel being delivered into a bus company's depot, or whether it's a retail person filling up their car, ultimately is decarbonising by about 14%. RTFO, keep those statistics, you can look on their website to see that if you want to, and the history of what actually has been blended in. And we'll come back to that because 7% is the max here. So how on earth do we get to 14%? That's through a different type of biofuel, HVO, which we'll have a look at in a second. And on the previous slide and on this slide here, we've got these two red bars. Affordability is a key thing at the moment. And if we look at those red bars for the previous slide and for HVO, this is the government tax. This is duty, 53, almost 53p. That bigger bar there on the right-hand side and the bar above it, that's VAT. So VAT and duty together are a substantial amount of the diesel cost. And what we can see here is the UK's UCO, used cooking oil, that stands for HVO. And this HVO has apparently a significant greenhouse gas savings. That is, it's more, a plant was planted over a year ago. It sucks CO2 out of the atmosphere. That plant was planted to produce cooking oil. That cooking oil was used to cook. It's then been collected after being used and fed into a refinery to produce HVO. HVO is very expensive because you imagine picking up a lot of 1 litre bits of used cooking oil everywhere, and then bringing it back to a refinery and redistributing is expensive. And what you can see here immediately on that blue bar, the raw cost of HVO, used cooking oil based HVO, is 3 times more expensive than diesel. Okay. Now, this has got an orange bar on it, and that's because this market is subsidised by the RTFO scheme. So when you buy diesel, that little green sliver, we were looking at green sliver on the previous slide, that 7-8p has been collected. There's billions of litres of diesel being consumed in this country. That's going into a pool at the DFT, and then the DFT are redistributing that pool for people bringing in 100% HVO and other biofuels too, and they are then getting subsidised. And I always say a subsidised market's not ideal. It suggests fundamentally it doesn't really work, possibly, right? Thinking about affordability, this is not a great situation to be in, but however, HVO is the easiest fuel to try and change over to a greener fuel. And I'll say that in inverted commas because I'm not sure how green HVO really is myself. But anyway, so this is expensive. Tom, you want to say?
That was, a valid point. I just want to say about HVO versus sort of other biofuels like FAME and Ucomi is that HVO is fully interchangeable with diesel, isn't it? So
yes, it is.
You can run it in a normal diesel car. There's no kind of cap on how much you can blend. Absolutely. And it can also kind of sit there in a reserve tank indefinitely almost without breaking down. So it's quite
absolutely right.
Desirable for things like data centers and things like that for their backup generators.
Back to affordability, you don't need to change any of your pipelines, you don't need to warm your tank. So some biofuels like fatty acid methyl ester, you need to, if you went with a 100% fatty acid methyl ester, it's cheaper, but actually you have to heat your tank, heat the line, and make changes to the vehicle. With this fuel, there's no change. So it's an immediate replacement with no capex, no capital expenditure. So this is considered the fuel to decarbonise this network at scale. And when I say at scale, we're at 14% now. Come 2030, we're at 30% for the EU, and the UK is following that trajectory. So we're going to see more and more of this coming to the pump. And I put this in inverted commas, pump price, because you generally can't buy HVO at the pump at the moment.
Yeah, I was going to say, in terms of demand for HVO, it's still kind of industry, right?
Yes. Yeah.
It's not like a kind of commercially available fuel for retail consumers.
One reason for that is, as we look at this chart, is the expense. It's 3 times more expensive.
That's who would actually buy it?
And it's really companies coming out of COVID that were really, they've got a lot of, they've got their customer base were very focused on decarbonising. So, just imagine a pizza box from pizza supplier down your road with "we've gone green" on it. This would be one way they'd achieve that ESG focus. But of course, with affordability being so apparent in this country at the moment, tax burden and everything else, this is a real issue, and this is an expensive fuel to change. So pump price here, this builds up to £1.83 with VAT and duty on, with no supplier margin embedded into that. Whereas today I can buy diesel at £1.40. So it's significantly 50-60p more expensive. It really is. And again, in the context of 50 litres, that may not feel unachievable. It's on affordability on a personal basis, of course. But if your Domino's Pizza is consuming 30 million litres of diesel a year, 60p is now a very big change in cost. Yeah. But you were saying, Tom, we've had a lot of people coming and asking us about benchmarking.
Yes,
that's the key thing
absolutely, here. Because lots of these companies are using these fuels. They're kind of they're significant purchase of it, but it's very difficult for them to get any transparency over where the market's trading, and particularly particularly to gain access to a forward curve. Because they want to hedge their demand going out 1 year, 2 years, and there's whole market's completely opaque, really, isn't it?
Yes, it really is. And maybe that's a good point to go to the next slide here quickly. So if you were a subscriber, and you can get a free trial, so you can check these numbers out. You can log on and see these numbers changing every day. We're marking them every day and live during the course of the day. And, HVO is still a developing, fuel physically and also on a forward market basis. We've striven to put it on here. And what you can see here is this now doesn't include VAT. Okay, but we do have duty on these numbers. Okay, so you need to add it, and it doesn't include VAT. It doesn't include supplier margin either. So this is the fuel with duty without VAT and supplier margin.
So it's effectively like a kind of wholesale price, isn't it?
Thank you. Yeah, exactly right. Well, yeah, good addition. And what we can see here is actually the BALMO or spot forward numbers were £1.52 for HVO. And we've had a few people going, that number's completely wrong. I can buy at £1.30. Why? You're completely wrong on your number. This number is good. And as what we can see with the forward curve here is it's very what we call backwardated. It's getting cheaper and cheaper as we go further forward, and it drops off into 2026 to almost £1.30, £1.31, £1.32-ish. And if we took an average of 26, it'd be around about £1.32 and a half, approximately, right? Comparison to diesel, right? Diesel, ex-rack diesel with duty, no VAT, no supplier margin, that is around about £1.2. So we got £1.32 and we got £1.02. So we've got about a 30p difference. And if people are often looking at HVO and diesel, both fixed price, this is a really good platform to benchmark what your supplier's offering you, first off. So real live example, we've had 3 or 4 people in the last week coming into us, your spot number's wrong. We can buy at £1.32 on diesel, £1.33 on HVO. Okay, and we can also buy diesel plus a fixed premium. Just for example, £1.25p. So how would you use this platform to compare floating diesel price plus 25p for HVO? So the HVO is priced on diesel. You'd look at the diesel line on the right hand side here. Look at the 2026 value, about £1.02. Add on your premium 25p, that works out to be £1.27. So you could range your physical floating plus that differential, come on here and hedge on diesel to lock in your HVO supply cost at £1.27. Or you could buy from your physical supplier at £1.32p for the HVO. So the platform's really useful for benchmarking and actually asset checking. Am I getting good value with this fixed price offer from the supplier, or should I build it by floating and actually hedge independently?
In both of those examples, I think that the platform just makes it really clear there, isn't it? That's a great deal, and you should absolutely go to your supplier and lock that in. And I think it's worth mentioning as well that the supplier might not be pricing based on spot or where they see forward. They might still be pricing on where they bought the inventory.
And that might have been 2 or 3 months ago. It might have been that they aren't holding inventory, but they've got a contracted price that they arranged 2-3 months ago, at the beginning of the year even, because the volumes of HVO are around about, from memory, it's around about. I need to think this through. It's about 400 million litres. Last time I checked, it's probably higher than that now. And it will increase because of the changes you mentioned. And we'll come back to this in a minute. We're going to see more and more HVO coming online, more and more need for people to control and benchmark costs. We think the platform's brilliant for it. And as you say, your supplier's volume turnover, it's not the same as diesel, where they're literally turning their tank over 1 or 2 times a day, right? That's not the same case for HVO at the moment, because the uptick it's a fraction, it's 1% of diesel turnover, right? So it's much smaller turnover, but it's going to increase massively, I think.
Yeah, and then I think, Harry, you were going to give us a bit of an overview of what's been going on in the diesel and HVO markets, actually, which kind of might help to explain a little bit.
Yeah, well,
how those suppliers are able to sell HVO so cheaply, because we've been in a bit of a bull market.
Yeah, well, HVO has been in a bull market this whole year, basically. I mean, we'll see some charts in a bit, but there's this chart actually on the screen at the moment is this is the gas oil swap, and since we filmed the show last week, there was sort of there was a global rally in gas oil prices, which is the benchmark for diesel prices, and this was caused by a number of things. So there were some announcements on kind of further sanctions on Russian companies who supply a lot of the refineries in the east still. So that kind of squeezes the margin on these refineries in the east to procure crude from elsewhere. So we saw gas oil versus we've touched on cracks last week, but the difference between the gas oil product from the refinery and the feedstock crude oil, that differential blew out completely for gas oil this week. And we just saw outright gas oil prices. I think they outperformed Brent by about $8 a barrel.
Yeah, had a huge day on Wednesday, didn't it? But it was also kind of, I think Tuesday had already started rallying and almost did about $100 a ton, didn't it?
Yeah, it did. Yeah, and again, you never really know. The Russian sanctions, they get announced. It's all a kind of bit of a perception thing because you never really know how it's going to actually materialize. But whatever, the price action was strong. There also was some news of some refinery outages, one in Kuwait, I think one in India as well, where some of the secondary units were offline and took a significant capacity offline. And again, these refineries were big middle distillate producing refineries. So coming into winter, and you've got kind of cold weather as well, coming into winter, it's, the stocks were quite low around the world and the market was kind of primed for shocks to the upside. So when you have this kind of news, it just completely goes hyperbolic.
Because we've been talking about tightness in this market, like even since the summer, right? And I guess the kind of moving into winter, then you've got this additional like seasonality dimension as well.
Yeah, and it was maybe waiting for a bit of an impetus to move. And when you've got a market kind of primed like that, when you have like a shock, multiple shocks, this kind of thing can happen.
It might be worth saying to some of the listeners just why would India and the Middle East impact the UK? And some people may not realise we hardly refine any diesel in the middle distillate here at all. We import everything, right? More or less.
Europe's an enormous diesel consuming continent, but it's not an enormous diesel producing continent. So it relies heavily on imports. And since the whole Russia war's been going on, the kind of global, Russia was a huge exporter of diesel
to the UK. It was kind of coming in through other countries, but effectively all of this stuff, any kind of shock to global supply is going to shock Europe as well. So even though it seemed like it was the Singapore contracts and the kind of Asia contracts that were driving it, because they are the kind of purchasers of this Russian crude, and that's where that Q80 refinery supply would likely go as well. But Europe's not immune to it. It's a very import reliant continent. So any of this kind of global supply disruptions is going to massively affect Europe. And we've seen kind of in June as well, when we saw like tightness in like the Middle East and tightness in the US. It was the Europe contract that did a lot of the work. The Europe contract blew out again just because of the reliability on imports. Yeah, thanks, Jim. It's good point. And then this chart was just to visualize. So this is the wholesale HVO. This is the dollars per ton price of HVO cargo. And this is just to illustrate kind of since the summer, but we've seen kind of more broadly throughout the whole year, just a really kind of steady, sometimes aggressive bull market. And various reasons, but recently, and I'm going to put you on the spot a bit here, Julian, but that's fine.
But recently, the narrative has been around some of this new EU legislation,
absolutely,
which is kind of squeezing the kind of putting a perceived squeeze on biofuels.
It certainly has. What struck me before I answer that is just what I want to point out. That raw HVO cost here is $2,600 a ton. Mm-hmm. Raw diesel cost is $700 a ton. So it's more than 3 times more expensive, this fuel. Hugely expensive. To your point, your question you were asking me, Harry, there's been a confluence of issues. Close to home, we have, actually went live in May this year, is the RED, Renewable Energy Directive 3. It's the 3rd generation of the RED directive. And this is an EU directive, and a directive means we're directing countries to adopt this and bring it into legislation, and it's up to the countries in the EU how they adopt it. So which makes biofuel trading very complicated as a result, because they all adopt it in different ways. And some have adopted it and some haven't, at different stages, although it was supposed to come in full force in May this year. The key thing about RED 3 is that it is getting rid of double counting. So if you cast your mind, let's quickly go back to that slide for HVO for a second. And see the orange bar there? That's the subsidy. It's discounting the price. And that subsidy is double counted. It's 2 times the subsidy. That double counting is going to disappear, and we're going to use GHG, greenhouse gas savings. The amount of carbon this fuel actually saves will subsidise this fuel cost. So it won't be double counted based on used cooking oil. And subsidies themselves can, I always think, I might have said this before, the Indian copper effect. There was this, 200-300 years ago, too many coppers, people getting bitten. So the local sort of councillor said, you know what, I'll put a 1 rupee on every copper's head. And suddenly noticed that more coppers were coming, heads were coming over because he had an incentive, right? People were now farming coppers to collect the incentive. So there's this perversion of subsidies, and this can absolutely happen with used cooking oil. Used cooking oil can be more expensive than virgin cooking oil. And when that's the case, virgin cooking oil gets classed as used cooking oil, right? So yeah, anyway, the point really to answer your question, RED 3 is getting rid of double counting, and counting will be on a greenhouse gas basis. We could do a whole topic on that. Let's come out of that for a second. So that is going to drive up feedstock demand. So instead of 1 litre of feedstock getting 2 times the subsidy, I now need to bring double the amount of feedstock in, almost effectively, right? So it's put demand on feedstocks. The other thing RED 3 has got rid of is POME. So palm oil mill effluent. It's a really nasty thing, but it's a derivative of palm oil. And lots of people are anti-palm oil in the ESG movement because cut down lots of rainforests to put this in place. Arguments for and against it. Let's not go into that right now. Getting rid of POME, there's a lot of it around. And this now means there's more demand on feedstock. So feedstock prices have gone up, HVO prices have gone up. The other 2 key pieces, actually the other piece that we're missing from this is in the States, the EPA, the Environmental Protection Agency, have just massively expanded their amount of renewable diesel requirement in their to decarbonise their network. So that means no exports from Russia, from the United States, excuse the faux pas, from the United States, leaving the United States because of Trump's tariffs and also the EPA. So there's been a whole confluence of things that have really put massive pressure. And then the other thing is that we've got legislation for SAF coming in for CORSIA, for airlines to decarbonise, for marine to decarbonise.
And that's SAF is Sustainable Aviation Fuel.
Yes, exactly.
There's a lot of acronyms in there.
Lots of acronyms. Yeah. So it's equivalent, it's this jet fuel equivalent of HVO. So SAF, Sustainable Aviation Fuel, is produced at the same time from the same refinery, part of the refinery that produces HVO, but it comes out lighter end. Okay, and it's blended into jet fuel, maximum 50%. That's gone through the roof as well, along with HVO, because now that we've got this huge focus. So legislation's driving change, driving feedstock change, feedstock cost. There's not enough of these feedstocks around. So in terms of affordability, I can see diesel at the pump getting more expensive. Another reason to come on and look at the platform to fix in your costs, right? And this is not today, tomorrow, but gradually, almost imperceptibly over time, over the course of the next 2-3 years, we'll see diesel going up and that yellow wedge increasing in cost. Bigger element. Okay, the flat price might change, go up, down, but that's going to increase effectively, and we're going to see these costs escalate, I think, as well. Anyway, that's it in a nutshell, I guess.
Cool.
So yeah, I guess then in summary, I think it's just so important, isn't it, having that visibility into the future, being able to see that forward curve, and I guess being able to use that to inform your procurement decisions today, but also secondly having the ability to kind of lock in prices in the future.
Yeah, talking about the backwardation of the HVOs, I think what a lot of people don't understand is, well, if you don't have the visibility on the forward curve, you don't understand how different those values can be in terms of, your spot versus your 12 months out, say. So when you're budgeting or even getting quotes to lock prices in, a lot of people are kind of, your providers are going to be relying on the sort of opaqueness of the market to, to really kind of capitalize on you not knowing how kind of backwardated this market was. You're just taking one price and extrapolating it for the rest of the 12-month period.
100%.
But also if you're budgeting, quite often in backwardated markets, there's a lot more kind of favorable prices to be locked in the future than you might think, being like, well, if the prompt price is £1.50 a litre, just the wholesale price, why would it be like £1.10 a year out? That doesn't make sense. But when you look at the curve, that's kind of like how these markets work, right?
And those prices do tend to roll up, don't they, as they become more prompt?
Yeah, absolutely they do. And I think it's about, you want to compare apples with apples, pears with pears. So you might get one supplier showing you for the same thing, a pear price, an apple price, a pumpkin price, right? But you need to be able to decompose that. So you want tools. You may not be financially hedging, but this will give you those tools to be able to assess value better. And the feedback we've had from 3 major logistic companies is that this was very handy for them to make a decision how they would contract that physical fuel purchase. So not coming here to financially hedge, but to actually engage and work out best value, where to go.
For sure.
Yeah, and I think probably as we've sort of illustrated here, this is a very complicated market to navigate. There's a ton of rules and regulations, a ton of subsidies. Those subsidies are changing all the time. So anything you can use to help give you better visibility is just incredibly valuable. And obviously we're here as well to help our clients as well, and to sort of guide them through the best way to use the platform and kind of how to get the most out of it.
Yeah, absolutely.
Great. Well, I think that's about all for this week. Thank you very much for joining us again. And yeah, we look forward to speaking again soon. Once again, I think as we mentioned last time, if you do have any burning questions or there's any subjects you'd like us to drill into in a bit more detail, please email in, tweet us, and we'd be more than happy to discuss it on the show.
100%.
Great. See you next time.
Nice one.
Thank you.
So there's a difference between gambling and taking risks. So in my understanding, the way I see it is gambling is you're just betting without any kind of edge whatsoever. Whereas taking risk in trading, there's the old phrase of like stacking probabilities.
Well, that's James King.
Yeah, James King, right? Stacking probabilities in your favor. Like that's what you're trying to do. And when you have done the preparation and the work that's necessary, you can go big. You can go, if you've built a strategy with a great expectancy, you know, good win-loss. When you win more than what you lose. I mean, you know, when you have good metrics, by all means maximize that strategy as much as possible. But that doesn't mean you just go, okay, I need to make money, let me go and buy some flat price.
Fakhri, thanks for doing this. I know you hate this kind of stuff, but
very uncomfortable. Well, gonna have to deal with it.
We'll just start with a quick fire round. You know, probably quite a lot of people do know you in the Dubai market. That's where you trade. That's where you traded for about 10 years now. But you know, as it is with the industry, like there's all these niches, right? So summarizing it, your career been how long in oil trading?
Since 2015, end of 2015, so that takes us right about the 10-year mark.
Yeah, and always been Dubai crude really in oil.
So when I started off, I did the usual kind of rotations.
Yeah.
It took me a bit to find my niche. So I traded a little bit of fuel, a little bit of brief period in naphtha, distillates, but I always kind of found my way back to Dubai.
You started with me, right?
Yeah.
Yeah, it was good times. And you always used to get shit for not marking your curve at the back. It was just not really your style. Chimming in and out. So I guess before we get into like more the detail, just summarizing, like how would you, and I know this has evolved, but if you had to very quickly summarize your trading philosophy.
So in terms of how I trade, so I trade especially now, predominantly systematically. So all of my trading is very process-based. That wasn't always the case. Let's say 10 years ago, 5 years ago, there was a lot more room for discretionary trading in the market, for day trading in general. As the market has evolved, I've also kind of moved a little bit towards slightly longer term, more signal-based trading. So I'd probably say I trade medium term momentum with a variety of signals based on flows. So, just understanding why and how people trade to hedge different kinds of risk, different kinds of books, and that helps me, kind of guides me through the ebb and flow of the market on a day-to-day basis.
So very much trading as a trader rather than always been about oil and oil specifics. You were at JP Morgan before, right?
Yes, so I started my career at JP Morgan, actually with their credit trading team in London. So I did that for 3 years. That was my first job. And then eventually moved on. So that was very much a classic bank derivatives market making role. And then 3 years later, I moved on to Mandara.
Cool. So first, when did you first realize you want to be a trader?
Well, at university, I was doing my bachelor's in economics and management. So I was remotely interested in understanding economies and businesses. I've always liked playing games, video games, board games, anything like that. So in my mind back then, the job that would combine those three things seemed to be trading.
Grad scheme thing.
Yeah, so the process back then, the if you wanted to go into trading, you applied to internships, the summer internships. So I did that, applied everywhere, got into JP, did that in the summer of my second year, got the offer to come back after I graduated for the full-time grad scheme. And yeah, that was the start really.
Okay, so favorite trading book?
Ooh. Probably the one that had the most impact is a book called Mastering the Trade by this guy called John Carter, I think.
Got it over
John
there.
Carter.
Yeah.
Do you have it?
I think so, yeah.
It's a very good book. I really like it.
Quite niche, industry specific.
It's got nothing to do with oil. It was...
Sorry, what I say, trading industry.
Yeah, for sure. I mean, the reason why is some of the ways in which it talks about coming up with trading strategies, I learned from that. Even though it's completely about, I think the guy mainly traded S&Ps and things like that. And none of the strategies that he used are even remotely applicable to oil. The method, the way that he thought about coming up with strategies was very useful.
And so where are you most at home, and like which asset class are you most at home in from analyzing, feeling like you know what's going on?
I really like oil. To be honest, my time at credit, frankly, I didn't really understand much there, but oil is a lot
more tangible.
A lot more tangible, and I feel like I get the market a lot more.
Okay. Favorite trading film?
I don't even know about films. What's the series that came out? Internship? Industry. Yeah.
Did you watch that?
I did watch it. I think honestly, in terms of describing and portraying the grad scheme, the internship kind of vibes, it's quite accurate.
Okay.
Apart from all the rowdy stuff.
Yeah. You sure? Okay.
At least I didn't do it.
Yeah. What's your most memorable market event that you've been a part of?
Oh, it has to be the start of probably the Russian-Ukrainian war.
Really? Okay. So kind of later on.
COVID before that, but I'd say they were, maybe COVID just because apart from the market moves, there was also infrastructural change. We all moved to working from home and one of those two, yeah.
And if you weren't a trader, what do you think you'd do?
I don't know. It's a very tough question.
But I guess economics something still, right? So you enjoyed that.
I don't know. I think probably. It's hard to say because I like it would have to be something a bit more dynamic.
Wrestling?
Who knows?
Because you're a passionate wrestler from my memory back in the day.
So I trained
Was
jiu-jitsu.
it? No, but when we first at Mandara, you were into wrestling, no?
I just, yes, but now
We had
I
a
train
few
jiu-jitsu.
spars on the trading floor, if you remember.
Yeah. Maybe, who knows? Who knows? I think I'm a bit too old.
And
to
if
become-
you're aware of any nicknames, or what would you, if there was a trader nickname, do you know what it would be? No idea, right? The Stoic, something like that. Okay, so just last one. So if it was day trading or swing trading, what would you consider yourself?
Or swing trading.
Swing trading, yeah, great. Thank you. All right, cool. So, yeah, I'd like to get more into, as you say, the JP Morgan credit time. And I think it's come up in conversations with us quite a lot. And I think for people listening, you know, everyone has their different starts in oil. And I think it's kind of unusual, actually, given how niche this industry is, for people to come from the outside into oil. I think that's actually more of a rarity than a standard thing, standard process. But do you think that macro element, it sounds like you say you're really into oil, but as in, did that still guide your thinking as you entered, and still to this day, you feel like you have to have a good grasp of the macroeconomics to guide yourself in oil?
So at first, yes, but that was a very incorrect way of thinking.
Okay.
I thought I had in terms of my grasp of macro was completely useless.
Okay.
So I think the time at JP Morgan was very good at teaching you, first of all, the basics of derivatives trading, the different types of products, more importantly, the concept of taking risk, warehousing it, and managing it.
Yeah.
Because when you work there, or in fact for any big investment bank as a market maker, you're constantly showing prices. You're constantly having to make markets for your clients. You can't just one day say, oh, I don't understand what's going on. I'm just going to take it easy today and get my bearings, which is actually a luxury that I have now. You know, so that teaches you a lot, and it's a lot of very painful lessons that you learn. But if you're able to think about and to analyze how how your decision making takes place in those different difficult moments, then there's a lot of learnings you can have. So for me, it's mainly the benefits came from understanding how to manage risk, how not to manage risk, the overall workflow, like the business of trading, the broader business of trading. You can learn a lot as well from that environment. It's a very good school.
I was going to say that. I mean, your learnings are really interesting, and we've actually talked, what we're trying to do at Onyx and what we were doing at Mandara before that, and what JP Morgan were doing. It does guide your trading, isn't it? Because like you're saying, when you were in the seat at JP Morgan, I guess the decision from management or what you were there to do was facilitate the franchise. That was the highest
Yes.
priority, right? And kind of
Yes.
money making was almost second.
If you were taking down all the flow and you weren't necessarily making a whole lot of money, as a junior guy for sure you'd be probably a superstar. Of course, the more senior you got, you also have to make money as well. But the way you would do that is through market making.
Yeah. And then pivoted to Mandara and even Onyx, as you say now. It's like, you're right, it's that luxury of saying, actually, we're kind of proprietary traders. We can go to trade and pick what we want to do. It found its way to being a market-making operation, because that's where a lot of our trading and our risk profile was, until it became like a skill set and a franchise move to be doing that day in, day out, which is very much what you had the ultimate hold on in Dubai crude, because it's one curve, it's very difficult to market make. I did it myself for a long time, was figuring out after costs, I'm literally like break even here, it's a pain. And so to figure out how to reliably provide liquidity whilst also making money is actually a very difficult thing to do. And the evolution of that market has become like, well, actually there's no real market making, or market making or providing liquidity is a different thing now. It's like you're there to take risk OTC if needed, but chopping in and out is a screen-based thing now, right?
Very much so. And I mean, the funny thing is, when I was at JP, I hated market making. So
Okay.
in fact, that was, for me, my biggest challenge of my time at JP was the fact that I hated market making. It was completely foreign to my personality because I was, like back then, I was quite introverted. To some extent, I am still today, but I can manage it better now. But as a market maker, there's a lot of different stakeholders that you have to build relationships with, you have to manage. It's always noisy, it's chaotic. You can't just sit down.
I'm slightly laughing because I remember, like, I don't know, like 6 months in, you were a bit of a character, right? Yeah, I know you're introverted, but you're also like confident, right? Maybe we do still a lot of pit trading. So
Yes.
just games like betting on IMDb ratings or whatever it was. And we were just encouraged to get in a room and just train, I guess. And then you were very much like, I'm going to make a market. I'm here at here. And I remember everyone tried to buy you and you were just like, so to everyone. Do you remember that?
Yes,
It's
yes.
hilarious. Like,
But that's, I mean, the games is one side when you're actually doing it. Like, I didn't like it so much that I convinced myself by kind of the second year that I'm never going to do market making. But the funny thing is, when I started trading Dubai at Mandara, I almost built like a market making business voluntarily. So I think
because you could see there was an edge in it, essentially.
because there was a demand for it, but largely because you could find a process and a methodology to run risk, but then you could trade that risk, those positions around as a market maker. Now, market making there wasn't the same thing. You weren't constantly showing two ways or anything. You were just providing and taking liquidity at different points in time when that was required. You weren't constantly on the market, showing two ways.
That's a big thing for us as well, isn't it? It's like, can you show me a two-way? And I always used to hate that question. Like, no, I'll show you, like, if I can counter. These days, and again, I think
That's the norm.
That's the norm, yeah. Show me a two-way. Okay, fine, here it is.
That's how it used to be, like, that's a very classic question when you're a trader at a bank as well. And you have to, you then have to guess, okay, what are they going to do? Skew the market based on that, skew the market based on what your own position is and what you want to do.
Where you're comfortable, yeah.
It becomes a slightly different. But the problem is when you're doing that all day long, you don't really have that much time or space to zoom out and to think about, well, what is the market actually doing? Which position do I actually want to have? You're stuck in that loop of taking risk off the back of what you see is going on, which is fine depending on which market you're trading. But a lot of the time, you really need that space to zoom out and to build, your trading strategies, to build how you want to actually run risk. If there was no market, if you didn't know who's doing what do you want to do? That was quite hard.
That's a great segue into my next question, which is 2024 and certainly 2025, I think unilaterally has been considered difficult trading conditions. Yet you've had a good year and you've never really had a bad year, let's be honest, but it's one of those things where the numbers would probably make it seem like you've got some like system going on and you're just like, yeah. But there's a lot of iterations and evolutions, more importantly. And I think that must come into your philosophy and approach to trading, right? Always be reinventing or at least trying to have a kind of anti-fragile approach to trading, which kind of comes back to the first bit that you just said. It's like, what do you want to do? And if you can't start there, then you're at the mercy of the market, really, of which there are a lot of traders who are essentially at the mercy of the market beta or the market paying the bid offer or whatever, right?
Very much so. I mean, you're right, because and that's the most difficult part. The market will, in my memory, for however long I've been trading Dubai, it changes at least once a year, maybe several times a year, the whole paradigm of what's driving the market, even how the market trades. I'm not talking about things where how the screen has become dominant and all those new algorithms that are running on the screen. That's a whole separate discussion. But the market will always change with varying frequency, and while my core methodology of trading hasn't changed, I've had to constantly reshape it and adapt it to the new market. And then you absolutely have to, because otherwise you'll be left behind.
So are you thinking ahead for that, or are you just looking at maximizing what you have at the time, and when it stops working, you kind of start again?
Yeah, I'd love to be able to think ahead, but I can't. So when what I have is working, I try to maximize that, and then you inevitably hit a rough patch. And that's always a very tricky part, because let's say you have a set of strategies, and in the back test, they perform, but they will inevitably they don't always make money, right? They're going to make money, there's going to be a period where they lose money or they plateau, and you're going to have some sort of hopefully positive equity curve with a bit of volatility. It's always hard to know whether your rough patch now is within the normal parameters of the system, or your strategies are becoming obsolete. So usually, there's something that you expect within the backtest. When you're approaching the limits to that, that's when you start thinking, okay, are we in a changing paradigm? Do we need to start kind of thinking about how to change this? It's always very tricky, but generally I will typically hit a patch where, okay, it's just not going right. Maybe I'm not losing money, but I'm plateauing. And then you have to then make a conscious decision. Okay, does that mean the way I think about the market is no longer valid? If so, let's iterate, let's think what we can change.
What's really interesting there for me, again, is the kind of general, I think, way people trade and apply themselves versus the way I think you do it quite differently is you are looking at your system, what do you call them, the parameters first, and you're saying, this is my VAR, this is my drawdown, this is what I think the market can give me with these strategies, and that's where I'm going to maximize. You're not one of those traders that goes, well, if I can make 5, I can make 50, I can make 500. If you don't mind saying, you've been approached by the bigger firms who've said, come and like scale, how can you make, I don't know, 100 million? And you're like, well, that's actually changing everything. That changes everything I do, and
Yeah, because there is some scalability. Well, there is a scalability of any the more short-term a strategy is, the harder it is to scale it, because it depends on faster movements. The longer term your strategy is, the more scalable it should, in theory, become, but also the more P&L volatility you have to be prepared to warehouse. So there's always that trade-off. So yes, if somebody tells me, okay, can you 10 up your risk now? Sure, but that's going to bring about more problems with getting in and out of positions. That's going to, in fact, probably I don't think I can 10x the position. I could probably triple it. Beyond that, the metrics start, even by then, the metrics probably start to deteriorate. But there's always that sweet spot, that balance, where it's not just saying, oh, I'm going to increase the size. No, your metrics are going to deteriorate.
Well, I think that's where you deserve credit, because basically you haven't allowed yourself to get away with it and run away with it. Like, again, you said COVID and 22 to 23 kind of time, great market conditions in the sense of a lot of beta and market moves, and generally people were making money. And we've seen it ourselves in our own trading floor. Sometimes that allows people to believe that they've got this limitless approach to them. They're not really factoring in the the restrictions that the market might give you down the line. So I think your ability to not get too high with the highs is something you deserve credit for. But I think also that is kind of unusual, because you're I don't know, mid-30s, whatever. You're not that new to it, but at the same time, it's not like you've been decades and decades and you've always been like this. So I think there's an element of natural maturity there. But is that something you think you've consciously, is that something that's in your personality to be like, well, look, let's not get too ahead of ourselves. There could be downtime, there could be bad times around the corner type thing?
To some extent. I also, the way that I look at trading is not, it's very, very remote from gambling. So for me, the way I look at trading is, like, I'm not sure if a game is the right word for that. More like there's a business and you're executing your business plan. And in your business plan, what is it? It's your trading strategies. It's the risk framework around that. I don't then all of a sudden go and put on random discretion. I might, if there's a good opportunity, I might put a discretionary trade on with the right risk controls over it. But generally, the work I do is in building the strategies, and then it's fairly easy. I just execute them. So if the parameters of the strategy dictate a certain optimal size, then that's what I trade. Now, it would be amazing to come up with strategies that allow you to put on bigger size, maybe move out a little bit towards the longer end of your horizon that you hold a position for. It would be amazing. But it's also not so easy to do. So you're constantly trying to come up with things that would allow you to do that. So my restriction is not in saying, oh, I restrict myself. It's more that you trade what you've come up with, what you've backtested, what makes sense, and you trade it in the optimal size. Hopefully you come up with something that allows you to make to scale up, maybe another strategy. If you could do that, great, amazing. But if you can't, that doesn't mean that you should say, oh, I really want to make, some big numbers. Let me just push my current strategy beyond the optimal size, hoping that it makes more money, because that doesn't make sense from a business standpoint.
You're seeing yourself as a business. And ultimately, if you were to, why haven't you been as tempted, or have you been tempted to try and join some of these firms, I guess, with huge risk appetite, wanting to see you make 200-300 million? Or has it just been something that
you can do if there is an appropriate strategy? So,
but if someone forced you to look, mate, I just don't care what happens, I want you to try and make that money, you would then say, look, that's gambling.
I think at this stage, maybe at that point I would start thinking, who knows where the creative process takes you. Maybe there would be strategies that would pop into my mind. I don't know what would happen. But as of right now, I'd probably say, yeah, sure, of course I can try, but we're going beyond kind of strategic trading. We're going towards the realm of gambling.
Which doesn't really interest you?
No. I don't view trading that way.
And is that, what I'm trying to get at is that you're saying it's very logical, but you gotta admit, like, there's a lot of people who fall foul to the ego side of things, which you haven't. So what is going on there? Is that something consciously you've been aware of, or?
Yes, I mean, to be honest, I'll give you an example. When I started off, I wasn't like this. When I started off, probably during my time at JP Morgan, I was constantly falling to, look, a simple thing would be you're getting hit or lifted in something, and then you run that position because you're hoping it goes in your favor. Without any rationale, without any real reason, you don't take a step back to think, okay, but do we actually want that position? What is your actual kind of view? Is the trade that you've just been lifted in something, do you want to be short there or not? Do you want to be short in general? Do you want to be short at that price over a short time horizon? None of that thinking would be there. It would just be, oh, I got lifted, let's try and buy it back a little bit lower. And then, of course, it proceeds to go above, and you're sat there thinking, well, this market making is not for me. I hate it. I'm an amazing trader, but the market making is terrible. Whereas, in fact, you're a terrible trader, right? You're just.
But in that example, though, if we was take it now, and someone was like, "Look, I just need you to fill me in something like 5,000 lots, something big," and you didn't want to sell, but you needed to show an offer, you would still take a positive expected value approach to that, right?
No, now it's different. Now I will show you, like, okay, but probably 5 years later, 5 to 6 years later after that. No, I will show you a price on whatever you want, and it will be the right, in my mind, the right price. So there will always be a correct price for your volume. It might not be the price you like, but it's a price that I like and I'm comfortable with.
Yeah, but that's interesting, isn't it? Because, like you're saying, do I want this risk? Essentially, no. But is there a price that actually this gets into realms of is acceptable?
Yes.
But then if you lose money on that, what do you are you thinking? If I get left on this, these are my outs, these are my hedges, this is my potential drawdown.
Exactly. So you transact at a price that there has to be a reason why you think that's a valid price. It's not just that you take a price out of the sky. So you must think, okay, if I can't get it, I mean, if it's a huge deal, you're not going to be able to get out straight away. You must believe that if you warehouse that deal, there's a way that you can hedge that in some proxy way until an offsetting risk presents itself that you can de-risk.
But in a scenario where you're quite keen to be long, let's just say, and you're forced to be short quite a bit of size, is there just a scenario where you say, look, I just don't want to do it? And that is the ultimate fail-safe.
So for me right now, yeah, of course, all the time.
Yeah.
Back then,
no.
Not really.
Okay.
Because when you have clients rather than counterparties, you do have an obligation to provide a price.
But then what about the obligation you have to your business, which is I want to be the guy people go to so I can get those trades. Sometimes it might not work out, but I want someone to make the call.
So the obligation to your business is to be long-term profitable for the business. being the guy that people come to is part of long-term profitability, but if it comes at the expense of you pissing away money here and there and not being able to recover it meaningfully in any way, then I think you are not working in favor of your business. So you have to be a little bit thoughtful here. Everyone will, at any point in time, there's 10 guys lined up willing to trade something super tight just to get the deal. That's not really what this is about, right? If you have a process how you're able to quote, tight prices, that's separate. But a lot of the time you will have people who will come in and they just want to get the deal done. Okay, great. How long are you going to be able to do that, right? So I've done this for a little bit, and I've seen people come and go, and the process repeats itself. So you need to think long term. You need to be long term profitable. If you are in the realm of liquidity provision, you need to probably be a type of counterparty that is long term reliable for either sizable liquidity or liquidity when things are difficult. Because when times are easy, again, there's going to be a lot of people prepared to offer liquidity. When times get tough, that's not the case. That's where you can provide value to the market by showing thoughtful prices and right prices. That's how I would think about it.
Makes a lot of sense. So what do you think, getting on like the lessons learned, when you have a particularly hard time, do you find enjoyment in basically reflecting and saying, okay, there's something for me to calibrate, or do you allow kind of do you ever get into that fear thinking of like, is this all never going to work again? Or is there an underlying confidence that you'll find something always? Or do you ever struggle with these kind of things?
Always.
Okay.
Like, I'm not a fan of this like fashionable, I love being challenged. I hate being challenged. What am I, a masochist? No. Like, I want life to be easy. Okay. So yes, it's always hard as we mentioned before, when you are in that tricky period where you're either drawing or you've not been making money for a while, and you're thinking, what does that mean? Does that mean my system is wrong, or does that mean we're still within the acceptable parameters? That can become quite tough, because you always have these thoughts. Okay, well, that's it then. This is finished. But you have to. If you need to take a step back, whether that means take a few days off or just go on holiday to clear your mind, come back, maybe look at things from fresh, do that. If you need to stop trading, go read a book, go just do something that maybe shifts your perspective, go do that. But there has to be a way for you to maybe like find inspiration to find a way out.
But you have an underlying confidence that in bleak uncertainty there will be something that reveals itself at some point.
I think confidence comes from doing something over and over. So luckily, I'm happy that I've been able to do it every year for a number of years. Maybe next year, maybe in 5 years, I won't be able to do that anymore. But for now, I've done it a number of years, 7, 10 years, and so far it has worked.
But if you wanted an easy life, you could have done easier things.
No, but this is an easy thing. This is a very, you mean other jobs?
Well, you said I don't like to be challenged, whatever, but you've taken, like, the Dubai curve is horrible. Like,
yes.
No one ever wanted to trade that. Like, being a crude market maker, which has obviously always been my thing, you just like, that market is shit. Like, why would you want that challenge? But you took it on, right?
True. I think the reasoning there was because everything else was already taken. And I'm like, okay, I want to trade.
But you got to go on gasoline and things like that.
Yeah, but then there were guys already in line.
Okay.
And I was like, I want to trade something on my own.
Okay.
The only thing is, Dubai was never even a separate desk.
Yeah.
So I went and said, okay, this little curve, split it for me. I'm going to trade it.
Yeah.
Okay, that's interesting, but that's it's not really a challenge when you have nothing and you're starting from zero.
But I think what you're saying, aren't you, is that if you're talking about your values, you do value independence then quite highly.
Yes.
Yeah. So that supersedes you want to have an easy life, right?
Yes. My best time, again, and for instance, if I compare my time at a bank versus at a proprietary trading company, it's like night and day. At a bank, you are part of a team. There's structures. You have to deal with salespeople, with your MD, with your immediate boss, with different other traders, and you have to do stuff. Whereas in a prop trading company, you don't.
No.
They give you that leeway to breathe and to find your niche.
Yeah, I don't know. I mean, again, I think there's things that sometimes work against, and obviously everyone has this, like you want this, but then that, and you kind of have to compromise to the position where you're comfortable with what you have.
Sure.
Because I would say, from what you're saying, you're independent and you want to be left alone, and to some degree that's true, but you've always trained traders. You've probably got one of the best training records, and you must have some enjoyment from that.
Yeah, that doesn't bother me though, because if I had to, what would bother me is if I was, so I'll give you an example. In the however many years I've been here, since 22, like over 3 years, you've never once come to me and said, oh, what's this risk on the book you got? Neither you nor Omar. I do what I do. No one's ever even asked me a question. Right? That approach. Now, again, you must have your reasons for that. There must be some kind of reason for that. But that's more what I'm talking about. I'm not against, training people or collaborating, sharing knowledge. That's slightly different. It's more about I am responsible for my own performance, and I like that to be the case.
Well, I guess I was just trying to take it. There's another part of this, which is, I think you do like to be part of a team as well, right? And you do like to train, and there's something in your career you've valued as well.
Yes, but I like to be responsible for my own performance.
Yeah.
That's the thing. I don't like to be in a situation where my performance also depends on someone else in part.
And in turn, that means, of course, you believe in the meritocracy angle, right? I mean, there's probably infuriating for people like yourself, of which I don't think there's that many on a percentage basis, but who then get treated like they're in some pool. It's like, you get the benefits of being independent as well as the downsides. So when you suddenly change that and say, oh, we're going to rope you in with this collective thing, it's like, but then that's not how that's not the deal I signed up to. And I imagine that's something that has been important here and probably your previous place as well, and then maybe other places couldn't offer, and it's something we maybe need to. I mean, certainly I love working with those people, and it's just, I'm kind of talking out loud because I want to protect that mindset, because the alternative is you get born into a franchise and you have to really believe in the franchise first and whatever else, but you're kind of taking handouts.
No, but there are some areas of the business that do require a team approach, right? So that's a little bit different. But you also, if you're going to be going into that area, you need to almost have the mindset where you're happy with that, right? Like obviously if you take like a very introverted kind of secluded person, you drop them in there, that might be a bit problematic.
Yeah.
But it depends. Like for a trader, you could do fine on your own, unless again you're in such an operation that really requires a multiple, many people on the team to be able to push the operation forward. So it really depends what kind of business you're in.
I think moving now to more specifics in oil trading, I guess something that I think you must have mentioned to me before in the past is we've been part of this evolution of the market moving from a very physical dominated mentality to more flow driven financial, and that only seems to be going one way, and it's pivoted from us being kind of bit part players to very much in the mix of what's driving prices. But I guess because you've gone from that journey, you did need to, and I guess you still respect the physical pricing and what people are capable of doing, but you've never had the physical. So that is a weird dichotomy, isn't it? So how would you explain why that's been comfortable? I think that's surprising to people, by the way. How can you guys be proprietary trading, especially in the spot market of Dubai crude? Like, there's so much going on there that requires inside information, flow information that, well, people would think that, but clearly you've been able to get information more second, even third hand, and still been able to filter it into your derivative trading strategy and make it work, which I think is surprising to people.
I think it's almost like there's different games being played. So what players who have access to physical, the game they play is wildly different from what you would do as a derivatives only player, right? So if you have access to physical, that access, your ability to market barrels and to buy and sell barrels, gives you information. It gives you real information on supply demand for any given cycle, not just supply demand balances. Okay, it gives you real information. It allows you to take paper positions that you can then, you leverage your physical capabilities to, to make something work. Okay, that's something that we can't do. And that's not really a game that a derivatives only place can ever play. Sure, you can put different pieces of the puzzle together and you can figure out, okay, most likely this is what is going on, so we can position it. You can do that, yes. But again, your ability to manage that will be limited because most of those things tend to happen, for instance, as we know, in some of the very prompt contracts. And the liquidity there, if you look at BAML, is not going to be, if you're wrong, unlike a physical shop, you won't be able to get out. So you need to be careful about the risk reward there. That, however, you have the whole rest of the curve, which is, yes, when it becomes prompt, becomes set by physical, but there's a lot of time until then. And so that's where I have personally focused my efforts, right? So there's a niche kind of medium-term horizon where there isn't that much competition. Well, people express views there, but there's not that much competition in the sense of somebody doing a trade does not prevent me from doing that trade. Whereas if you're trading the front, it does.
So you're almost trying to take the benefits of what physical pricing can do to the derivative market whilst not being too invested in it and herd trading it, whilst also doing exactly the same with the derivative market.
Or sometimes, the other parts of the curve can be disconnected from physical, and they can be driven by their own
But that's what
factors.
I'm saying, trying to take the best of both worlds.
Yes, you try.
Right?
I mean, really, you try and take whatever comes your way, but you try to be mindful of where your real edge is.
So how much do you think about the actual players that you're trading against? Do you worry about their psychology, think about their psychology, or you try and stay away from that?
Back in the day, so probably 2018 until probably 2024, that used to be quite important. The reason is simply to understand, so look, even, let's say I trade quite systematically now, so I barely even day trade. Back then it was different because even if you were a systematic trader, first of all, liquidity wasn't so granular that you could meaningfully test strategies against, or let's say you get a signal, does it mean you can get in at that price or not? So back then you had to work intraday quite significantly to be able to just get in and out of positions. And if you are going to trade intraday, you have to understand who is doing what to get a good picture of the different liquidity pockets. If you are a buyer, what do? Do you go and start lifting offers? Well, then you're going to push the market away, by 20 cents by the time you're done. But you might know that there's a particular counterparty that comes in the afternoon to do a hedge. And you're going to wait until they do, and when they do, you're going to trade with them at value. And that way, you're going to execute into the position that you want, that you had a signal on, I don't know, in the morning. That's why it was very important. Now, the dynamic of the market has changed to the extent, well, there's a lot more going on the screen. You still need, in a healthy market, to be clued up and to be aware of what's going on OTC, because more often than not, people execute large orders OTC, right? So you still need to know that. But I think it's much less so now.
Well, that was my next question. So yeah, Dubai is overnight almost, seemingly. Sometimes you think like it's very screen driven, but you still have a broker market, you still have OTC trading. And a lot of these guys are playing the screen versus the OTC, and there's always that element to it. So the next couple years, not even that far out, is it going to, well, how do you see it playing out, the dynamics?
I think probably, look, the trend, it's an interesting question. So a little while ago, we probably always thought that everything would eventually go to the screen, much like Brent futures did back in the day when they moved from the floor to the electronic trading. But electronic trading also has some downsides. When you start, electronic trading makes the market a lot faster and more volatile, and we've seen that. You know, if you have people making markets in an algorithmic way, if you have a lot of high-frequency traders, for instance, making markets on the screen, any move can get augmented, and moves in one direction or another can cascade without a whole lot of trading happening in between.
And make you think something's going on. And
It might make you think whatever, but the market, without much going on, the market can gap around a lot. You know, you have our own version of, the flash crash or something like this, and that now happens fairly frequently. At some point, and I mean, you have this probably if you look at, I don't know, equities, right, which were electronic for a while. You do have things like the emergence of, or increasing popularization of dark pools, where people are like, well, hang on a second, I want to get a big block done, so I'm going to go into this dark pool, and I'm going to try to get it done quietly, if possible. I don't know whether at some point people will get tired of the increasing volatility, and they might say, well, okay, that's fine for small size or whatever, but if we want to actually execute big size with reducing the footprint, or actually, with getting a meaningful price, maybe you'll see a move back to some sort of hybrid model where some of the bigger tickets are executed still direct or through.
But I think that is still. I mean, we were hiring a trader in the US who all his trading is block futures. There's still a big enough OTC market.
While there is a screen?
It's the Brent futures, it's RBOB and all that.
Right.
And it's exactly what you're saying. It's like, rather than be part of that noise, I'm going to get a reliable person you could be roundabout there and no footprint. And you can see the value in that, but you need to then know you can rely on that person, and I guess they make their own assumptions of that.
Yeah.
But I see your logic, and so I think that's, maybe something not to be afraid of, in the sense like there is a liquidity dynamic even from broker perspective that will probably retain for quite some time.
Yes, and I mean, in any case, you do need to, you can't really see the future, but you can only take it as it comes, and you have to adapt to that. So if the market is becoming more, faster, maybe you need to slow down.
Yeah.
Right? You need to slow down your own decision making, and rather than taking data at such granular levels, maybe you just look at the market on a day-to-day basis. There's many things that you can try to counteract that.
And as you get towards, the kind of middle of your career, if you like, do you see yourself doing this for a lot longer, or are you getting a bit tired of certain things, or how do you see it playing out?
As long as I can retain some sort of edge, I think I enjoy the job, and I enjoy trading as an activity. I think when the time comes that I can no longer figure it out, well, then that's a different conversation.
But, you talked about this concept of having a business and not wanting to gamble, and then you got a family now, right? So it must. Well, actually, how did that evolve your thinking? I guess probably pushed you even more into the sustainability side of business in trading.
Not really. In fact, the interesting thing is my breakout year was probably the year my son was born. Almost, immediately after that, whatever you call that. But I don't think about that, because that can probably add a lot of pressure.
Okay.
And I think the job's too, it has its own stresses. You don't need to put more on
Easier
yourself.
said than done, though, no?
Yes, but you just kind of have to have this laissez-faire attitude where, look, you try to come up, you do the best you can to come up with ways to make money, to come up with edges, to come up with strategies. There's not much more you can do beyond that, so don't kind of stress yourself out. Because the more you do, the more you'll be tempted to start gambling.
Yeah.
And that's definitely not what you want to do. So.
And obviously you don't need to name names or anything like that, but as in, you've seen that, right? You've seen the extremes of these things. On the one hand, you can get into a gambler mindset without even realizing it. I guess you've seen people do that.
Well, I've done that myself at the start,
yeah.
when I didn't have any strategy, when I didn't have any systems or processes.
And what's the polar opposite to that for people trying to get good at trading or whatever? Is an element of like, but you do need to want to take risk? I mean, are there people where you've seen you'll just never quite be the
So
traders?
so there's a difference between gambling and taking risks. So in my understanding, the way I see it is gambling is you're just betting without any kind of edge whatsoever. Whereas taking risk in trading, there's the old phrase of like stacking probabilities.
Well, that's James King.
Yeah, James King, right? Stacking probabilities in your favor. Like that's what you're trying to do. And when you have done the preparation and the work that's necessary, you can go big. You can go, if you've built a strategy with a great expectancy, good win-loss. When you win more than what you lose. I mean, when you have good metrics, by all means, maximize that strategy as much as possible. But that doesn't mean you just go, okay, I need to make money. Let me go and buy some flat price. Like that, I mean, that's not really.
But someone who's struggling to get their way in, and is there an element of maybe it's just not suited to you because you can't handle the whims of trading?
I think if you are struggling, are you talking about like emotionally, psychologically
Well, I just
struggling?
mean you've seen a lot of grads, you've seen a lot of people who probably are trader level, but they struggle. And
it depends on what they struggle with. So if they're struggling to find an edge, like the cure is to keep trying to do it. If you're struggling with, like you don't like taking risk, for example, usually, and you're stressed out by it or you feel anxious, usually, from my experience, the problem of that kind of anxiety comes from indecisiveness, so not knowing how to make the decision. So if you're sit there and you're thinking, okay, do I buy, do I sell? That's a problem. So to address that, you need to systematize how you make the decision to trade or not to trade, and if to trade, what to trade. And the only way how you can do that is you come up with some sort of methodology which is going to be consistent over many iterations, different market moves. It's going to, if the same set of conditions apply, you always make the same decision, right? So if you have a system, a process, which helps you make that decision, you almost eliminate any need to make decisions on a discretionary basis, right? So that will take away that stress, right? So when you follow a strategy, you don't stress out. You can lose money, but you then take a look at the backtest and you're like, okay, that's within the anticipated range of possibilities. So you don't stress out. You are going to stress out if all of a sudden you're taken outside the realm of what you thought. But then that becomes an operational question. You're like, okay, well, why is that happening? Is there a mistake? Is there a fault with the backtest? Then it becomes a question of, okay, let's work through this. But the most stressful bit is where you don't even have a process.
Yeah. You're trying to fight against.
You're just trying to, okay, let me read around, let me build a view. And then you're like, you come up with this amazing view in your mind that makes sense, and you put a trade on and the level looks great, and then it goes in your face. And you're like, okay, well, now what? The trade makes sense, my rationale. So am I wrong? Is there something I don't know? That becomes difficult to unravel, and that creates a lot of stress.
So I guess does that lead to what your main advice would be then, is try and find a system?
Yeah, and a system doesn't mean that you have to be like a very kind of quantitative. I mean, look, I can't program in Python. I don't know, but a system simply means that you have rules which dictate how to interpret whatever data input you're putting into that process, and it spits out a decision. Trade or no trade? If trade, what do? Do you buy or sell? Then you have a system on your risk management which tells you how to size the position. Imagine if you do those two things, then there's nothing left for you to decide.
So don't make it overly complicated beyond that, right?
Exactly. I mean, yeah, you can take it as complicated as you can, but usually you need to have some sort of decision-making process.
Fakhri, thank you. That was great.
You're welcome. Thank you very much.
it's, you know, the guys I think we have, they want to work together.
Yeah.
And I just obsess about that, because I think otherwise it's going to come out in the wash eventually when someone's selfish. And like you said, like last year we had someone leave who was particularly like that. And it's never going to work with that kind of person around. You can't really work together with that kind of person in the long run. So working with people who you want to work with, biggest bit of advice I'd give to anyone starting a business. So I thought we would refresh our conversation that we had, it's actually 2 years ago, that we actually properly talked about the firm, what we're trying to do, and I guess, the developments of this year in particular. So I guess the leading thing to start with is like, what are the latest things that we've done? So the big developments, I guess.
I think the setting up of Axis.
Setting up a new market making division
Yeah.
under the Capital Group. Consolidating like our services under one brand, Flux.
Yep.
So now we've got that like super clear. Onyx Capital Group is a trading business with market making businesses, 2 businesses across 4 different locations, Dubai, London, Singapore, Zug, and then soon to be New York.
Yep.
And then we've got obviously the service business in Flux that's got the retail offering and this kind of stuff. But I guess starting from the top then, like.
And we've also grown into the power and gas market quite a bit, which is quite a new
No, exactly. But I guess
business for us.
To refresh, people wanting to know what's going on from our point of view and what we're doing. Again, it always starts with liquidity, right? Liquidity providing, that's what we do. That's what we've done for almost 13 years now. So this has been an extension of trying to basically be as big as we can in that space.
Yeah.
So I guess this year, like we don't mind being transparent about it. You know, Axis was about taking traders from competitors, building it so that rather than compete with us in the external market, they're competing within our own brand. And on the back of that, we have a more market share, and we're kind of moving more towards that kind of dominant position, which is obviously great for a business.
Yeah.
You see it the same way, right?
But I think, so we've grown our market share significantly by bolting on Axis. And it's nice to have, 2 different setups where they kind of have their own trading views, they're very diverse. We've seen times where, even recently, where, our gasoline book could lose money, but the other gasoline book is making money. So it's not like we are trading the same positions. And again, it's good when the market's going in the right way, when both parties catch that move as well. So it diversifies our risk and exposure.
To emphasize that, like last year in 24, that the opposite happened, right? We had a lot more traders coming in, different backgrounds, and we brought them into the same team. So we're having in this room, trader conversations, and they're actually, what happened was groupthink, right? And we were getting stuck in positions that were too correlated.
Yeah, and every desk had kind of the same position. When gasoline was coming off, the whole, fuel oil, relative value, every book was long. Whereas when it was rallying, every book was short. So
that's the important distinction with Axis, right? We keep it separate.
Proper Chinese
walls. They do their own thinking, their own management, and everything's different. So in effect, it really is a competitor.
It is a competitor.
And then you get the benefit from that. So for anyone wondering, that's why, right?
Yeah.
Because trading can be quite damaging in the sense of, Alf used to call it portfolio heat, right? When too many people have the same reflections, but put in slightly different ways, that can be very damaging.
And I also think, in terms of increasing your market share as a sole desk, when you go to the 30 to 35% level, it kind of saturates. If you go anything above that, you're almost taking the opposite side of the market, which which I've done sometimes, which previous employees have done, and then you end up with a position where you can't really get out of because you're giving the whole market the position, and you're the only one with the opposite position. So there's no outs. So the only way to get out is, you stop out when they're taking profit, if at all, right?
It's a really good point. Becoming that shift from a decent player with decent size to a dominant position from a volume perspective, doing so much of the liquidity providing, as we call it. We've had these new challenges we wouldn't have expected.
Yeah.
So I guess what counters that then? If the overall market continues to grow with it, right? Then the capacity overall grows.
Yeah, I think the overall capacity grows. But again, I think the market has also changed significantly to the point where it's kind of over market made now. So, when we were trading propane back in the day, we were one of the pioneers, and you'd always trade with real interest. Whereas now in almost every market, there's 3 to 6 or maybe 3 to 7 people trying to market make. And it's okay in certain markets like fuel oil where it's very big and the volumes are humongous. But in certain markets that are illiquid, you end up just, you're just making two ways. You're trading with each other, and then real participants don't take part. And when real participants want to do something, they can't get it done as well. So sometimes, liquidity is, when there's too many market makers, that's not in the best interest of the market as well.
Yeah,
so you need a dominant
outside of what we do, like the options market making space, right? So generally speaking, options market makers need to be short volatility, like they need to sell all the options to the world to get on their bets, their insurance and all this kind of stuff. So like the Iran situation this year taught us, right? There was a massive spike when the tensions were peaking. And we heard, all the options traders lost a hell of a lot of money because they can't not be short. That's how they provide the liquidity.
Yeah.
But as you say, when it's like too many people doing that, then what do they do when the volatility
Yeah, it's
spikes?
a crowded trade and
Crowded
it's
trade,
oversaturated. And again, to add on options as well, that's something new we've done this year, hiring Humayun, who's been a great addition to the team as well.
Yeah, it's trying to, I guess, so increasing the volume of the trades that we do, I guess, is what we would consider market share and going up to about, 30% of all markets.
Yeah, I think 30% is kind of the ideal point, because when you try and force it above that, you kind of end up in an awkward situation. So sometimes you want to sit back. I think that's what I've learned as well is, there's days where you can be 40, 50% of the market. Sometimes everything lines up and everything's perfect and you can just trade everything. But when it's kind of one way, you don't want to be that one person giving all the liquidity because you're just going to get run over, right? Yeah. So I think 30% is kind of the sweet spot as an individual desk. But yeah, with the addition of Axis, we've kind of built that quite nicely to that level.
Well, it's getting to like 80+% on some niche contracts, data breaks, CFDs, things like that.
Yeah.
But the next piece was, okay, it's all well and good having a lot of volume. How is it working as a unit? And that's something I think has been some evolutions this year. I'm really excited about. So if we talk about New York, right, we've got Billy coming, who is a big distillate and crude trader, but much more on the futures, the block futures. And it's such a core component that, we do, but we're not as dominant in. So him bringing that in creates a kind of a slot in. And so that 1 + 1, Billy plus us doesn't equal 2, equals 3, right? And I'm really excited about that because it's basically, it's the information, it's the centralization, it's the internalization concept you can get, which I think is the next thing. And we talk a bit about that, but then I guess the thing after that is to remember like what you're talking about, having liquidity constraints with your own trading, getting to a certain size. We've got to remember that that's because we are operating at the very, very forefront of the market. Like we don't get we haven't until now been getting the kind of flow that the banks get, that the, basically all these models that provide access get. So by us bringing in this Flux model of, Flux markets, giving credit, giving clearing, giving access to retail traders to our market, that is flow that's additional, that wasn't there before. It really helps our game. So that's what I'm trying to say is build really strong liquidity, start to figure out how it works together as a unit and bolt on additional flow. And that's what we're going for.
You need additional flow. You want different flow, right? You don't want the existing flow in the market. As in the flow in the market is good, but all these avenues open up people who haven't even thought of hedging or people who haven't even, had access to these markets. And, retail clients, we have quite a handful, and they're actually starting to make a decent impact now in terms of what we do. So I think that's a great addition to the team, and I think it's going to grow and grow and grow. And there's so many untapped markets like Jakarta, Thailand. There's Far East Asia. There's so many people who don't have access to these markets. And again, as you said, everything that comes from these sources will eventually go back to the market, right?
Yeah.
It'll go back to the exchanges, to brokers, to traders, and it just makes the liquidity healthier for the entire market as well.
I think another thing we probably should acknowledge is we have kept the model very tight in previous years, but you get to a certain size position in the market that it's very difficult to operate without being able to handle directional trading.
Yeah.
And I think it's something we've developed over time, and let's be honest, has some pretty shocking periods as well as we've kind of calibrated and navigated these markets. In particular, this has been a very tough year, but last year's second half was very tough as well. But we've learned a lot on that side as well, right? Like we've got Ligier in Singapore, who's pretty much running like a mini fund now, right? He's got like 4 or
his
5
global
guys.
macro book, which trades cryptos and a whole bunch of different things.
But it speaks to, again, trying to not just build something that maybe makes money, it's build something that has benefit to the overall business. So I think Ligier has always been very passionate about directional trading. We did an Inside the Minds episode with him, getting into the grips with like how he's evolved over the last 10 years. And it's very complementary how he looks at markets to what we're doing. He can give you that macro aspect. Like you don't feel like you're missing things, right? A big stock market move, a big macro shift. The trick though is really becoming proper like portfolio managers. I think that's been a challenge for me and you, right?
Yeah.
Because we're still quite active trying to figure things out on the ground, but then you have 2 huge portfolios in Onyx Commodities and Axis, and then within them you've got very different trading styles. We used to just be like just curve strip, market make, whatever, like, and kind of boost that a little bit, but now it's gotten so complex that it's just the challenges I'm trying to get at. Like
I think it's been a great experience. I think since our propane blowout in
24.
He's
come up with some names for these. The
Yeah.
propane blowout.
Was that Feb or March?
Yeah.
We drew down 40 million in a couple of weeks, which is a big learning experience for us, right? We'd never seen a shock in that way, and we've never had to trade a liquid market to get out of something like that as well.
Yeah, exactly.
So,
it's not like you can just go, okay, fine, call someone up and get out. This is something you have to manage.
That was kind of sleepless months almost. I think when the markets have evolved, when the markets were good and directional, it would have been a lot easier to manage these positions. Whereas this year has been a cluster of news, right? From tariffs to Trump announcing different things every time, Iran, Russia. There's so many macro drivers.
And then mechanisms breaking down, right? Physical traders pushing one thing up versus the other that gets everything out of historical norms. Like it feels like a big shit
recently
show.
as well, propane. The classic trade was to price CP long, be long FEI spreads, and the Saudis printed quite high, and there's a big shock of this. CP was printed $50 lower. And that caught the whole market because everything was already historically quite cheap. So again, a lot of these markets are changing fundamentally how people trade it. So the whole easy trades aren't there anymore. It's still there in certain markets, but you have to be, risk management is very important as well, I think, in these markets when there's so much uncertainty, when you're at extreme levels on trades. If you look at our cracks at the moment on gasoline, they're at historical winter highs. Again, whether you want to be long it or short it, you've got to be, again, it's stops and risk management, and that's something we've kind of lacked, or I
was going to say, like, we can't say we're like being geniuses in risk management, but I think we, as you say, that any time you have a failure and you learn from it, that gives you a positive expected value over time. But to just very easily say, but your risk management is flawed because you had drawdowns, that's also oversimplifying it, right? Like you have to look at the lay of the land, what you're trying to do. And one thing that does frustrate me with us versus our competitors and others is, we might have gyrations in our P&L and like what we're trying to do, and bad times, good times, whatever, but we have a plan. So as in, like, if we are going to be directionally short gasoline, we're going to have a macro thesis, we're going to deploy it. It's our prerogative, right? And at the end of the day, like, we're not trying to be a steady 8% a year growth business that we can IPO and go, cheers, like, isn't it so safe? It's our money. And at the end of the day, we do have a plan. We want to be the traders, be on the front foot, switch from a passive trader to very much on the front foot, providing liquidity, but providing the messaging to the market, providing like, very strong stance on how it's going. And that is very, very difficult, especially in a market like this is, like it's been. So yeah, the learning, what I'm trying to say is, if we don't learn, that's the bad thing.
But I think from all the experiences, we've had great experiences and we've had a few not so great experiences. So it's kind of learning when you're doing well as well. Could you have done things better? Could you have run things longer? Could you have
and you get people
scaled
say, well,
up?
Why didn't you think about this? Why didn't you think about that? There's a lot of hindsight. It's been very interesting to get third parties in to critique your trading. And what do people do when you're losing money? Why are you losing money? Or that's losing money, and they emphasize you're losing money. It's like, but it's not really about after the fact, isn't it? What are you going to do? What is really going on under the hood? And then there's these theories about, yeah, but are you guys trading to counterflow? Are you doing this? Are you doing that? It's like, look, you try and build this liquidity model and build it to what we have. It's a beast to manage, and that's what we're trying to calibrate right now, basically.
Yeah, and I think we've had a decent year this year, but again, it could have been better. It could have been a lot worse. When in end of Q1, usually Q1s are stellar quarter, and with Trump and all the news that happened, mid Q1, we were down quite a bit as a firm, and then we did really well to recover. So I think we cut the risk, managed it, and then when the market was turning, we added on the risk. And again, we've had a bit of a lull where, again, the propane move and the gasoline move, it's caught us a little bit. But again, it's how you recover and what learnings have you taken from it. And I think all our traders we have now are pretty good traders as well, right? Okay, whether they've made money or drawn down, they're pretty disciplined, they're very
I think
communicative.
it's an exceptional team. Like if I compare it year on year, I was moments last year very frustrated because I didn't see the method in some of the approaches. But this year you can't say that
But I think we have a strong trading team.
But it's also the network, right? Like again, it's all well and good saying, I'm just going to start a firm, hire a bunch of good traders. And that was basically the model when we started and other traders, other competitors. But now it's like, what are you doing about the back end of the curve?
Yeah.
What are you doing about the front? What are you doing about, increasingly digital trading? And that I'm incredibly proud of what we, but the results won't show it this year.
Yeah.
I think this is a future thing
Yeah.
as Axis builds out and all that kind of stuff.
Yeah, I think this year has been a lot of investing in people, hiring people. We spent the latter part of last year and the first half of this year, going through all our legal disputes and, hiring a great exceptional team. And even when they started out in Dubai, the first couple of months was quite tough for them, right? Because they have been out of the market for 18 months. Things have changed. As I said, there's 10 market makers now quoting 2 ways down the curve. And, the last 2 months, these guys have done exceptionally well and kind of found their own niche and found their own way of trading. So yeah, I think, we've invested, again, it's key investing in the right people, right? We spent so much time and effort hiring these people for a reason, and we knew, okay, it's not going to be easy from day one. And like, as you said, it's an investment and it's already starting to, yield its rewards 3-4 months in, and it's just going to get better and better and better, I think, as time goes.
And I think the rewards from taking your licks and learning from last year and certain things, and I think I've got to commend the team and their developing as humans as well, right? We're all personally developing, and I am seeing that with the pretty much the whole trading floor. That they're very keen to personally develop. Which, to be honest with you, there were some people last year I didn't think that was true. I think they kind of felt like they were the finished article, and there was bigger and grander things to do. I think here it's a great compliment to have people come in and go, I can't believe how much nicer it is. There's no politics. We're just cracking on, and I get left alone, but can still interact. It's all these nice things. I think we're starting to get that. The calibration of the culture, if you like, really, really kind of quite nice. So that's the big win out of this.
Yeah.
But on the flip side, the challenge is, if the markets conditions have been hard for us, they've been hard for other people. The CEOs of the trade houses recently came out and said it's been really, really tough and hard to predict. But the margins have got higher, and I've made no secret about the costs being extortionate in this market. That also squeezes trading margins, and I think that
we pay 100 million plus in costs, trading costs a year, which is
makes us
ridiculous.
A big customer of the market. But the point is that I would say this year what has changed is it's kind of squeezed out competitors or businesses that actually clearly haven't got a plan for the future, and that's, I wouldn't say I wish bad on them, of course, but as in like it's good from my point of view that the model looks sustainable as we are deploying it, whereas others are starting to die out. They haven't really got a plan. Like you say, you might need to take a bit more risk. You might need to do this and that because the liquidity is harder to provide and whatever. But they don't seem to have a plan, some of these other companies, and they're starting to fall away. That's quite interesting.
Yeah, I think we're very well placed in, a lot of us have been doing this for nearly 10 years. We've hired a good group of people. We've been we've kept a lot of our money back in the business as well, right? So we're well capitalized. And again, a lot of people came into this market in 23 thinking, with the whole Russian market and, with all the Russian headlines and what happened during the war, it was a lot easier to make money. Don't get me wrong. It was probably you know,
A lot of funds came in to chase that money. That's what
yeah,
you're
looking
saying,
back,
yeah.
I think we could have made a lot more now thinking.
If
But
it was now,
if it was
develop-
now,
but there will be another time.
yeah,
right?
it'll happen again. But
Yeah.
at that time, our traders traded exceptionally well. They learned a lot, and all the other entrants, such as the funds and the other new market makers, kind of came in at the wrong, well, not the wrong time, but if at all, they kind of added to the problem as well, right?
I agree with that.
Funds came, and you know, we've had a very whippy crude market this year as well. I think finally we've seen a proper break to the downside, but in general, it's been whippy, and there's been stop outs on all angles. So I think we are well placed. I think our competition is dying. You know, you've seen a lot of people pulling out. So I think we are exceptionally well placed with our technology, with our people, with our training
But why do you
program.
think? Why do you think it is? It's just a lack of. Like, I put it down to a lack of plan. But how do you see it?
Yeah, I think, yeah, you need a plan. You need different iterations, and I feel like we've done over the last 8 years all kinds of iterations, from, you know, being purely market making. You know, when you started, every night I used to get a call from Johnny saying, "Oh, Greg's holding 200 CFDs overnight. You know, can you ask him to reduce it?"
Yeah.
To, you know, us now holding thousands and thousands. Pricing thousands a day. And, you know, again, the whole propane blowout taught us a lot. You know, on gasoline, we've had great times and some not so great times. Last year, this year, we've learned. So I think we've been active on trying different things, experimenting, you know, with all the technology, all the retail, all the direct trading and relationships. We've kind of got everything. The platform is kind of now perfect almost, right? So I think we're well positioned for the rest of the year and next year. And again, if there's going to be an exceptional market move where
We should be well
crude
positioned.
dumps,
Yeah.
you know, to low 50s, or you know, there's some kind of macro event, I think we are so well placed
Yeah.
to maximize that, because, you know, we've learned to be relative value traders, where you can trade when it goes to extremes, and then you've also learned, okay, when it goes to extremes, there could be new extremes
reasons, yeah.
for reasons, and we've kind of got that right and wrong. So I think, you know, looking back, we've kind of been through it all. We've been through easy market conditions to tight market conditions, but we've kind of know when to be active, when not to be active. So I think with our processes and plans in place, I think we are kind of on for a very good ride. And again, having two entities is phenomenal as well, because you almost have two trading houses working under you, which
Yeah.
is great as well.
I think expanding on the future, like obviously, I hope what you're saying is correct, but you know, we can't deny as well that the market is evolving. So we've always tried to stay on top of that, but at the same time, you know, we did come into this with people saying your job won't exist, right? And or same thing people say to brokers,
Yeah.
you know, you won't exist, the market evolves, whatever. If anything, it's been proven the opposite, right? I mean, certainly like the Jane Streets of this world, the Citadels, these guys are like mega businesses as market makers. But that aside, we have to acknowledge that, you know, the technology innovations in markets, tokenization, crypto, etc., like how incredibly sophisticated they're getting. It is finally starting to find its way to energy, albeit still like very, very different markets.
Yeah.
We are obviously trying to manage that transition and be on the top of that, but it has been interesting, isn't it? Like, there doesn't seem to be a way in for these kind of more technologically driven market makers as much as they probably would have thought. We know that they've tried and maybe failed, but they'll still be there, they'll still be knocking, right? But again, it's like, how are you feeling about those next 5 years?
Yeah, it's interesting, because I think if you look at markets like Dubai, I think you or Fakhri were telling me the other day, where like 10 million lots of the front spread traded, and 90% of that was on the screen, right? But I guess Dubai is pretty linked to crude, right? So you can, you know, it's easy for algos to automate and auto-generate markets. Whereas when you look at markets like gasoline, naphtha, you know, if you look at the ice screen now, it's populated with two ways down the curve. I'm not sure who's doing that. But at the same time, it's for 1 KB, or, you know, nothing trades on it. I'd say, you know, 0.001% of daily volumes go through there, if at all. So
Yeah, the screen trading has an element, but it is interesting to see like you say, Dubai's screen is incredibly liquid, but the broker market is still making record volumes. So the OTC is still huge. So
Yeah.
it just helps markets grow, if anything. And we go hiring Billy. Billy's market is futures trading.
Yeah.
But he does block futures with brokers.
Yeah.
Like that's the majority of his market. So it's like, it doesn't seem like they're going to go anywhere. The market will just evolve. It doesn't necessarily mean things stop or start. It's just evolutions, right? But
Yeah.
I think one thing that's been proven is you have to have so much domain knowledge, right? You have to have so much understanding of not just the physical, but the mechanisms of the physical and how it interacts with the benchmark price. And this year has been very hard for people because of the distortion between what's going on in the physical and the benchmark. So imagine that for an algorithm, right? It's just pretty
there's
difficult.
too many niche points, where things work for a while and then it doesn't work, and identifying when it doesn't work is significantly important, and that's where experience or what's happening in the markets. I think the screen helps to grow the market and the volumes, and it gets outside people to look at it. Certain people don't have access to brokers.
But that's what I was trying to lead into Flux, right?
Yeah.
So that's really our thing. So visibility through giving you a platform that has the market numbers, which is straight from our trading floor.
Yeah.
And then our digital trading, we're not just going to throw that out there like to support another platform for the sake of it, right?
Yeah.
But we will do our best to present our liquidity in digital form to our clients, because that benefits us, right? I mean, we can start to show people access, show people visibility to get them more engaged with us, get them more engaged in the market. It doesn't necessarily mean that's going to become a hyper liquid screen. It just means it's an extension of our liquidity out to the market, right?
Yeah, it's like it's the same as someone calling us up and asking for a two-way. It's like direct trading, but having it on a screen just makes so much more sense. And if someone can click a button and trade it, that definitely makes sense. And eventually maybe we partner with some venue, so that we have distribution to the entire market from every single user. But again, the time is not right, or the partners aren't right. So when that comes about, I think it makes sense. But right now it's a good way to market our services, our liquidity, build relationships with clients. And we started it 3-4 years ago. And
what I really like where it is now is the Flux business can be called one business now, and all the things in that business. But really it's like, a bit like say New York and Billy joining in Onyx and fitting together. It's a bit like that with Flux. It's like finally now you can see it on basically a screen and a unified service. You can see how it fits into Onyx. It's the way to get access to everything, all our trading basically, our liquidity, which is directly the liquidity in the market. So that's as simple as a message as I can define it. Like Flux is just giving everyone that access directly to that, not just via a bank, via this, via that. It's like, no, just come to Flux, and whoever you are in the world, institution or tiny person, you'll get direct access. And I think now that people can visibly see that, even internally, people are starting to get it. Like you said, they're like, shit, this retail flow, like that was actually pretty decent. Like this is cool. You can see it growing. You can see how our model is benefiting people, and hopefully that will just grow and grow and grow and evolve the whole business, really.
Yeah.
So I think what's worth touching on as well is like maybe taking a little bit of a backward step, but the competition again and some of the legal issues we've had and recruitment in general. Like you said, like hedge funds have been out there for the last 3 years hiring basically anyone seemingly half decent.
Yeah.
And then you've got the market making talent, which, from our pursuits, we've kind of seen just how tight this market is, right? There are not that many, and we've pretty much got captive share on those market makers, right? But the money spent to get that, the legal cases we had with Dare, and then the general recruitment out there, it's very, very competitive and tight. So what has been your take on that? Bear in mind, obviously, when we left Mandara 10 years ago, and that was kind of how we felt. The world was our oyster a little bit now. Now it's not so much like that. It's like, where are you going to get trained? And these contracts are massively long, and like it's just a very different landscape, isn't it? Like, how do you see that evolving?
I think still the best talent you generate for market making personnel who focus purely on the curve and try to extract value from the curve and position based on what the curve is doing. I still think most of the success we've had comes organically. You hire graduates, you train them, and the only people who've succeeded have been trained under us or the top tier ex-Mandara personnel, right? There were a cohort of 6 to 8 people, and anyone who's done well in the market making industry has trained under those people, whereas people who start their own shops or do different things and try and get into it haven't succeeded in any way or form, right?
It's just become too...
It's too competitive. It's, you know, it's, you need that formula and that structure and to be trained organically, and you need leeway and good management as well, right? You know, we recently, you know, lost someone who left propane last year, and he moved somewhere else, and we said, you know, we have a very good nurtured culture. We will guide you. We are okay. You know, we will manage draw. You know, we all in it together. The infrastructure, and you know, we had this whole long conversation, and this person leaves, and exactly what we told him happens, and then he comes back to us and mentions, you know, he's, as a friend, he's like, yeah, this happened, and I was like, yeah, we told you this was going to happen. So
I guess a lot of employers do that, right? They say, oh, it's never good anywhere else. This is the best. But in our case, I guess we put a lot of thought and work behind.
A lot of thought and work. And again, you know, I think it's important, you know, from this whole legal, you know, disputes we've had, you know, retaining staff, you know, we've lost good staff, we've gained some good staff. It's very rare we hire externally market makers from competitions until recently. And I think having stronger contracts is definitely important, because at the end of the day, what's the point in us training people to go and trade elsewhere? You know, on gasoline now I have, you know, 2 or 3, actually every gasoline trader out there has worked under me. And I'm like, yeah, I've trained, not every gasoline trader, but trader in the market making angle has been one of our juniors. So, you know, why train these people to go and compete with us? You know, you have to be brutal on the contracts, and you know, we've tightened our contracts as well, and you know, it has to be fair as well.
But that's what the legal case taught us. We didn't think these things would hold up.
Yeah.
And then it turns out they do, right? You know, a 1-year non-compete can hold up. And then I think the way we've managed that is to be fair, like you say, and say, look, think of this like a footballer's contract, right? You're here for us for an extended period of time, and you get paid for that. It's not like we're going to say you're out in the ether not getting paid, which is kind of where it was going a little bit with other contracts from competitors. So, you know, stick to a period of time where, you know, we get to invest in you, you get to invest in us, and we go from there. It can't be any other way. And this isn't exactly new, right? This is every company that has a growth trajectory starts to eventually think this way, right?
Yeah, I think even, you know, the trading houses, I think it's quite public. Even Trafigura recently increased their non-competes from
3 to 6,
6 months to a year, or 3 months to 6 months. And again, you know, when we had ex-board members, they always mention you have to be careful. You know, places like, you know, other trading houses are constantly looking for good paper traders, and you guys are training the best. And if you don't have good contracts in place, they're just going to poach your people, which is kind of what happened. But key is
market makers being integrated into trade houses a little bit. That's becoming a bit of a theme, which, you know, 10 years ago they would have laughed, right?
Yeah.
You guys don't know what you're doing, like we're the way to get trained. And now it's like, exactly as you say, the market is becoming more paper driven, financial market driven. They're definitely starting to see how they integrate that. But there's no substitute for, if you are a market maker, you want to be in a market making shop. It's very difficult to be in like a hedge fund, for example, and then suddenly try and make these outsized returns from chopping in and out. And the same thing in a trade house. It's just different models, different mentalities, which leads me to say, you know, you've already mentioned it, but this whole building with people you want to be here and who also want to be here, and getting those right people has been a challenge at times. But I feel now you get a sense, there's a lot of camaraderie, which is, I really, really love that. That's one of my favorite things in life, is to have camaraderie and people you go to war with. And I do feel like we've achieved that. Maybe not finally is the wrong word, but with dips from very big highs, you know, you get to see who people really are. And we've had to let go of people. We've also had people leave us. And it's one of those things where it's very nice to see that what we've got left is people who, you look to your left, look to your right, and they genuinely are here to fight, which I think is the biggest win out of all this. But
yeah, I agree. I think, you know, we've touched wood, we haven't had anyone you know, who's been with us for a while and grown with us as a family ever leave, right? You know, we've let go of a few people mutually or non-mutually, but everyone who's kind of been a part of the journey for more than 3-4 years, are still embedded, and they've still fought for us, and they put their bodies on the line, right? Jasper is a good example, who's taking a bit of time off, and hopefully will be with us in a different role. Maybe not trading, but more, because again, we've given him a lot, he's given us a lot, and it'll be awesome. We continue the journey together.
Agreed. Yeah.
But a lot of these people have put their body on the line and sacrificed a lot for us, and we've sacrificed a lot for them as well. So,
but that's what I mean about coming together when the dust has settled to some extent, or even if it hasn't, and knowing that what people are enjoying is being together. That's a win.
Yeah. So it's a great culture. And you're starting to get a few of the next generation of those people coming through as well now. The likes of Toddies, Albans, kind of the next gen of like loyalists are kind of driving through as well, and it's been a while.
It's very interesting to see that integration of the new generation.
Yeah.
It's never really any different, really. Like they remind me of us when we were like 10 years ago. They all just very hungry, aspiring traders. But again, it's the guys I think we have. They want to work together.
Yeah.
And I just obsess about that, because I think otherwise it's going to come out in the wash eventually when someone's selfish. And like you said, like last year we had someone leave who was particularly like that. And it's never going to work with that kind of person around. You can't really work together with that kind of person in the long run. So working with people who you want to work with, biggest bit of advice I'd give to anyone starting a business.
Yeah, and I think this year has been a great gelling process. And also we've in terms of desks that haven't worked out, right? We had a power and gas Zug desk which didn't work out.
Yeah.
Whereas we have other power and gas desks that are doing well. We had the systematic book which was run by someone else as well, that didn't work out. And you have to make, and we had cross barrel, we had 3 desks that probably lost 10 million each in the last year or two, which is, and we've kind of, you have to eventually stop those,
and treat them like investments, failed investments, whatever. Yeah.
Eventually you have to draw the line. And again, why I feel so good is I feel like now everyone we have has great track records. They haven't had a losing year. Not ever, but generally they haven't had losing years. Steady P&L. So I feel like the team is kind of spot on, and we're constantly looking for new personnel as well. Humayun was a recent addition who's doing quite well. Liege is constantly looking to hire, and Axis has settled in very nicely. And I guess our next one is to see how the US guys settle, right? We have Billy, then we have Scott who trades.
I've been amazed to see the talent out there already. Maybe not surprised, but just really, it's really cool to see how many people are out there when you start opening up your doors. They're like, we've heard about you guys who want to get involved. It's exciting. I can't wait to get stuck.
And I think it'll just open up. There's a lot of people there who want to do EBOB and don't know how to do EBOB, right? It just gives you a gateway into clientele there who might have wanted to do something but didn't do it. I think it's quite exciting. That's kind of our next integration project.
And again, I think probably the final thing would be, we've definitely focused on oil always. And we've ridden these waves of pessimism about the industry, low prices, super high prices, renewables, all that kind of thing. But I think we very much take the stance that oil's going to be around for a long time, and particularly the Eastern markets are starting to develop. They're starting to want access to this market, and that's kind of where we're going with the access model, access model, not axis model. And that's going to be really interesting to see. But having said all that, power and gas is actually pretty much where oil was probably 10, 15 years ago. And that's quite exciting for us too, right? And we will be there. We're just taking it steady, right? There's no point just jumping in and becoming we've got Vinay out there trading some. We have John here, so we've already made in. And the US, right? There's going to be a lot to do, and it will bolt on nicely. And I guess the one thing I want us to keep doing is anytime there's an investment, it's how does it integrate into what we've built, not just another investment that might make money. That's a business of businesses, right, or a fund of funds. I've never really liked that model. It's very it's too siloed. I like the idea of, if we go into power and gas, like we have Stuart out in Zug still, right? He's an excellent gas analyst, and Octavio with him. And that's the right thing to do, is to maintain intelligence, even though you're not too big in power and gas yet, but you want to really understand it as best you can, and you build that way and make sure they're still interacting with the old team. And yes, there's not always going to be synergies, but they've got to feel the concept of what we've built so we can build it steadily in power and gas. I'm excited to do that.
And we've got Akshay as well, who's now recently moved to set up US Power as well, if I'm not mistaken. So I think that's gonna see a lot of growth in the next year to 2 years, because oil we've kind of grown and not saturated, but we're pretty good at what we do. And now we have access, so are pretty good at what they do. So they have a bit more growth and they have a few more gaps to fill. Again, we help them with it, but they're a independent entity, but we of course help with hiring and management and strategy as well if they need it. But apart from that, I think for the company, the big push going forward is into the US power, gas, carbon, that whole space. Certain parts of it is about 20 years before oil as well. So I think that can be very interesting in terms of opportunities. Because again, when we started oil 10, 15 years ago, there weren't many players doing what we were doing. The market was so inefficient. And if you look back 25 years ago when Alf and all the bank traders were doing it, it was, even less efficient, right? So if you can find some of these markets to get into, the opportunities are...
Ride that development wave.
Yeah, abundant, right?
Yeah. Cool. Well, thanks, Omar. We'll be back to do this again, I'm sure, in the next year or something like that.
All right. Thank you.
Hi, welcome back to another episode of Trading Corner. So we're just going to touch upon the market, see where we've moved from last week. Seems like, 5 trading days feel like a month recently.
It's definitely felt that way, yes.
Yeah.
Especially coming into the changeover of the month and all of the physical interests changing and what's been going on with Russia. It's been
tiring to say the least.
exhausting.
Okay, so let's start with Brent, I guess. Last time we spoke, we'd had a lot of short covering, although I think we were suggesting that perhaps not people hadn't 100% covered, given the sanction news that was coming out, a $4 rally in Brent flat price wasn't that aggressive. Since then we've softened quite a lot. Interestingly, on the whole curve as well, typically when you hear news like this, what you'd expect is perhaps the back of the curve to normalize a little bit, because it very much is a supply shock in the prompt. But actually all the spreads have given way a little bit. So it's been quite interesting. I think the market still is fairly confused.
Very confused. I was going to say, prior to the Russian news and prior to even our conversation last week, we moved from proper contango on crude spreads to proper backwardation. And now we've kind of settled, the prompt's still a bit backward, but on the future side certainly. And the rest of the curve it's super flat.
Super flat. It's quite interesting. You're totally right. Like before the sanction news came out, there was aggressive, sell side flow. Even the front spread was threatening to hit around flat at one point. And since we bounced back, I think the markets found it hard to believe that the sanction is going to be a long term or even medium term issue. I mean, the way the market's behaving at the very least, you would think that we're pretty good on oil around and there's no real shortage.
I think so, and I mean you're seeing that with the amount of oil that's on the water, which is significant, which is keeping a proper bid on freight. But let's just step back to what we talked about last week with India being the swing barrel, right? Because the rhetoric out of India has been also mixed. Like there's been some chat saying that they're not going to buy barrels, and then there's others that are going to buy barrels, and so it is a bit confusing. But oil-wise, we have oil.
We have oil.
Yeah.
But, we're coming out of maintenance now.
Correct.
So we should be picking up on these crude purchasing. And that's still, from the looks of it, that has still not happened. I think we still have a lot of refiner buying to come into the market, especially in dated. I mean, if you look at the curve right now, so before the news hit, we were pricing around minus 20 cents on the physical diffs. We have rallied there about 50 cents up to 30 cents, but the whole of the forward curve is really quite depressed. Given a strong backwardated market and the potential of the refiners coming in with the margins where they are and the Russian oil offline, the forward curve looks undervalued 100%. So
the only thing I would challenge to that is that I think the forward curve on a relative basis has been undervalued for a long time. Do you not agree?
Well, yes, for Brent, but actually usually for dated it's the opposite. So typically for dated, our forward curve is always overpriced.
I see, okay.
Because of the forward hedging. And then when it kind of comes to pricing, typically this year at the very least, we've had the roll down. Whereas this time we've got the opposite. And it could be because the refiners are still waiting to potentially get the cheapest barrel that they can possibly do.
Sure.
But typically what we find when they do that is they will all come in at the same time and they won't, it's hard to buy the lowest, even if you have some great foresight. But
they'll be chasing.
It typically
it feels that way.
Creates that environment. So it's hard to really look at dated and say it's a sell. You just have too many supply shock risks, I think, and with the margin where it is. I think the margin is extraordinary. You talk to any refiner, they're the ones that have won this year, right? We've had sustained, very strong margins.
Super strong margins. Just whatever crude is done, product demand is there. Right, products being absorbed. All the refiner margin hedging, any margin hedging is just getting absorbed daily.
Exactly.
Almost, it feels like.
So it's quite hard to look at the dated curve where it is, with margins where it is,
to be short.
Even regardless of what's going on with the Russian barrels, and if India needs to come and fulfill a short, it's difficult to say that there is downside.
Correct, and also it's interesting. I mean, over the weekend you had the OPEC meeting, and it was quite super non-aggressive tone of increasing supply, which has certainly been their strategy, or certainly been the tone for the last 3-4 months. So everything was in line as expected, and what was interesting was that there was some chat about not potentially increasing supply come Q1 because of the plentiful supply around.
Yeah.
Right. So, it's not clear. I'm with you on the margins. Like, the margins are strong. We're coming out of maintenance, and you could see refiners coming in to buy crude.
Yeah, I mean, on this curve, they definitely should be doing that. And then also we look at the other regions. TI is doing okay. I think all the stats last week were very constructive.
Correct.
So we were having really big crude draws. Let's see what happens with Venezuela, if that is material in any way really to the crude supply there. And the Dubai curve is back to normal as well. We priced 148 on the front spread today. First day of pricing, very, very strong.
Yep.
And the Brent Dubai is, kind of back to normal levels of like minus $1.
Yeah.
So every other region looks okay. It looks like dated is the undervalued curve at the minute as it stands. Now,
sorry, go ahead.
no, I was just going to say, the other thing is, with freight where it is, the arbs are shut. Every arb is pretty much shut. And so if the demand comes from Europe, which I suspect it will in the next 2 weeks, it's going to be very hard for them to buy Midland, which is,
move it over even,
but with the freight where it is, or anything out of Northwest Europe. I think it's going to be very expensive for them to do that, which means the local grades, Brent, 40s, Osberg, Ecofisk, I think they will clear very easily.
Okay.
So let's see.
Yeah.
It is interesting. So I just wanted to actually show you this graph really quickly. So I've spoken about it before. I love to look at it. It's essentially the margin, which is this kind of 3D block line against the DFL. And it totally makes sense given where we are in the maintenance season that the DFL is a bit more suppressed.
Yeah.
But I do expect this relationship to start converging a little bit. I think we still will see strong margins.
Yeah.
The reason for that is because the core of the barrel, so to some extent gasoline, but gas oil mainly, is very solid.
Correct.
We're going into high demand season for gas oil, so I think we will probably maintain those cracks there. And so it's the peripheral kind of cracks that's going to move the margins, so the waste products.
Or crude.
Which I do suspect that, potentially naphtha. I mean, this is from a crude perspective, so
sure.
Give me your 2 cents.
I'll give you the
well.
product perspective. Yeah.
I do expect that the waste products will probably be the ones to soften the margin rather than the middle of the barrel, as I was saying, just as we start running rates a bit stronger. And I think crude will start picking up a bit, which will help the margin as well. But I do expect that convergence there.
I think from the product side, it's important to note that a lot of the tightness is coming out of the U.S. Heating oil is tight. Gasoline in the Atlantic coast, it's tight, it's strong. So there's an enormous amount of U.S. related strength in products, I would say. Tightness exists across the world, but if you look at it on a product specific basis, gas oil, we are, as you said, coming into peak season, but we've priced an enormous amount of that strength already. And as we price it in the turnaround season, it'll be interesting to see whether over the next 6 weeks or so refiners come out to hedge further margins and how that would be absorbed in the product market.
Is the market long gas oil?
It's difficult to say.
Yeah.
I think the market's long gas oil structure.
Yeah.
And it would be, I would find it surprising I would find it surprising to hear if the market was short gas oil, because I think that would be.
Also, they've been burnt trying to do that relative value trade all year, right?
All year.
Yeah.
All year. Although I would say that it could you could see an improvement in balances, and even if you drop a few dollars on the gas oil crack, we're still extremely strong.
Yeah.
Right. So I don't think it's going to
That
weigh.
is the thing, you
it's
know.
just, we're still so strong.
Yeah, the difference between margins at $7 and $10, you know, the refiners will still be running 100%.
Absolutely.
So you're totally right. We can give up a few dollars on the margin, and nothing should change from an operational perspective.
Correct.
Okay, so it'll be interesting, and also we're coming into Thanksgiving, so potentially local gasoline demand in the US will have that additional support as well. So yeah, I don't see the product demand going anywhere into the year end, personally.
One thing which I wanted to talk about last week, and I actually forgot, but it's super interesting because we're talking about crude structure being relatively flat outside of the front 3 months of the curve, certainly on a futures basis. You know, it's been, you got to remember that it's actually been a very, very long time, probably 4 years, maybe even 5 since COVID, that the market saw deep contango and product spreads, right, across the back of the curve. And if you're a physical trader and you're looking at any available contango, you're probably hedging any storage or pre-hedging any storage requirements. So I think a lot of the product strength can also be driven off just the flows at the back, and what's implied, which is super interesting. So that's actually keeping strength on the prompt margin as well, is the fact that the rest of the curve is offering storage economics for a lot of products that are at levels where physical traders haven't seen that for years.
Yeah.
Right. So it's a flow factor to keep in mind. That's keeping strength at the prompt.
So the guys that, I mean, I'm assuming this contango that they're hedging is Cal 26, or is it further back?
It's not Cal 26 yet. It was 2 weeks ago when we were a lot lower on Brent, you know, near the 60 mark, and crude structure was a bit lower. But yeah, definitely Cal 27.
Cal 27.
Yeah.
So I wonder, you know, they've locked in certain levels. That volume should get exhausted, though. You know, they only have so much storage that they can put this product into.
Correct.
And so if the levels go through there, will they have to stop out and look for better levels, or?
Unlikely. They're probably going to scale. I can't imagine all of that hedging is done.
Okay.
I think it was there for a brief while, and it's already repriced higher. So I think you'll get weight on contango product spreads for a while until the product markets can actually, the demand stops in the prompt, I suppose. You know what I mean?
Yes. Exactly. Yeah. And I don't think we can really go into a truly bearish market until we see these margins low. It's really hard to play, you know, a really short crude view or whatever off margins at $10. Like, it's really hard to justify.
I agree, and also if you look at the products independently, as I said, we were looking at them last week. A lot of these products are trading quite independently now, particularly during that short squeeze when everyone was trying to cover short. But even after the market settled down a little bit, if you look at high sulfur fuel, things are pretty tight. I think if you look at and continue to remain tight in Europe and in the US. Asia is actually fairly balanced, I would say, in high sulfur. In VLSFO, we've had a big leg up in VLSFO, mainly probably due to freight, I would imagine.
So are we seeing East-West come off?
In which products?
Like gas oil, like the ones that will be exported out of the East? It's mainly gas oil, I assume.
Yeah, I mean, but there's Eastern strength in gas oil as well.
Okay.
So I think East-West is still negative.
Yeah, something does need to help the freight, right?
Yeah, correct. Yes, exactly.
Yeah, interesting.
And then, so we, you know, the fuel complex still remains tight. Gasoline it's still, I would say, fairly healthy. We've dropped a little bit. Naphtha, we've dropped a little bit, but again, fairly balanced, I would say.
And nothing material to the margin.
Correct, and a lot of fears around Dangote, obviously being a large driver of the moves in the gasoline complex, and distillate is strong.
Yeah.
And so where are we going to give way in the margin for it to come off? And so it'll be interesting. I think you'll have to see something change on the product demand side to really, like you said, have a high conviction short on crude, which is I'm sure you've made this argument well before you and I started talking, and we're going to continue saying the same thing.
Yeah.
Yeah.
Okay.
Yeah.
So, I mean, other than that, other than the retracement in, well, I guess across the barrel, but predominantly in crude, it's been a fairly quiet week, I would say. I think volumes have really dropped off. It feels like the market is fairly risk off.
I would say so, yes. Especially with the uncertainty about what's going to happen.
Yeah.
And I think a lot of the product markets actually last week and this week were really driven off crude.
Yeah.
And crude has also, crude volatility has dropped off a little bit.
Crude's dropped off, exactly.
Yeah.
The price action in dated is getting a little bit more volatile because the liquidity is not there so much. But we had expiry on Friday, which was fairly constructive. We priced 65 cents roughly on the cash spread, which, given this forward curve at the minute we're seeing on deck barrels, we're pricing in around 30 cents. Mm-hmm. It was a strong expiry. We also had a lot of Jan EFP transactions. So I think the market does think it is worth owning barrels here with the margins where they are. It's just not come into the forward curve on the dated side yet. So for me, the only trade that makes sense is to go long Novdeck. I think we're going to have, as I said, margin support purchasing from refiners. We're going to any potential supply disruption, knock-on effects from Russia, like if India come in purchasing, and also all the arbs are shut. So it's going to be really hard for TI to land competitively and fulfill some of the shorts. So I think it's the only thing that makes sense.
Yeah.
Obviously, unless margins get clashed, but I just do not see that happening.
Yeah, I mean, look, last week I said I talked about being long general, Q1, Q2 product crack rolls, which is fine. I think I like that. But actually, having looked at the curve a little bit more across all products, the deferred margins like Q4 26, Cal 27 margins, those all look obviously significantly cheaper than the front, as we say, and actually the front is a little bit of a difficult one. Like you said, is it going to be products that correct down or crude that corrects up? And for me, it actually doesn't surprise me that the back end of the dated curve and the crude curve is a bit depressed, because I feel like with all of the rhetoric around the oversupply next year, it feels like it's more of an aggressive prompt roll-up than anything. So if there's buying in the prompt because of margins, as you say, it can just be prompt strength, and then we'll see next month.
Then we price that, exactly.
You know what I mean?
Yeah. The only thing that I don't love about it is everyone is short Q1 DFL.
Yeah.
And they're going to have... we saw some stopping out last week with the sanctions. A lot of deck Jan, Feb buying. People were definitely covering positions there. But I'm very much a contrarian trader, so I don't enjoy getting into the same position as the market. But sometimes you just have to. I mean, it's... especially when it's behaving
sensibly.
Not so much sensibly, as in just numbers do not matter. It's flow, and flow is dominating the curve. People need to enter or exit a position. That's it. They don't care where the value is.
I 100% agree.
So I think that's very much the scenario we're probably going to remain in.
Over the next 6 weeks or so, into the new year, I would say. I think flow is going to dominate into the new year.
For sure. Okay, well, saying that, I think we know what my trade suggestion is. What's yours?
I actually am going to say that second half 26 cracks. I would say across second half 26 margins, buy.
Oh, buy. Okay, cool. Yeah. And mine is Novdeck dated. So let's see how we are in a couple of weeks' time. Thank you.
Cheers, thanks.
Hello and welcome to the latest episode of The Hedging Show. I'm Tom Fawcett and I'm joined as usual by Harry Campion-Evans. No Julian this week. I think he's on holiday.
He's on holiday. He's having a well-earned week off.
Yep, taking advantage of his newfound celebrity status. This week we wanted to talk about marine fuel hedging and why credit is an important aspect of that industry, but why, certain participants don't always know the true cost of that credit.
Yeah, we thought we'd sort of try and lift the lid a little bit on the kind of, opaqueness of the credit industry and why it's so important in shipping anyway.
So I guess that's a good starting point. So why are these sort of shipping companies so reliant on credit?
So, as I understand it, in the shipping industry and like maritime industry in general, you have long payment cycles.
Yeah.
You've got a lot of operational costs which are paid up front, and generally it's quite a tight margin industry. You've got quite tight margins on sales of bunker fuel. It's very competitive, but I think more importantly, it's the payment cycles of the industry kind of lend itself to this kind of credit, methodology, I suppose, where you've got transactions need to be smooth at different ports. Like everything needs to keep moving. A lot of the cargoes that are being moved are paid for on delivery, whereas the fuel is being consumed on the journey. So you've got that kind of mismatch in, paying for something up front, but not collecting the revenue for what you're actually delivering until later.
Yeah. So I guess it's kind of similar to what we talked about before in the aviation industry, isn't it? Where you've got these like particularly low cost carriers operating on super tight margins.
Yeah.
Wanting to hedge out, a long way into the future.
Correct.
Because those margins are so tight, they need to be able to defend them, but they don't necessarily have the liquidity available to be able to fund those hedges.
Because as we kind of discovered, the airlines don't get paid until the flight's actually landed. So that ticket you think you've bought for a year ahead, they have to kind of lock in the fuel cost for that, but they don't actually receive the cash from the ticket sale until the flight's taken off or landed. And it's just like the payment cycle thing. It just doesn't kind of match up. So if these marine fuel suppliers and consumers are paying upfront or depositing collateral for a hedge of something that they're going to use in the future, none of that kind of cash that will be like a receivable they won't have any of that cash received. So there'll be a huge mismatch and they'll basically be operating as like a bank almost.
Yes. Yeah. So, and I guess it kind of brings us neatly on to why sort of banks have been quite dominant in that space, kind of, plugging that liquidity gap.
Yeah.
So they provide a lot of the hedging services, don't they? Even though they're not, natural liquidity providers in that space, they can leverage their balance sheets in order to provide the credit for these shipping companies to hedge against.
Yeah.
But they're not always, I'd say not always is a bit generous. I think they're very rarely transparent about the actual cost of that, are they? They're typically kind of showing an all-in price, which has got some kind of, markup.
Yeah, and it seems
baked into it.
Yeah, and that could be, well, again, we don't know always how transparent they're being with the customer, but it's not just the kind of, there's obviously the bid ask they have to cover and the internal cost they have to cover, but there's also kind of credit risk. There's all these layers of like risk which they're trying to bake into one price. And like obviously as you keep adding these layers of cost that they're trying to bake in, you just keep getting more opaqueness. Which suits the provider because they can just keep justifying like a wider spread. But it also, and what we've kind of also learned recently is that it can give the illusion that services are being provided for free.
Yeah.
And then it's like, you just pay this one cost and everything's free. And it's like, well, well, how, because everything's not itemized, you're just saying, well, it's just a bid offer spread, but actually, like, it's not a bid offer spread. You're just kind of charging everything on the execution.
Exactly. And it's like all these things, nothing's for free. So it's like, if someone's offering you a, commission-free stockbroking, for example, they're making their money
So
somewhere
that was the
else,
thing with
aren't they?
Robinhood, right? It was like commission-free and everyone jumped on it, but then it just turned out it was like at the post office when you do your money, it's just, you just get a crap rate.
Yeah, exactly. You're being shafted somewhere else, basically, aren't you?
Yeah, exactly. And no one's going to lend you money for free.
Yeah. And I guess where the banks have been able to kind of take advantage of this in the past is there just a lack of transparency in this industry. The companies hedging didn't necessarily know where value was. So if you showed them a price that was, broadly where they expected it to be, they don't know whether they're paying, like $1 a ton above value or, $5 a ton or $10 a ton above value. And that's why having access to something like the Flux platform is so valuable, isn't it?
Yeah, absolutely. I mean, it was not in their interest to give transparency, but it also, the fact that the business was going on for so, what is going on, just shows like how important cash is to these shipping companies. That, because like we said before, a lot, the banks have this kind of synergy where they're often providing like trade finance to the shipping companies. So it's all they have got these guys cash, or they've got collateral or whatever, and they're kind of happy to offer them credit to take on the derivatives trades.
Or they might even have some kind of like factoring arrangement or supply chain finance or something like that. And I guess the more kind of hooks they can get into
it reduces their overall risk. So they can kind of they can say like there's we've got a lot of credit risk, but actually it's kind of negated in other areas of the bank. But either way, it just shows like that concept of like dead cash and what it's worth to the shipping companies. Would you rather not know how much you're paying, or would you rather deposit money in an account for to receive like a transparent price, trading on the exchange or whatever, and
and we've had some conversations like that, haven't we, where we the people almost kind of know that they're being ripped off, but they almost kind of don't care because it's not like an explicit charge. They're like, okay, well, it's just it's all baked into the hedging cost. And I think Julian's been very clear on this point in the past as well about how important it is to show your hedging costs and your actual purchasing costs, put those on the same balance sheet so you can kind of offset the P&L from both of them. Don't just be like, okay, well, we lost X on our hedge, but we procured this fuel brilliantly at a much lower price. The two things should be netting off, and you've got to kind of look at everything holistically to understand these things.
But it seems like it's easier to swallow when it's just a bid offer spread that you're crossing, because there's no kind of like there's no sort of notion of like money being handed over. Whereas if you itemize costs and things are kind of charged separately, then all of a sudden there's an issue. Even though it is more transparent and you're getting a tighter price, people would almost rather just not know and pay their wider spread.
And I think there's quite a lot of research around this type of thing, isn't there, in terms of like trader psychology. And people would much rather take a kind of percentage of percentage chance on a larger possible future loss versus like a kind of guaranteed smaller loss now, even if the odds are against them. It's kind of human nature kind of pushes you towards that, thinking, okay, well, I've crossed a wider spread, but the market might just come back to me, rather than just locking in this kind of cost today, which is, I guess it's illogical, but it kind of plays into human psychology, doesn't it?
But I still think but what we're trying to do, I mean, we've had a lot of feedback from the market, kind of what they find important, and actually it's increasingly obvious that there is a growing demand for transparency, and there is a growing kind of, I don't know.
I mean, it's kind of what we're all about here, right? They're kind of trying to shine a light on all of these things and kind of bring transparency, and we're showing people where our own traders are see value, and in the process we're probably making ourselves quite unpopular in various swings of the market.
But I think but whether you like it or not, that is just the way things go, and that whole kind of opaque market, it just can't last forever. So we've always prided ourselves on being at the kind of forefront of that movement, and even if sometimes it appears that we're a bit early and it's not always taken up so quickly, but we stick to that kind of transparent like ideology, and, you know, being very clear about what we're charging for things, where the bid offer spread is, you know, any other charges. We don't love the idea of baking things into a cost, but, you know, we know that that's what some people want, and we're a client first business, so
Yeah, absolutely.
whatever, we're happy to adapt, you know, and credit lines that we offer are tailored to what customers want, but we always try and push this kind of transparent angle where we really want to be upfront with, you know, we can charge a tight spread because we don't need these layers of middlemen, and we are the wholesale market. You know, when you trade with us, you're facing that kind of Onyx liquidity pool, which is, you know, they are the largest liquidity providers of oil swaps in the world, and you're kind of getting direct access to that liquidity pool. So we don't want to start adding layers of bid offer to that to make that not clear. But
yeah, exactly. I think, you know, obviously we're a trading business. We've always kind of felt, you know, we'd much rather make our money from market making, but we kind of appreciate the importance of or the need for credit in certain areas, and where we have offered that in the past, we've always been very clear that, you know, this is how much you're paying to trade, and if you're being extended any credit, then this is how much interest you're being charged on this credit facility.
Yeah.
And those are two separate things, so you can, you know how much you're paying for one thing, how much you're paying for the other thing, whereas, you know, the kind of bank model, whereas, you know, by the way, you know, that they'll probably be coming to someone like us when they need to flush out that risk anyway.
Yeah.
So you might as well kind of, you know, cut out the middleman by, you know, not going via a third party.
Yeah.
But also, you know, just be super clear that, you know, if you could see that markup that's being added onto that price expressed as an interest rate, it might be quite eye-watering to you, and it might make you kind of think differently if you said, okay, well, this, you know, X dollars a ton is actually like, you know, 20% annualized interest rate. And you see it like that, it actually becomes quite offensive.
Yeah, and we've done the maths, right? And we've kind of worked out that actually, like, it doesn't take to work out like a kind of annualized interest if someone's trading regularly. The kind of extra markup is not that high, which is why we want to, you know, we work so hard to provide tight prices, and then quite often, you know, the question comes back at you. It's like, well, what's in it for you? Like, why are you able to show this? Like, what's in it for you?
Exactly. And it's just, you know, for us, we're a market making business. You know, the more flow, you know, the better it is for us.
Yeah.
And ultimately, we've always been of the opinion, right, that just an efficient market benefits everyone.
But it also shows you that kind of the criticalness of removing as many kind of intermediary layers as possible, right? If there's like $1 spread at the end of the line, but there's 3 intermediaries, all of a sudden you've got a $10 spread. Because everyone needs to eat. So we're about removing as much of that as we can, and that is why we can show that price, because we don't have, you know, 5 mouths to feed on the way down. You know, this is the end of the line when it comes to liquidity. Like this is where the banks and the independent hedge providers are all coming to trade. So we just don't need to justify, you know, paying 3 different people to make the trade worth it.
Yeah, no, absolutely. And I think, I guess at the end of the day, you know, whether you want to subscribe to the Flux platform just to view prices for the purposes of benchmarking, or, you know, have a relationship with Flux markets for, you know, direct hedging, you know, it's all about just giving yourself as many tools as possible to make the best informed decisions.
Absolutely, yeah. And I think like we've kind of noticed that area of the market that was being served, you know, particularly on credit lines, was really, they were really kind of trying to pull the lever of opaqueness as much as possible, right? Because you want to kind of maximize the return. And we found, like, so far in this, you know, relatively new venture for us, we've had pretty good traction with, you know, these credit customers, because they are really benefiting from the transparency in price, the tighter spreads.
I mean, that's kind of always been our sales pitch, right? Because I mean, you can talk about these things sort of academically, and it's kind of harder to get the message across. But we've always been like, okay, well, next time you go to your current provider to get a price, you know, come to us at the same time and we'll show you our price, and then just, you know, compare the two, and then, you know, it should be quite simple in black and white.
Exactly. Yeah.
All right, great. Well, I think that kind of wraps it up really for this episode.
Yeah, it was always going to be a short one.
Yeah, great. Well, hope you can join us again soon, and we should have Julian back with us next week. Thank you very much.
Cool. Nice one.
Thanks so much for being here and making the move into the actual office. This is the first proper interview from a third party. So
Fabulous. Yeah, very, very impressive, I have to say.
thank you. Well, look, the first thing for me straight away, loved your book, genuinely, not just saying that because, you know, I've got you on the show.
I loved your book too, by the way.
Oh, thank you.
No, I really, I'm not just saying either.
Well, look, the reason why I want to justify it is because when you look for a history in the market, you can go for the world for sale, which is quite a good overview, oil 101. But I think the hardest thing for an entrant is, but what's really going on? It's a bit like an employee coming into a company and saying, okay, I've been given the corporate spiel and I know kind of what we're doing. How does it really work here? You're only going to get that from this book. And you learn the history of, and you can even feel, and certainly, I guess, because I know the market relatively well in the last 10, 15 years, you can kind of feel the tensions, the how people are thinking by the stories, which is like such a great thing to have done. Yeah. And it may seem very niche, but you know, it is a niche market, but that's, if you're in this market, you should want to know the niche stuff. So first of all, honestly, that was great. But I guess that would be the first question for me then, which is like, having explored all these stories again that you obviously knew, but you're going interview sure. and all that kind of stuff. How did you summarize it with Adi about how you kind of see the oil trader mind? You kind of alluded to it a bit about the entrepreneurial mind and this kind of stuff. How would you summarize it now?
Yeah, so Adi and I spent the best part of a year and a half researching. It's a little bit like wallpapering the front room of your house. You know, 90% of the work is in the preparation, and then having done the year and a half of research, you know, he wrote some chapters, I wrote some chapters, and we did it in the space of 4 or 5 weeks. Mm-hmm. You know, produced what we've produced, and we were trying to put something together that was different to anything else that was out there, and something which memorialized a business which is huge. I mean, it's the, you know, the largest, least well-known, most remunerative business probably anywhere. And
most niche but most impactful, I would say.
Yeah, the most impactful is a good description. And we wanted to memorialize that because it hadn't been done. You know, Javier Blatter, a wonderful book, and with Jack Fakhri on the World for Sale. You know, Deeds of Daring Do, you know, very much for the general public. You wrote a wonderful, very clearly put together book on derivatives. Liz Bosley's written some books on the physical markets and how they operate, but no one had written this sort of, you know, memorialization of how the business started, who were the people that put it together, where were the places that it happened, and how did this social construct come to be and come to create this massive market we now have. And so in doing that, of course, you analyze very carefully the people who were involved. Mm-hmm. And what we didn't want to do was to lionize people who had used the market, mm-hmm. you know, and benefited hugely from the market, and perhaps have been lionized elsewhere as wonderful traders, which they probably were, but who didn't really add anything to the way the market developed. So, you know, someone like, maybe I'm being unkind, but someone like Andy Hall, for example, lionized as a fabulous trader. Was a fabulous trader, you know, on a Tuesday night in, you know, the 1980s when the API stats came out and you were long or short a cargo you didn't want, you had to call Andy Hall because he was the guy that would take it off your hands. And he was a wonderful trader, but he didn't really, in my mind anyway, add anything to the way the market,
the infrastructure and
developed. Mark Rich did, on the other hand, created something. So you get people in the book who we think have added something. Jeffrey Sprecher, clearly somebody who, in the way he developed ICE, created something.
If you don't mind me saying, the one person who maybe got shortchanged was Jorge.
Well, actually, that's very interesting. So you and your board have two of the people who I would most admire in the industry. So Jorge was massively influential in the way that the markets developed and the products developed. You know, he came in with a sort of muscularness, really, and did things that other people would not have done, and things that needed to be done and were accepted. The other guy on your board who I, you know, hugely respect is Peter Smith. Peter Smith to me is the ideal trader. You know, low risk, regular revenue, great mentor, great leader, nice guy, and you know, These are
Trading as a business.
trading as a business. So anyway, back to your question after a bit, bit of rambling. What do you need to be a success in this business? Well, I think it's changed somewhat in some ways, but in my mind, the person who is successful needs to be humble, because if you think you're bigger than the market and you know more than the market, you will fail. So you need to have a humility relative to the market. I think no question whether you're a technologically focused or a merchanting focused person, you need to have a mental arithmetical ability. You need to be good and quick with numbers. I think you need to be dispassionate, cool, able to put bad trades behind you and move on. That's very important. And I think you need to be able to really understand your competitive advantage. I think a lot of people don't really understand or seek to understand their competitive advantage, and they end up going down the wrong road, or not focusing on what they are really good at. And then, of course, trading, I think, in the interim, 50 years has gone from being a single person activity to being a team game. And as you know, with all the folks you've got, you can't just have one man who's at the market interface being the trader. You have to have the salesman, you have to have the analyst, you have to have the structure, you have to have the whole kind of ecosystem, which is now behind trading. And so trading is a team game now, and that's a big difference.
I think the way you were describing that is so interesting, because going back a bit, you were saying that people who've actually innovated and changed the market, I'll go as far as to say that is what you need to be in this business, because I don't know if any other asset class has the same dynamic going on, which is constant reinvention. So, I mean, I can think of a million examples, to be honest with you, but even as a North Sea trader, paper trader, but watching the North Sea physical traders, for a couple of years' time, it will be a major who's the completely driving force behind the market because they have a particular asset that's particularly useful or a particular relationship. So Huandong, you talked about, and Shell, he was the first one to form a relationship in China to take 40s, and that changed the way the whole game worked for 2-3 years. And then it got reinvented again. Remember the South Korean arbitrage. You've had now TOTSA with the Midland, they're advantageous. And you're constantly having to figure out, where am I? Where is my competitive advantage? And what is going on in the underlying dynamics of the market to allow me to capitalize? So someone like a paper trader, our advantage way back in the day with Mandara was just looking at the mechanism of how the curve price, as simple as that. But you focus on where you can have advantage and what the market's doing, and you end up, monetizing it and deploying your strategies. But in turn, the market evolves.
Oh, you have to be on the ball, because it's a complex matrix, isn't it, of geography, of products, of product quality, of the temporal aspect.
But what I'm saying is the ultimate capitalism at play, because then you're making money doing these strategies. The market then evolves, and the ecosystem gets more complex and sophisticated, and then you're on to the next one. So every trader has had to do that. They've had to be a business builder, even though they're a trader.
And I think you're right to point out there are certainly few markets, I would suggest, other than this market, that actually have gone through and are going through that process. Maybe the credit markets would be similar, but I don't think foreign exchange is. I don't think equities is really. I don't think metals typically is. This is very much unique to the business that that we're in, and oil in particular.
And I think that goes away to explain why those markets have been so much quicker to systematize and be so algorithmically driven, whereas oil, of course, is in Brent and WTI, but it's got a long way to catch up in other markets because of this complexity. I think that answers that.
Yes, I think that there's a degree of complexity there, perhaps, that, again, other than the credit markets with the sort of layers of debt and concepts that they have in that market. There's more in oil than in any of the others for sure. One development, though, that I will not be popular in mentioning it, that I think has added nothing to the course of events, is the introduction and development of speed in markets. I don't see any social or economic usefulness whatsoever to speed.
Of speed of the execution, or
speed of execution. and it's the same thing applies in the equity markets and other parts of the financial services world. Speed is self-serving in my view, and there are many companies out there and individuals who are making huge amounts of money through the application of technology and speed to dealing. But I just don't see that maybe in a minority of one, I don't know, but I don't see that adds anything whatsoever to social or economic benefit.
I've not heard that before, but I can see your logic. I mean, and that's why I guess it's quite orderly still in some markets, like again the North Sea market, where they congregate around the 4 to 4:30 window, and everything's kind of pre-prepared for that time. It is still quite slow. I mean, they do catch waves of, oh, the Brent's moving, so I need to do something. But I guess, yeah, you still to some
someone from XEX will probably come and try and shoot me for saying that. I don't know, but it's it's just it's one of my little hobby horses. And
interesting.
if I was a regulator with a magic wand, I would take away speed from markets.
And how would you do that, do you think?
No idea. I think it's virtually impossible. The vested interests are such that it
you'd shorten the windows where you can trade.
I would find some way of outlawing technology that allows algorithmic trading to happen in a microsecond. For the benefit of the algo trader and no particular good economic or socially useful reason.
Well, I guess that sets up quite nicely. There's the future we've got to talk about, but obviously learning from the past to predict to some extent the future. And the bit I have to talk about because it's so particularly interesting to me is the switch from the banks kind of running the derivatives game with their bilateral trading to the exchange.
Yeah.
And you credit Jeff Sprecher being a huge part of the whole market because of what he developed. But again, the reason why I mentioned Jorge at that point is because maybe I'm wrong here, or maybe I don't know, but it seemed to me that it all came together at once. And I think Jeff in particular played the cards right. For example, okay, we need Platts numbers need to be aggregated in a more succinct way with timestamps. Okay, that needs to be done with technology. Someone needs to take the lead on that. And by Platts aligning with ICE, that was a huge moment on retrospect it sets the governance today. I mean, ICE's integration with Platts, the e-window, the data, it's so intertwined and so entrenched. We are where we are today. And I guess that's why I said the Jorge bit. But having said that, yeah.
You're absolutely right. The Platts have been criticised over the years for very many different things, and ICE too. But what they've managed to do together is systemize something in a very complex market.
Yeah.
Which required to be systemized, and in a certain way they've assisted in the democratization of the market and enabling people to operate in the market with confidence. And I know you're very keen as an individual and as a company on democratizing access to the market, and they played a big part, both of them.
The problem now is what you'd expect with any kind of capitalist venture. They've done their job very, very well, and they got remunerated and rewarded. Now the entrenchment is so deep. We are where we are, where we see Platts increases 300%, increase on fees year on year. Everyone's complaining about that. ICE have that very strong hold, and it's now getting into legal and regulatory realms, which I personally don't see how it's sustainable, because we've solved the problem, which was visibility, transparency, getting that big boom in volumes, and the ecosystem becoming more sophisticated. But now I think it's that threat of we're not able to continue to achieve the things that you highlight so well in your book. If we go back, Morgan Stanley seemed to be particularly very important to some of the birth of some of these new contracts and how to trade, and we could talk a bit about that. But I just wonder if you had any thoughts on why were you so freely able to innovate without restriction? Were people kind of on your side when you had new ideas?
Yeah, that's a very interesting aspect to think about. And there's a story going back to the beginning of Morgan Stanley when Nancy Kropp had come from Sun and John Shapiro from Conoco. brought into Morgan Stanley to start up their business, and they were then asked to take on a very, very bright 27-year-old from within the bank, a guy called Mark Crandall. Mark, of course, subsequently went on and founded Trafigura and had a wonderful career and is a wonderful guy. And Nancy had to explain to Mark, how the rent market worked. So she explained how the rent market worked. And Mark listened, and then he thought a little bit about it, and he said, right, Nancy, now we're going to change that. And in fact, Nancy just retold the story to me a few days ago when I saw her. And that was what he wanted to do, and he was able to do it, and the market was receptive, and Morgan Stanley did it in a similar way that you do it with Onyx, as a client-centric activity first, proprietary second, and there were no barriers to doing that. Regulation was light, to say the least, and internal permissibility, capital use, all that kind of stuff was a thing of the future. Nobody cared about it at that point. It was easy. It was easy.
Yeah, but you see what I'm getting at here. So you've got a genius comes along, got this thinker, or these geniuses all thinking about how to make their market work better. And then you get into the second part, which is how do you execute this in an orderly function? And you hand over to third parties the operational running. Those third parties, you create a monster.
Yeah, no doubt about it. And that monster is out there, and you're right to recognise that. And how do you change that? How do you further democratise?
Well, that's what I wanted to bring up.
It's harder for you. Maybe the regulatory environment is a little less severe than it was 5, 10, 15 years ago. I think it's probably lighter touch.
Well, I was going to bring you back to the Enron Online part because in this context, because it was really fascinating. I heard different stories about Enron Online, and the way you portrayed it was this was immediately seen as a threat. So just to give the context, Enron, everyone remembers Enron as obviously this big dodgy enterprise because of the accounting side, but putting that aside, an incredibly innovative trading business,
absolutely,
right? Top talent and all the rest of it. So what their idea was to say, we will be a single dealer type platform, or we will be we'll offer you the liquidity on a screen. This is going back to like 1995 or something like that. Or
99. Yep.
And so a long time ago, this is what we're going to do. And it did launch, right? It did work for a little bit.
Yeah. So it was really championed by a very smart lady who called Louise Kitchen, who subsequently did some other things within the commodities business. Very, very smart person. And she championed this concept of an exchange where the whole world would come to Enron. So it was one to the world rather than, everybody to everybody. And so we kind of thought that really wasn't going to be very good for Morgan Stanley, Goldman Sachs, Shell, BP, and the people who were providing the value in the market.
Yeah.
Liquidity, because liquidity that's the value. So we got together, and the book describes how we got together. And I know it to be true because I was there.
That's what I love. As
Max Boyce used to say, I know, but I know
you're able to get together. That's again emphasizing. Well, you couldn't do that now. People are so worried about collusion and things like that.
Yeah, we did it. It was interesting. There are a lot more little sub stories to be told on that. But basically, Dick Bronx, who was my equivalent at Goldman, JR, and I went out and we persuaded all these people to come and join us. And then, having done that, by complete chance, Jeffrey Sprecher turned up at Morgan Stanley's offices with this technology platform.
Oh, it was genuinely concurrent.
Oh, genuinely concurrent. So he turned up with he cold called, came in, and he saw Neil Shear, who was the boss of commodities at the time. And I always remember Neil coming out of his office and saying, I give that platform a 5 out of 10, but this guy Sprecher, he's a 9 out of 10 at the very least.
Wow.
And that then led to, the combination of the platform, the European oil.
But I'm fascinated, and again, this is the social side, how you're able to convince each other, or one person's able to convince a group, we're not a threat, or we are a threat, or whatever it is. And when I spoke to Dick, actually, this was in the first year of Onyx. We were thinking of making our chairman. Anyway, he was. I was very curious about all this and the Goldman Sachs index, and he said basically the main pitch from his point of view was the pit trading that's going on and the locals, which I guess we're the locals now, the market makers, or Stanley became them. Them on the floor. He said, you're losing so much money a year to them. If it's on the screen, they won't be able to be doing this kind of that. He said that was his major push.
You know, I think we maybe had slightly different objectives, but you know, they weren't mutually exclusive. I think the objective that we had in Morgan Stanley was that, and we had to persuade a number of our, you know, senior traders that this was the case. But the objective we had was to increase volume, because we believed that if we increased volume through transparency, you know, we were in a position to be able to do much more than anybody else could with that volume, and would have more opportunity. Now we would cannibalize some of our, you know, more opaque over-the-counter businesses doing that. So we had to give something up, but it was
an incredibly progressive move like that. That was like, it's a very impressive thing to have happened. I don't feel that that's possible anymore. I don't know why I say that. Maybe we can explore in a bit. But
well, you don't have the community, I think, that we had. So we, you know, the thesis of this book we've written is that it's a social construct, and it's people and it's place, and we all knew each other, and you know, we all kind of got together in different settings at different times, and certainly we competed. There was no element of collusion whatsoever in anything at all. But, you know, people were decent, and people were friendly, and people were, you know, intelligent enough to understand that working together was possible. I think now the objectives of different companies, the size of different companies in different sectors, you know, different focus, different cultures is so disaggregated and so differentiated that it's going to be very hard to replicate what we did.
Yeah, it's a bit like people complain about the EU. You got this big bureaucratic thing. It's so hard to change things, and it's protectionism. I personally see it being more of a newer entrant, I guess, in this story. To that, I'm shocked at how protectionist everyone is. And I mean, this is not even putting the singular blame on anyone. This is every single trading business. This is the brokerage community. This is the exchange community, the PRAs. They like what they've got. They don't want to let it go. But someone, you know, like Morgan Stanley said, yeah, we're going to have to give up a bit of this, but we know where the world's going. Let's position ourselves well. I don't see that. And I think it's so obvious that we need a next new evolution, but we are a little bit stuck in this mode. Anyway, you answered it fantastically well. It's the community we lack. And, you know, I've been told myself, it's like, Greg, you know, if you want to do things, you need to make friends. You can't have an enemy with everyone. But I'm like, look, to be honest with you, I was locked out of this market for 2 years. People wouldn't even show me numbers. I had to fight my way in. So I don't see the community the other way. Like if there's a coming together of minds to be had to create something that works for the benefit of the trading community, I am 100% for it. Yeah. But I don't know why there's such a resistance to it, I guess.
Yeah, well, probably or possibly it's because, you know, whereas in my day it was very much a social construct, and in your day now there's quite an element of it being a technological construct, and there's an anonymity that comes, I think, with
and fear, I guess.
A fear and a distance.
Yeah.
You know, that the contiguities of place as part of the social structure.
Colin, where I do massively agree with you, and I think it still exists, is liquidity is the value, and it's not that many players. We're still in a market that's disproportionately influenced by a small number of individuals. You could get the 10 biggest traders in derivatives, let's say, together, and you would still be 80% of the trade. I mean, I know there's algorithms and all that kind of stuff, but it's still hugely influential.
The difference, I think, now from my day was that a large element of that liquidity was offered with client centricity behind it. It was helping people understand how to manage their risk at the market interface and providing the liquidity for them to do that. So you were certainly proprietary trading, you know, basis what you were doing with clients, but proprietary trading, certainly in Morgan Stanley, was always secondary to serving the clients. Now, I don't see there are so many folks around who are providing that liquidity today who are doing it to serve clients. You know, I think that element went when the banks were exited from the market by the, you know, Federal Reserve in the US, and you know, you guys have come in and you're trying to do that, but you know, there are not too many others, right? Most of the others I see are, you know, they're Andy Halls. They're looking to, you know, make their money. Fine, that's you know.
The market's so developed and sophisticated that you still get a year like 2022, where the need for oil traders is so high in the world, the ecosystem to do it is so well positioned and so high functioning. A lot of money is to be made by staying true to the system and delivering the economic function that is required.
That's the merchanting side.
But I think it all came together, like the derivatives and everything.
came
It's
together.
a great example of like, that's how a mature market keeps something in line. I mean, was it nickel couldn't handle it, couldn't handle volatility. Oil handled an incredible amount of volatility. Well, I think.
Yeah, I think, and the structures that Jorge and Jeff Sprecher and all of us in our own little small corners have put together over time, developed in a way that the market, became robust and was able to cope with all of these, changes and issues that arose in the market. Coped very well. Some people were very well rewarded for that, so they should be, because they enabled things to happen that made stuff cheaper for people.
Yeah. And back to the Enron Online thing, I just wanted to finish that. So they all came on this one for everyone solution, and then you guys thought, we should benefit from that. We don't like that. It should be a community-based thing, I guess. And then it was the idea to set up a business together. But you were kind of leaning. So it was Jeff's business, and he was saying come a part of it, or you kind of all came together at one, or.
So the business belonged to the equity holders, and Vic and I went out and we offered equity to BP and Shell and Total, etc., in return for guarantees of liquidity. So, they got 12, 13%, let's say, which when they finally sold it, they all made $1.5 billion. So they were the owners, and it was a collection of 5 or 6 or 7 people. And
so how was it sold? Was it IPO?
Jeff was given equity, obviously, as well at the time.
Yeah, but he just IPO'd it, and that's what got.
It was and it went in periods of different offerings, and the objective of the owners and the folks who had set it up was to get out of it as soon as we could, because we didn't want it to be our system. We wanted it to be the market's platform, and there were those who were unhappy at not being included. So Vitol, for example. But Vitol in 1999 were nothing like the force they are now.
It's funny you say that, because when I spoke to a Vitol trader about this, he was saying, well, his version of the story was, we didn't like the idea of it going to the screen because we thought we had an advantage on the pit. Do you think that played a part in it as well? Or?
Maybe at some levels within Vitol, but I think, Ian Taylor, who was running the business at the time, I know he wanted in, and, we didn't let him in.
Oh, wow. Okay.
So, Steve Semmets and Steve Hendel were the same. I can't remember. I think they were called Hepco at the time.
Right.
They wanted in, we didn't let them in.
So, because, I've had this conversation over the years recently, is that why are we not doing this again? Why you've got T+2 settlement, you've got a lot of inefficiencies. I know you say you're not a fan of speed, but you surely are not a fan of inefficiencies and clunky capital and high margining and things like that. Things can be done a lot more efficient. There is another next boom to be done, because the technology has been around for a long time. It's just about oil catching up. So why doesn't, if Vitol missed it the first time, come and do it the second time, and all the other companies. And it was interesting because one company said, well, you do know that since 2022, it's actually very awkward to be part of market infrastructure because so much money was made. You want arm's distance. Well, that's the pricing mechanism and whatever else. If you're seen to be part of that, that's actually a bit of people don't want that anymore, whereas they clearly weren't afraid of it.
Well, we thought they might become afraid of it, and that's why we wanted to, hand the thing off as quickly as we could. And I can understand that. There's always going to be that suspicion. It was the same when, in a different context, when we were talking about how to extend Brent, whether to go to, Midland WTR, whether to go to Johan Sverdrup. And one of the reasons that was cited strongly, actually, against using Johan Sverdrup was that it was very dominated by Statoil, and that domination was something that made people suspicious. And it's the same sort of sentiment, isn't it? That you have to have this sense that people trust and feel that, the platforms and the venues that they use are independent and reliable.
It seem okay to give up the pricing element of that in terms of fees. We'll pay the high fees, fine, but as long as there's that distance and no one else has a competitive advantage. That's clearly the pain point.
Level, it's the level playing field concept, really. So, but I am, I kind of sympathise with you, Greg, really, because I see you trying to do things that clearly would, in my mind anyway, be beneficial to the way in which the market structure was and could develop. And yet it's so difficult. There are so many very, very deeply entrenched interests being hugely rewarded, perhaps in a way that wasn't the case in 1999.
Yeah.
That protectionism, becomes the first thought.
And I do think they've kind of forgotten who put them there and how that works. And that's maybe a separate point. To move on, I would say the very interesting dynamic as well is that, clearly this, and you do mention it quite a few times, this link with Wall Street refiners, Wall Street paper players, and the innovations. It's just the way the beginnings of the banking system as well, right? All kind of made sense. Do you see a similar thing with the emergence of the East? People have been talking about the East growing for a long time, but I see now they're genuinely getting very into paper trading. In China, for example, the exchange volumes are incredible there. India's all these stories about stock options. And, I'm personally seeing that is the area that, if you really think about and you really read your book, you get this sense of very Western. It's a Western operation, but it's growing. Do you agree with me? Do you think it's going that way, more East? And
it certainly seems to be. The center of gravity, I think, moved in the 1970s, early 80s from the US to the UK, Europe, and it's been stuck there for quite some time. And I think you're right. I think the center of gravity is, picking itself up and thinking about moving east. There's a lot happening in China. India has a colossal future in many respects. We're seeing the Middle East become a legitimate trading center, and people and ideas are collecting in that area. So I think in all probability there's opportunity there that there wasn't. China was always a domestic opportunity in the course of the last 50 years, more than an international opportunity.
Well, this is what I was going to say. To flip it on its head a bit, what I just said, can you really beat the free market thinking of the Scottish in the North Sea, and then everything becomes, and then London, this hub, and then the same with the US and obviously their innovations, technology, etc. There's this freedom to explore and innovate that I find I don't really get. I've seen these explorations of let's build an exchange in the Middle East, let's do, China's got their exchange, but there's capital controls, and India have capital controls, and it's not, if they embraced what we did, let's say, in Europe and US, they would have already had.
Well, it's always been very disappointing, and for many years, the consumer of oil or power didn't have any risk really, because there was a pass-through concept from companies to individuals and etc. And so there was no risk to be managed there, and so there was no need really for markets to let people hedge in the market interface. And to an extent, I suppose, you look at China, you look at India, that they are sort of managed places, aren't they? Managed economies, they're not really places that have the same depth and history of free market thought that we had. Russia was a prime example. I mean, I did a lot in Russia in the early 1990s, as did a lot of my contemporaries, and
because they wanted to have an exchange.
Well, they've wanted lots of different things like that over the years. So they said, and here we are 30 plus years later, and you still can't really trade anything. It's it's been disappointing from an open market trading perspective. So, but I do see movement in that direction, and I think the development of Dubai as a trading center, albeit there's an element of sort of Russian sanctions action there, albeit that's there. Nonetheless, I think there's a sense now that markets are starting to move east a little bit.
But even to make it to current day, I mean, oil on water from Iran has been a thing for 10 years, but now it's Russia, and now there's so much sanctioned oil, and there's two-tiered markets with China and India and Russia, and I thought it would be temporary. The market was pricing it like these things are shocks. It kind of looks like it's materially shifting towards this possibly de-dollarization that's been threatened for so many years, but at least a restructuring or reimagining. And I think that's oil traders always have to keep up with that. I mean, I don't know, but it seems like this year was possibly the most. Usually we like volatility, but to get the Trump style, tariff style, import export style volatility has been carnage, and sanctions, because now you're having to juggle what the physical market is doing versus what the benchmark oil is doing versus, like, it's all these things going on. And then the FOB contracts versus CIF contracts. It's causing mayhem because it's, for example, the propane contracts, you would think US into Asia constantly being sent that way. How does that differential not go down an incredible amount once the US are no longer sending propane there? Well, there was a nuance in the FEI contract, which meant it did the opposite. And you're like, that kind of stuff.
That's opportunity, and that's the sort of opportunity, over the years that people have managed to monetize. And if you can monetize an opportunity by mining someone else's indifference, taking value out of something that your counterpart doesn't care about, then that's always the best way. And sometimes, mining the indifference of the piece of paper that has this particular regulation in it is the way that happens. But
I think that's what makes it so difficult for you. mentioned XTX, the Jane Street. This stuff will drive you crazy because there's no system for it. It can change. You introduce WTI Midland, that changes everything to do with the crude contracts. There's no historical things to analyze.
So you mentioned XTX and Jane Street. That leads on, I suppose, to another thing, which is the element of size. It's such an important aspect these days, having size and deep pockets, and being able to wait until the market does what you've put your positions on to think it's going to do.
I think natural gas has proven that to a big extent, but I think oil still struggles. I think you still hear stories of these big funds struggling to make consistent profits without the physical information. I still think that's an oil unique thing.
That is very true. I completely agree with that. And I think, that's something that won't be solved by AI. That's, that's where you're looking at the, significance of a shrug of a shoulder, or the way someone kind of intones, and things that, you need to find out by being there, knowing that person, face to face.
But the integration of the oil markets into politics, I mean, it's always been a thing, but now you kind of get the sense that there's a lot more active players that have government type information and they're utilizing it. That certainly seems like a new thing for me. But just maybe the final thing to discuss, for yourself being where you are, and particularly, I mean, I found when I wrote my book that it's such a great exercise for self-development, because this stuff, of course, but by going back and making it very clear and concise and creating a narrative, it really empowers you. Empowerment of thought. So given that situation you've now got, I mean, you're not that old, right? You've still got a lot to give in the market. It's not like you have to stop anytime soon. So what would you like to see, given what we've just discussed and given all the challenges going forward? Would you like to see a retrenchment in a way of community, get back to the community sense, or do you think it's unrealistic, or what would you like to see?
Well, I don't think we can go back. I mean, I think we can look back and we can say, look, what lessons can we learn? And, lessons from history are very valuable, as we all know. What can we learn from, this last 50 years? But I don't think we can go back to it. That doesn't really ever seem to me to be a good idea. I think we have to take what we know from there and apply it looking forward. I've told you I would like to see speed eliminated, but that's not going to happen. But I wish it could. I just hope that the social and face-to-face and collegial and contiguities associated with place that have served the market development so well can continue in an age where technology is looking to beat everybody. I think that's a challenge, because technology is easy. People develop the stuff, you sit at the desk, you've got your computer, you don't have to worry about traveling up to the West End for lunch or going over to Los Angeles to meet a client. I just hope that people won't take the easy option, and that they will retain the social structure element.
But it's something you're still doing. It's something you're still interacting with people.
Yeah,
and
absolutely.
I think you've got a big part to play in that. You know, even after this book, it's like a reminder, you know, these things, as much as we love technology and AI, it's not going to solve some of the intricacies. Maybe we do need to be getting around the table a lot more. And maybe that's something you can be helping with.
Well, you know, AI is there to be used. And it's wonderful because it'll make people better traders because it'll give them more information and you know, the use of AI is wonderful, but you know, not I think to rely on it to be the thing that, you know, lazily develops markets. I also think what you're doing is very important. You know, trying to ensure that there is a client centricity, a liquidity provision, a democratization continuing, and that, you know, some of these vested interests and you know, behemoths that are behind the way in which the markets trade are not allowed to completely dominate and monopolize and are challenged. And you know, good on you for being somebody in a company who challenge that. It's
well,
important.
thank you for saying that. Honestly, thank you for writing the book, because someone needed to. I like you used the word lionize. It needs to get the reality of what it's like to be in this market, and that conceptualization that's so important. And that this book is what it takes to really be in this market. And you mentioned maths. I would slightly disagree, because I just think you've got AI now and things like that. You've got to have a conceptual brain and maybe an entrepreneurial brain. And I think you emphasize that fantastically well. And there's so much more history to be written. So thanks for everything, and thanks for coming in.
Yeah, no, Greg, thank you. And as I said at the start, I really enjoyed your book as well. And I think hopefully, you know, we've both added something to the canon.
Exactly, and many more to come. Right.
Cheers, thank you.
Hi everyone, today I'm joined with Martha Dowding, who is a research analyst and Flux Insight team. And with the Flux News launch, we're going to be doing more and more on weather. So we thought we'd start with an introductory discussion around weather patterns and which specific weather events obviously impact the trading market in particular, some of the historical moves, and then thinking going forward and kind of reviewing the year as well. So Martha, you want to take us away?
Yeah, of course. I think we're going to keep it evergreen today, but just for context, we're coming to the end of the 2025 hurricane season now. And this is a graph of all of the hurricanes that has been in the Atlantic this season. And as you can see, it's been a pretty lucky time to be living in the East Coast of America, bad time to be a fish, and lots of these kind of fish storms. So we have seen lots of the usual hedging from players kind of amount to nothing. So that's being taken off now. So I thought I'd have a look at some of the usual impacts on crude and a couple of products for some specific hurricanes.
It's just butting in straight away, just because gasoline has had a big move, particularly in Europe. And I guess there's a lot of things going on there, but you would expect, if you looked at it on a graph and during the time, a hurricane must have kicked off.
Yeah.
Not at all, right? So it was a very...
People have such trust in forecasts because of the way that weather works, that people start hedging ahead of the hurricane. So it's not like it happens, then all of a sudden there is panic buying, although we have seen that quite a lot. So we do see kind of the build up to it, and especially the later in the season it gets, the more it's kind of like, oh, we're finally going to get a hurricane, we're finally going to get a hurricane. We did kind of see spurs of buying because of that.
Okay. But you have to say kind of a bit uninteresting from a seasonal basis, no?
It's interesting because,
market perspective. Okay, so leading in, so
this is just purely why this is just for me to talk about the weather for a minute. So there was the high pressure center around Bermuda that was a bit lower this year. So as you can see, that means that the path that the hurricane would take from the coast of Africa is going to be more to the east and a bit more north. And there was also a kind of a front of low pressure over the east coast, which kind of disrupted that as well. So that's why we saw this. Like, it was just an incredibly lucky season, I'm sure. Yeah, incredibly lucky season.
Okay. So I think we have to say as well, like newcomers, whatever, but we know with hurricanes, it's about what the hurricane impact actually is. So it's always a bit confusing. Is it going to hit infrastructure like a refinery? And then that's kind of bearish crude because they can't buy the crude. It's bullish products because they can't make the product. Or is it taking off storage, or is it going to be demand destruction? That's what's always confused me a hell of a lot. Like, okay, there's a hurricane, but we don't actually know what that really means. So traders are always looking, aren't they, for the path and what.
Yeah, that's exactly what the most important thing is, and that's actually a great lead into the first hurricane we're going to talk about, which is Hurricane Ida. As you can see here, in 2021, that hit exactly where Mars crude in the States gets pulled out of the Gulf of Mexico, Gulf of America, and you can see there's another graph here showing exactly all those offshore drilling had to be evacuated, it got shut in, and as well as seeing the usual effect on the WTI spread, which is kind of a softening of the spreads, as you can see. So usually in hurricanes generally, you do see a softening of the TI spreads because, as we often talk about, WTI has a tendency to kind of pool in place that when they can't export as much, and if there's any damage to kind of infrastructure or refineries, you can see a few examples here and also a little chart of why the spreads do suffer. So as well as seeing that in 2021 with Ida, the impact that the hurricane had on the Mars grade specifically was really clear.
Yeah, very bullish. Which, it obviously makes sense. You can't get access to the Mars crude. It's going to go big. But again, it can be confusing because obviously the weakness in WTI is because it can't export. So you have to get that nuance right, and it's not like a repeatable trade. Just nothing else to say. It's why I don't think people really like trading it, because it's so randomized. But I guess what you can do when the hurricane is forming and when it's becoming closer and closer to impact inland, you can at least look for the momentum trades, right? You can look for what's starting to react and what people are starting to gauge. And I mean, that's a half decent trend following trade. Like you can see it here. I mean, it's rallied 250 all the way to flat. So that's per barrel. So it's quite a lot of entry level to get in and ride that up as that was moving. That's the only thing I can really say there.
Yeah, this was the largest, like clearest impact on this specific differential that I saw, but you did see it kind of inching up when you see the path like leading into the Gulf of Mexico like that. I think it's quite a niche trade, but it's interesting.
It's a niche trade, but because it's a niche trade, it's very specifically like what would impact the market from the Mars terminal going down, obviously the Mars differential. So that's quite nice in a way, where there's WTI spreads. Of course, you've got a lot to contend with. And if it's not a minor hurricane, but it's something that will cause days of damage rather than weeks and months, like, and obviously some of the more extreme scenarios, then you're a bit like, well, you know, am I going to sell WTI spreads maybe on the backdrop of a very strong Cushing market, and there might be a big draw in the EIAs. So again, maybe another thing that probably comes up in the history is, if you can find those niche expressions that are kind of binary, those are the ones to stick to, but it's all about execution, isn't it? So.
Yeah, and I think with the crude differentials in particular, they kind of get up and running a bit faster than getting a refinery up and running as well. Right. So I think that may also lead people to be a bit cautious down to trades like this.
Okay, so Ida hit through Gulf America or whatever, so, and hit the offshore platform. I remember it myself, 21. You all hear the whole, right, they're exporting, they're getting all the people off the Mars platform, evacuation. And that was the clearest thing. But it did reach inland, did it?
Yeah, of course. So this is the path here. We saw it kind of move over Louisiana.
Right in the Gulf Coast, which is where all the major refineries are.
Yeah,
in the US.
So there was refinery issues too. So there was 2 million barrels a day of capacity taken online with some big names there. We've got the Marathon, Garyville, Motiva, Valero. So like these big names you hear a lot in gasoline as well, which we'll get to in a second. But so you can see 60% of the US Gulf Coast production was shut, with 1.7 million offshore crude halted. Yeah,
and again, it is quite niche, the Mars grade again. But the thing is that the US is very sensitive. The US crude market is very sensitive to the sour grades that they need to blend in, right? Yeah. So we saw that with the tariffs this year. You block off Canada from exporting their oil sands down into Cushing, and it really screws up the refineries on the East Coast, right? That's what they rely on. And then it actually was very bullish gasoline. Like, there's always knock-on effects. So Mars might seem niche, but actually, you know, it's got to be replaced some way for the Gulf Coast refiners. And who knows, it might have caused like a few knock-on effects. Maybe you don't have that right here, but
it'd be interesting to look into with those heavier grades.
So what about the product side? Because it did hit a refinery, as you said, or it did at least take capacity offline. So it's all about the production there, of which obviously the US export products, but they also export internally, domestically, right up to New York, which is a big deal.
Yeah, so I think like looking at the New York Harbor, US Gulf Coast differentials for gasoline, that's interesting, but we don't really trade those so much. So I did try and keep it looking at the ARB between the US and Europe. So you can see here the graph of when the hurricane hit. We can see that jump in RBOB, which is this green line. It's kind of, I think because it's in September, it's kind of, we're expecting a hurricane to come. And I think there'd just been one a little earlier in the season, a bit less strong. Yeah. There wasn't a kind of significant jump in prices that I was expecting, but we did see this kind of trend down in the ARB, the gasoline ARB, after the other gasoline the other gasoline focused like little study I did as well. So that must be something that kind of to expect, because that's a fairly significant drop.
Yeah, and again, it's the backdrop of positioning as well. Like I actually put that in my book. It was one of those ones where, you know, you expect refineries offline, bullish gasoline, but if everyone's been expecting it, that is the thing with hurricanes. You do get quite early warnings. You know, it's weeks you can be
you can obsess over it.
Yeah. So I think by the time it actually hits and there's the expectation that it's going to get hit, or a high probability it's going to get hit, then you're probably going to have RBOB positioning in there already. So, and if it hasn't really moved up towards that, you're probably getting a lot of sell side resistance. Is that because people are taking profit on the rally? Is that because people don't believe it? Whatever. But it's a very difficult one to be early to, I would say. But the knock-on effects, a lot of the confirmation, you again can maybe get from the more niche trade. So the ARB, again, that's probably a more higher percentage trade, because if it really is cutting off some restricted gasoline, it's probably not a huge deal for the global pool of gasoline, but relative on an export basis, of course, it's going to cause disruption. So a higher percentage trade will always be, in my opinion, like the ARB. going up, right? A relative value trade, or down, depending on what we're looking at here. But I think I don't know. That's kind of my anecdotal point of view on that.
I think people point to it being priced in very easily,
That's what I
and
mean.
it's the kind of thing with the same thing we see every week with the stats when people are like, should have gone up and it should have gone down, when it turns into kind of a liquidity trap, and it goes up to such a level that, oh, this is great to hedge at, and then you see it come straight back down.
Or, the thing about sell the rumor, buy the fact type psychology, you see it a lot with the EIA stats. You've got Genscape coming out on Monday who kind of preempt what the EIA is going to say quite accurately with their satellites and whatever. You see the market react or position for a stock draw or whatever, and if it was a hurricane, it's a hurricane. And then when you actually get confirmation of the news, they use that as a liquidity event.
Yeah.
So again, it's difficult in this kind of game, because you're always playing that lead lag between the people who have the information right on hand, or have literally been speaking to someone being like, I'm on the Mars platform, I'm getting taken off. Do you have that kind of instant access to that information? Anyway, let's move on, because this is that was quite detailed.
And this is just more as to why there was not a huge difference in price, why there was kind of cushioned. You can see stocks were decent. There was no huge power outages, and I think Colonial was off a little, but it wasn't as badly as we'd seen other times, although that can also be quite unpredictable, the effect that has on gasoline too.
So do we have a hurricane which really caused shockwaves in the market?
Well, yes, we do. This is the Hurricane Harvey from 2017. This one, as you can see, inland, really significant, not a huge path, but pretty powerful. This took more than double the refining capacity online. About 25% of the total US refining capacity was taken online by this.
Wow. Okay, so then I'm obviously assume, I can't really remember it, because 2017 I was definitely trading crude, but I mean, Omar must have been trading gasoline at that point. So what did happen actually? I can't remember.
So let me just check the dates. Yeah, so this is late August. This has a much clearer rally in the both EBOB and RBOB cracks into the end of August here. And then again, it's got sold into, whereas this had less of an impact on the ARB, I think because I'm not too sure why, but I think it did still see that drop afterwards, like I said previously. But I think for this one specifically, with such a huge amount of refineries down and the amount of time it takes for refineries to get back on track, making gasoline of good quality, we did see this really significant rally.
Well, it looks like we had quite a bit of volatility on the ARB as well. So that looks like a choppy one. Again, given its extremity, I imagine there was a lot of aggressive positioning. So yeah, the bigger the hurricane, the bigger the event, the bigger the expectation and positioning of volatility. So that makes it even more tricky, which again, I would have said high percentage trade is what I just said before, but it looks like the ARB was as choppy as anything else. So probably quite a tricky one. Be interesting to hear from somebody who's actually trading that, what they think, but I don't remember. So yeah.
So that's for gasoline. And then for LPG, it's similar with the import-export situation of the States, of it being easy to pull, LST in particular. So this is looking at Harvey again and Laura. So with Laura, the problem with so many of these things is to isolate cause and effect. There's obviously a million other things happening at the time. So with LST, the LST FEI differential, which is what we usually look at to measure the strength. You can see here, this is taking some of our Flux data and historically. So Hurricane Laura was in 2010, so that's the yellow line. You can see that's seasonal highs, that's all-time highs for the LST FEI contract. But we can say that...
Sorry, 2010, what happened, sorry?
2020, it got sold down to from there, which you can say it was because of hurricanes. You can also say it's because the Panama Canal was very congested. And there was just a whole series of reasons to start selling this, and also there were extremely high prices. But that was a pretty significant drop from Hurricane Laura added to that as well.
Got it, okay.
And Hurricane Harvey, which we just mentioned, that's just a similar thing. We see fractionators down on the coast, which means that you can't export gas specifically in the right, C3, C4 amounts. So we can see pooling of propane in the States as well in the LST, and we can see pressure on the ARB from that.
Okay.
You can see that here in late August of 2017.
This is going back to Harvey, yeah?
Yeah, this is the 2017 Hurricane
So
Harvey.
we were pretty damn high on the ARB actually, or at least if you compare it to these days, but it came off a cliff, right?
Yeah, huge drop there, yeah.
So in terms of higher percentage trades, then that's also a pretty decent one. I much prefer these export differentials in weather events like this, because it's just, it's temporary, right? It's never going to be like well, no, I shouldn't say that. It could have huge knock-on effects, and there have been in the past. But generally speaking, you get these flash events, these weather events that quite consistently, and you know there's going to be disruption, but you want to isolate exactly where the disruption is, get that highest percentage trade as possible, like we said with the Mars TI. So you've got to look at these things. And actually, LSTFEI, we got big in propane kind of like 2018, 2019. So this is just before that. This is the kind of thing you would be expecting to have a lot of positioning on, given its kind of predictability. So that was interesting. So that's hurricanes. That's kind of summarize hurricanes. And just, I guess, just to finish off the 2025 part, you do get these indications early on in the year that this is going to be a year for hurricanes and that kind of thing. Wasn't that said this year?
Yeah,
and that's because of the
sea surface temperature, the second highest it's ever been, with the highest last year. I think we're either one or two of the highest at different points at the time. But it just shows that we're all kind of at the mercy of more than one predictable thing. We can see that the surface temperatures are so high, but without the correct path and without the pressure differentials being, in your favor, you're not definitely going to get a hurricane. And I think we're getting better.
If you do, is it going to be a hurricane?
Yeah, so we had really strong hurricanes, but they just were at sea.
Okay, so that was hurricanes. Moving on to, I guess, something quite important these days is heat.
Yeah, so we've been seeing a trend recently of extreme heat in the summer. I think focusing initially on Europe, I think last year was especially hot in 2024. And then prior to that, I think the most significant heat wave was the year before in 2023. I think we got off fairly lightly this year in 2025, but it's still really important to have a look at the kind of effect on the European infrastructure and products, power and gas and electricity, because not only is this part of the market, but this is something that directly impacts, the consumer and everyone watching this. So 2023, looking here, because this was especially hot, we can see the Med refineries were forced to cut up to like a third of their production over the summer. Wow. So Macquarie, yeah, thank you. Sorry. Said that heat-related disruption reached about 1 million barrels a day, which is about 10% over the whole year. So this is really, really impactful numbers, and it impacts different refineries in different ways because of the different units, ability to kind of handle the heat. I think when you look at heat and you look at hot weather, the most sensitive would be the FCC, the fluid catalytic crackers, which make gasoline and other, smaller hydrocarbons, and also hydrocrackers, which also produce gasoline. So it's really important to kind of have a look at how these are going to be handling it. Refineries in Europe aren't built to handle the temperatures that, say, refineries in the Middle East are. But even now, I've heard reports that like this year, during the 2024 summer, 2025 summer, they were going to have to cut some of the run productions from in the Middle East, and their whole refinery system is built at a different pressure so that it can handle temperatures up to like 55 degrees, but temperatures are passing that now.
Yeah. I think absolutely topical. I actually remember now, like 2023 was such a basically market move in the products because of refinery fires, refinery overheating, and there being issues in the US as well, right? US and Europe.
Oh, definitely, yeah.
And so given 2023 was quite a difficult year in terms of predicting outright price towards the end, I think it was starting to get a bit more uncertain. I remember coming into 2024, there was an incredible amount of like Q3 buying, basically predicting another heat wave disruption. That was like the leading narrative. And I guess the global warming narrative that you hear all the time, and because it had happened in 2023, people were getting really overhyped for that really early doors. And you just got a massively oversaturated product market in 2024 for the summer, way too early. I remember Bloomberg reporting about record open interest Q1 for this type for these contracts for products. And it didn't materialize. And when it doesn't materialize, everyone's expecting it. And obviously, it's a bit of a bloodbath, or makes the market difficult, if you like. But it is funny like that. Like, even it's almost like anything we do, if things are so expected, they tend not to happen, right? But having said that, the other side of trader psychology is if it doesn't happen, you think, okay, it won't happen, but then it rears its head again. And there's all these things you always forget. Like, if next year there's hurricanes that impact inland, I mean, recency bias, I haven't really, it's been a while since there's been a big impact. So if something happens now, I think there will be a lot of people on the back foot and it will be a lot of volatility. And I think the same to be said about heat, you could say.
Yeah, it's interesting because looking at kind of the chemical engineering process, it's going to be less efficient. There's going to be optimization issues because the FCCs aren't able to cool themselves as they should because ambient temperatures are higher. That doesn't mean that there's going to be fires. That doesn't mean that there's going to be huge issues, but it just makes it more likely. Same with the hurricanes. Nothing is an inevitability. And I think when people get overconfident, that is how, that happens, how you said.
And this year, there was, as you say, we got off quite lightly in Europe, but there were pockets of this extreme heat. And in particular, the one that stands out from memory was in France, the nuclear power stations, like the water around it, like the river, I guess, or the surrounding water got so hot, it couldn't cool down the nuclear reactor. So it really caused some volatility, at least in the electricity markets, power markets. But as you say, like the inclination there is like, you have your energy stack in Europe, right? You have nuclear power, you have coal, you have oil at really kind of extreme. But either way, when something goes out, it is an outage nonetheless, and you have to put pressure on other substitutable commodities. So it's always something to be super aware of, even if you're an oil trader and saying, what do I care about nuclear?
Yeah,
it does have an impact, right? Something to be aware of. And as you said, going forward, more and more, this is likely to happen. So.
Yeah, I remember you saying on the podcast last year that people say nuclear is this kind of like magic response to kind of global warming and everything, and people using coal again. But because of the state the world is already in, the cooling facilities aren't really possible, and there are such stringent regulations in Europe that you can't be discharging water at a certain temperature. In France especially, it's really quite low. So I think if we're seeing nuclear build up more, we might have to see a bit of a drop in those regulations.
Interesting.
So looking to the Middle East, we saw a kind of different demand in this summer and also last summer kind of rear its head. We saw a lot more fuel oil demand, so high sulfur fuel oil.
It's air conditioning story, right? This is now a big theme for the market as well.
And it was definitely like one of those narratives picked up by the media, and we saw bunker demand increase as well, but there was this aircon story that people really latched onto. So you can see, looking at the graph here, the 2025 seasonal highs, all-time highs in the 3.5 barge crack, which is the Euro high sulfur crack. And it's especially obvious when you look at the east-west, so the difference between the 380 in Singapore and the 3.5 barge crack in Europe, that got to new seasonal lows as well at the end of July because of this like really high demand coming from the Middle East.
Yeah, and just conversely to what we've been saying about hurricanes and the unpredictability, even of heat in Europe, I think the air conditioning story it's a lot more structural, if you like. It is every year. And I think it's almost just something that the countries like Saudi Arabia are very keen to do, right? It just makes sense for them to be exporting less fuel use whilst it's obviously cheaper than crude, and they can play around with the exports and what they're doing. That draw on fuel oil is going to be, I think, something quite staple in the market, and therefore probably quite likely to be priced in quite regularly, a bit like 2024, like I was saying there. So, but still a good one to point out. But I guess if you were trading this, the stuff in Europe, you're probably more looking at electricity prices and gas prices, a bit harder maybe to trade that on an oil basis. Unless there's a refinery fire, particularly from the US or that kind of stuff, then the obvious happens. But yeah, as I say, the more structural one to look at is probably fuel oil then in the summer. Okay, so that was the hot. What about the cold?
So looking at the cold, we're going back to 2021, which was a rough year. So we're looking in the States at, we had this storm Ida, which we've seen the phrase actually last year as well. I don't know if that's just when I became interested in weather, but this kind of polar vortex, this cold air being pushed down from, the Arctic down into the United States. So, through Canada. Just basically a quick description is that you have the polar vortex kind of spinning around the North Pole, and then you've got the jet stream below that, still like 5 miles, I think, above the Earth. But when the polar vortex weakens, the jet stream weakens, and that cold air can kind of pass down. And this was especially bad in 2021 during the Texas freeze, Ida, because there was this area of low pressure over the States as well, which is spinning anti-clockwise. The polar vortex spins clockwise, and that meant that
carnage happened.
Yeah, carnage.
So this is what year?
2021.
Okay, 2021, because the Texas freeze that I thought maybe that was 2021 as well, but the one that we had in 2020, 2023 and into 2024, I think we at Onyx probably know all too well, because that was an enormous impact on propane, actually, right? It got so cold that you had the wells being frozen. And that was pretty unexpected. We got crude rally. We got the WTI kind of differentials going bid around some of the Texas areas. They're all kind of predictable on that front. But I think the propane one, we thought there was so much supply at the time. It was just not as expected to be so bullish. And I think we'd already had quite a big ARB rally. We'd already had quite decent spread rallies. So for it to really go on from there as much as it did, that was a blowout performance really for the propane markets and caught people by surprise. So again, it's a repeated one. When you see the Texas freeze, there are, well, you can tell me, there's probably other trades, but for me, it would be straight to propane now. I'm always thinking.
Yeah, straight to propane. And actually, we'll come back to this a bit later when we talk about La Nina, which we're talking about with the trader kind of chat the other day, which is another really interesting way to kind of look at the intra-United States contracts, the regional contracts as well. But yeah, this is just an example of the electricity at the time, ERCOT, which is in charge of the grid for Texas, because it's not connected to the rest of the country, I don't think. They basically from 2021, in 2023 and 2024, there were far less severe power outages, which because after 2021 they were in such bad trouble that they had to weatherize, is what they're called, the whole the grid. So that's meant that there was a far less significant impact on power prices.
But propane there was.
Yeah, that's different.
On retrospect, it was potentially, of course, the cold, right? Propane used for heating in homes. But I think the wells freezing, at least from memory, was the unexpected one. How can it be that cold that literally you can't even produce this stuff anymore? That's pretty nuts.
Yeah, that's and they're just not used to it. But this actually leads pretty nicely on to talking about La Nina, which is happening this winter. So you can see this is to do with the ESNO and complicated weather things. But it's basically, in each season, you're either going to get La Nina or El Nino or nothing. It's neutral. Right now we're in La Nina, which has been confirmed for winter. So looking at the United States.
Sorry, what's the difference? So La Nina is basically this, as you've got this chart here.
Yeah, it's to do with the ESNO, whether it's positive or negative around the equator. There's this.
What does it literally mean? You get a cold.
Yeah, so this is the typical weather pattern of La Nina. Generally, you're going to get a colder. Like we just said with the polar vortex, the jet stream is less consistent. And as it's more variable, we expect colder air to be pushed down from the Arctic down lower into the States, where it's a bit warmer at the southern states. So this is kind of the expected pattern. And because of that, there's this differential in the states called the North-South differential between Conway and Mont Belvieu LST, which I think could be a really interesting thing to keep an eye on, especially
niche, though, hard to trace.
Very niche, but
no, look, you can get some stuff off, and that is interesting. Sorry, so again, La Nina versus El Nino. One's basically La Nina's creating this pattern, and what's the difference with El Nino?
That creates just a completely different pattern. I don't have a graph for that right now.
But we're sticking to La Nina then. Yeah, it's cold where? Sorry,
cold coming in from the north to down.
Yeah,
and then it should be, and also
so basically you're bullish the north-south.
Yeah.
Bullish to north because it's obviously colder.
And also there will be an impact. Propane is used a lot for crop drying.
Yeah.
So the crops will be wetter and colder and they'll need more propane to dry them around the Corn Belt, around the Midwest, which is where it will be colder and wetter.
Interesting. Okay, and more domestic demand, I guess. And so just generally quite bullish, but particularly the north. Okay.
Yeah, sorry, that's very niche.
Cool. Yeah, no, that's good though. I mean, again, this is the thing. So like we keep saying on all these different ones, if you want to know what's the real impact on the market, I think you are looking at the niche differentials. So you look, okay, I remember doing it myself. So what's really going on here? We were like, okay, if there's real wells being impacted, like where is the main concentration of propane being produced? It's like, we're going to look at the Conway contract, not the LST. We're going to look, and I know it's a niche differential to LST, but we want to know what's going on there. So that will give us an indication, is this real physically or not? Or is this just, just a bit of hype and just a bit of positioning and speculating? And that's a really important thing to do. So it's just another reminder. It might seem super niche, but you hear La Nina, you look at the propane markets, look at the north-south differential to get your indication that it's real. That's very fair, I think.
Yeah, and of course scale matters. So if it's colder across the whole country, then there should be more demand for the whole propane market in the States. But
fair.
So lastly, just looking at cold weather in Europe, this is the graph of the LNG stocks year on year. As we can see, we're not looking super high right now. Of course, we're still,
Yeah, this is EU, right?
This is the
There's
EU.
all this talk this year is like, are we going to mandate the 80% storage that we have done before? Market was getting quite excited about that in that market because, it's basically essentially front run that, right? They front run the storage, but it got relaxed a bit in some I think some EU states, but whatever. The point is that was a factor. But I think what's super interesting about the storage and about the LNG story is that because LNG is replacing obviously a lot of Russian, when we had sanctions just yesterday, right, they're able to have these renewed sanctions because they've stabilized their supply, particularly for LNG from Qatar, from the US. So they can then squeeze the Russian supply again. So it might not seem like it impacts oil, but as in what's happened is because Europe are in a position where they're happy with their LNG storage, because it's cold, but it's not that cold, no one's too worried. It probably had a part to play in how they were able to go after these big oil and gas sanctions in Russia. You should never not look at it because it's political, right? Markets are so political these days. It's incredibly important to know what's happening in these core markets, even if they're not directly in oil, for this exact type reason. That would be my addition. But generally speaking, it's cold.
Yeah, I think we're expecting a colder winter because of La Nina. Okay. But we're looking at decent levels. Like it's not like stocks are on the floor, like 80 something.
Yeah.
And we've seen there are more LNG kind of facilities to get all of the LNG that America's trying to ship us being built year on year, and consumption's trending down year on year. But we saw a spike the other day of just some stats coming out. They're a bit bullish and prices, jumped up. We're in a really reactive market, I think. Right. I think TTF is really, really reactive.
Okay, understood. Well, Martha, that was great. Thank you all for the summary, and thank you for the whole summary. But I think just to conclude a kind of major themes there, I'm just going to repeat it because it's one of those things that you want to say, okay, I want to buy or sell something liquid when one of these things happens, whether it's a very evidently a niche thing. Even, hurricanes, heat, cold, whatever, it's always, but where, what's it specifically going to impact? And again, I would always reiterate, if it's a physical impact, you got to look at the physical market. You got to look at the differentials that are going to affect the physical market. So that would be the export differentials, like the ARB gasoline from US to Europe, or the other way around, Europe to US. We've got those North-South Conway. We've got all those kind of differentials like the Mars WTI for exporting. That will give you the confirmation on the physical side. Then obviously when you're trading the derivatives, you've got to weigh up other things like you always do, positioning and flow and all the rest of it. But at least you should know from these indications whether the story actually is real or if it's just a rumor. And I think that's kind of like the main message. And then trading off the back of it, I mean, I don't think we've been super clear how to make money out of that. That was not really the point of this, but maybe that's something we can do in the future. But generally speaking, there are key contracts. The air conditioning, it is about the fuel oil market mainly. Hurricanes, it is a lot about gasoline and maybe Mars and WTI to some extent. The cold, like you said, in Europe, it's really more about electricity and gas.
Yeah, gas,
but propane in the US. And I guess it's just having that up as an event trade or something you're looking at. In the case of, have up your list, hurricanes or whatever, these are the key contracts I've got to look at. And that will repeat itself all year round, every year. So cool. That was a great introduction. You'll be doing some weather shows going forwards. And obviously whenever anything happens that is significant to the oil market from a weather perspective, Martha will be there. So thanks for listening. I hope that was interesting and see you again soon.
We'll be right back.
Hello and welcome to the latest episode of The Hedging Show. I'm Tom Fawcett and I'm joined as usual by Harry Campion-Evans. No Julian this week. I think he's on holiday.
He's on holiday. He's having a well-earned week off.
Yep, taking advantage of his newfound celebrity status. This week we wanted to talk about marine fuel hedging and why credit is an important aspect of that industry, but why, certain participants don't always know the true cost of that credit.
Yeah, we thought we'd sort of try and lift the lid a little bit on the kind of, opaqueness of the credit industry and why it's so important in shipping anyway.
So I guess that's a good starting point. So why are these sort of shipping companies so reliant on credit?
So, as I understand it, in the shipping industry and like maritime industry in general, you have long payment cycles.
Yeah.
You've got a lot of operational costs which are paid up front, and generally it's quite a tight margin industry. You've got quite tight margins on sales of bunker fuel. It's very competitive, but I think more importantly, it's the payment cycles of the industry kind of lend itself to this kind of credit, methodology, I suppose, where you've got, transactions need to be smooth at different ports, like everything needs to keep moving. A lot of the cargoes that are being moved are paid for on delivery, whereas the fuel is being consumed on the journey. So you've got that kind of mismatch in, paying for something up front, but not collecting the revenue for what you're actually delivering until later.
Yeah, so I guess it's kind of similar to what we talked about before in the aviation industry, isn't it? Where you've got these like particularly low cost carriers operating on super tight margins, wanting to hedge out, a long way into the future.
Correct.
Because those margins are so tight, they need to be able to defend them, but they don't necessarily have the liquidity available to be able to fund those hedges.
Because as we kind of discovered, like the airlines don't get paid until the flight's actually landed. So that ticket you think you've bought for a year ahead, they have to kind of lock in the fuel cost for that, but they don't actually receive the cash from the ticket sale until the flight's taken off or landed. And it's just like the payment cycle thing. It just doesn't kind of match up. So if these marine fuel suppliers and consumers are paying upfront or depositing collateral for a hedge of something that they're going to use in the future, none of that kind of cash that will be like a receivable they won't have any of that cash received. So there'll be a huge mismatch and they'll basically be operating as like a bank almost.
Yes. Yeah. So, and I guess it kind of brings us neatly on to why sort of banks have been quite dominant in that space, kind of, plugging that liquidity gap.
Yeah.
So they provide a lot of the hedging services, don't they? Even though they're not, natural liquidity providers in that space, they can leverage their balance sheets in order to provide the credit for these shipping companies to hedge against.
Yeah.
But they're not always, I'd say not always is a bit generous. I think they're very rarely transparent about the actual cost of that, are they? They're typically kind of showing an all-in price, which has got some kind of, markup.
Yeah, and it seems
baked into it.
Yeah, and that could be, well, again, we don't know always how transparent they're being with the customer, but it's not just the kind of, there's obviously the bid ask they have to cover and the internal cost they have to cover, but there's also kind of credit risk. There's all these layers of like risk which they're trying to bake into one price. And like obviously as you keep adding these layers of cost that they're trying to bake in, you just keep getting more opaqueness. Which suits the provider because they can just keep justifying like a wider spread. But it also, and what we've kind of also learned recently is that it can give the illusion that services are being provided for free.
Yeah.
And then it's like, you just pay this one cost and everything's free. And it's like, well how, because everything's not itemized, you're just saying, well, it's just a bid offer spread, but actually like it's not a bid offer spread. You're just kind of charging everything on the execution.
Exactly. And it's like all these things, nothing's for free. So it's like, if someone's offering you a, commission-free stockbroking, for example, they're making their money somewhere else.
So that was the thing with Robinhood, right? It was like commission free and everyone jumped on it, but then it just turned out it was like at the post office when you do your money, it's just you just get a crap rate.
Yeah, exactly. You're being shafted somewhere else basically, aren't you?
Yeah, exactly. And no one's going to lend you money for free.
Yeah. And I guess where the banks have been able to kind of take advantage of this in the past is there just a lack of transparency in this industry. The companies hedging didn't necessarily know where value was. So if you showed them a price that was, broadly where they expected it to be, they don't know whether they're paying, like $1 a ton above value, or $5 a ton or $10 a ton above value. And that's why having access to something like the Flux platform is so valuable, isn't it?
Yeah, absolutely. I mean, it was not in their interest to give transparency, but it also, the fact that the business was going on for so, what is going on, just shows like how important cash is to these shipping companies. That, because like we said before, a lot, the banks have this kind of synergy where they're often providing like trade finance to the shipping companies. So it's all, they have got these guys cash, or they've got collateral or whatever, and they're kind of happy to offer them credit to take on the derivatives trades.
Or they might even have some kind of like, factoring arrangement or supply chain finance or something like that. And, I guess the more kind of hooks they can get into
it reduces their overall risk. So they can kind of they can say like, there's, we've got a lot of credit risk, but actually it's kind of negated in other areas of the bank. But yeah, either way, it just shows like that concept of like dead cash and what it's worth to the shipping companies. Would you rather not know how much you're paying, or would you rather deposit money in an account for to receive like a transparent price, trading on the exchange or whatever, and
and we've had some conversations like that, haven't we, where we the people almost kind of know that they're being ripped off, but they almost kind of don't care because it's not like an explicit charge. They're like, okay, well, it's just it's all baked into the hedging cost. And I think Julian's been very clear on this point in the past as well about how important it is to show your hedging costs and your actual purchasing costs, put those on the same balance sheet so you can kind of offset the P&L from both of them. Don't just be like, okay, well, we lost X on our hedge, but we procured this fuel brilliantly at a much lower price. The two things should be netting off, and you've got to kind of look at everything holistically to understand these things.
But it seems like it's easier to swallow when it's just a bid offer spread that you're crossing, because there's no kind of like, there's no sort of notion of like money being handed over. Whereas if you itemize costs and things are kind of charged separately, then all of a sudden there's an issue. Even though it is more transparent and you're getting a tighter price, people would almost rather just not know and pay their wider spread.
And I think there's quite a lot of research around this type of thing, isn't there, in terms of like trader psychology. And people would much rather take a kind of percentage of percentage chance on a larger possible future loss versus like a kind of guaranteed smaller loss now, even if the odds are against them. It's kind of human nature kind of pushes you towards that, thinking, okay, well, I've crossed a wider spread, but the market might just come back to me, rather than just locking in this kind of cost today, which is, I guess it's illogical, but it kind of plays into human psychology, doesn't it?
But I still think but what we're trying to do, I mean, we've had a lot of feedback from the market, kind of what they find important, and actually it's increasingly obvious that there is a growing demand for transparency, and there is a growing kind of, I don't know.
I mean, it's kind of what we're all about here, right? They're kind of trying to shine a light on all of these things and kind of bring transparency, and we're showing people where our own traders are see value, and in the process we're probably making ourselves quite unpopular in various swings of the market.
But I think but whether you like it or not, that is just the way things go, and that whole kind of opaque market, it just can't last forever. So we've always prided ourselves on being at the kind of forefront of that movement, and even if sometimes it appears that we're a bit early, and it's not always taken up so quickly, but we stick to that kind of transparent like ideology, and being very clear about what we're charging for things, where the bid offer spread is, any other charges. We don't love the idea of baking things into a cost, but we know that that's what some people want, and we're a client first business, so
absolutely.
Whatever, we're happy to adapt, and credit lines that we offer are tailored to what customers want, but we always try and push this kind of transparent angle where we really want to be upfront with, we can charge a tight spread because we don't need these layers of middlemen, and we are the wholesale market. You know, when you trade with us, you're facing that kind of Onyx liquidity pool, which is, you know, they are the largest liquidity providers of oil swaps in the world, and you're kind of getting direct access to that liquidity pool. So we don't want to start adding layers of bid offer to that to make that not clear. But
yeah, exactly. I think, you know, obviously we're a trading business. We've always kind of felt, you know, we'd much rather make our money from market making, but we kind of appreciate the importance of or the need for credit in certain areas. And where we have offered that in the past, we've always been very clear that, you know, this is how much you're paying to trade. And if you're being extended any credit, then this is how much interest you're being charged on this credit facility.
Yeah.
And those are two separate things. So you can, you know how much you're paying for one thing, how much you're paying for the other thing. Whereas, you know, the kind of bank model, whereas, you know, by the way, you know, they'll probably be coming to someone like us when they need to flush out that risk anyway.
Yeah.
So you might as well kind of, you know, cut out the middleman by, you know, not going via a third party.
Yeah.
But also, you know, just be super clear that, you know, if you could see that markup that's being added onto that price expressed as an interest rate, it might be quite eye-watering to you, and it might make you kind of think differently if you said, okay, well, this, you know, X dollars a ton is actually like, you know, 20% annualized interest rate. And you see it like that, it actually becomes quite offensive.
Yeah, and we've done the maths, right? And we've kind of worked out that actually, like, it doesn't take to work out like a kind of annualized interest if someone's trading regularly. The kind of extra markup is not that high, which is why we want to, you know, we work so hard to provide tight prices, and then quite often, you know, the question comes back at you, it's like, well, what's in it for you? Like, why are you able to show this? Like, what's in it for you?
Exactly. And it's just, you know, for us, we're a market making business. You know, the more flow, you know, the better it is for us.
Yeah.
And ultimately we've always been of the opinion, right, that just an efficient market benefits everyone.
But it also shows you that kind of the criticalness of removing as many kind of intermediary layers as possible, right? If there's like $1 spread at the end of the line, but there's 3 intermediaries, all of a sudden you've got a $10 spread. Because everyone needs to eat. So we're about removing as much of that as we can, and that is why we can show that price, because we don't have, you know, 5 mouths to feed on the way down. You know, we are this is the end of the line when it comes to liquidity. Like this is where the banks and the independent hedge providers are all coming to trade. So we just don't need to justify, you know, paying 3 different people to make the trade worth it.
Yeah, no, absolutely. And I think, I guess at the end of the day, you know, whether you want to subscribe to the Flux platform just to view prices for the purposes of benchmarking, or, you know, have a relationship with Flux markets for, you know, direct hedging, you know, it's all about just giving yourself as many tools as possible to make the best informed decisions.
Absolutely, yeah. And I think like we kind of noticed that area of the market that was being served, you know, particularly on credit lines, was really, they were really kind of trying to pull the lever of opaqueness as much as possible, right? Because you want to kind of maximize the return. And we found, like, so far in this, you know, relatively new venture for us, we've had pretty good traction with, you know, these credit customers, because they are really benefiting from the transparency in price, the tighter spreads.
I mean, that's kind of always been our sales pitch, right? Because I mean, you can talk about these things sort of academically, and it's kind of harder to get the message across. But we've always been like, okay, well, next time you go to your current provider to get a price, you know, come to us at the same time and we'll show you our price, and then just, you know, compare the two, and then, you know, it should be quite simple in black and white.
Exactly. Yeah.
All right, great. Well, I think that kind of wraps it up really for this episode.
Yeah, it was always going to be a short one.
Yeah, great. Well, hope you can join us again soon, and we should have Julian back with us next week. Thank you very much.
Cool. Nice one.
welcome to another window update from the officials looking at the North Sea for today and Tuesday session. So to recap where we are, we had a much stronger and very busy window yesterday. The physical differential climbed to 58 cents. That's the strongest we've seen since kind of 13th of October kind of time. So it's recovered significantly from its negative stint in kind of the minus 30 cents range. And the reason for that is largely yesterday's incredibly busy window. And today was much less busy, but still pretty active, both buy side and sell side interest for a few of the same players and some new joiners as well. So what we had yesterday, 16 bids or offers, 4 trades. So that's 2.8 million barrels traded yesterday in the North Sea. Today, we didn't get any trades, but we had some of the same players coming back again. So particularly we had Mercuria in Midland and Glencore both offering. Meanwhile, had Exxon bidding again. But what you can see is quite significant. This trade here, for this offer for the 16th to 22nd, offered at 170 overdated. Yesterday, the 15th to 22nd, offered at 190 overdated. So we've got a significantly weaker offer there, significantly lower. And also Exxon, they never raised this bid above their initial bid of 140 overdated. So Midland is a bit weaker. Likewise, 40s, we have a 55 cent overdated offer. Yesterday, we had it being bid at around 70, 75 cents above dated. So you've got this significant decrease both across Midland and 40s by approximately 20 cents. And then in Ecofisk, we have Phillips again bidding. They bought 2 cargoes yesterday, but clearly that's not enough for them. They want another one. Plus, ConocoPhillips came in to offer. But what we're expecting, therefore, is a bit of a weaker diff, perhaps like towards 50 cents kind of area, down from the strength that we had yesterday. And then if we look to the futures and derivatives market, we had a pretty significant sell-off in flat price this morning. We went all the way down, even, as you can see, to below 64. So the real weakness was, as I say, in the morning session. So through the Asian session, through the kind of Dubai and Asian window, we get to this kind of floor just below kind of 64, around 63.90. And then at lunchtime, we have this recovery. We have a big candle here where we have a big jump back up towards the mid 64 range, which is where we reached the close today. Likewise, the spreads, the prompt spread, we have a pretty continued, significant, consistent sell-off here. And similarly, we dropped to kind of 40 cents, even to 38 at the lows, you can see. But unlike flat price, we haven't really had a recovery this afternoon, and we remain pretty depressed down at around 40 cents. So the structure is one to look at, whether flat price comes back off again, or if structure can recover slightly. And then the other thing to keep in mind is ADIPEC, the conference going on in Abu Dhabi. And the main stories coming out of that are questions about India, what they're going to do regarding Russian barrels. Are they going to replace it with Middle Eastern? The question, therefore, becomes one of Dubai. Does that impact the Dubai market? How will it affect the structure? For now, as you'll remember from this morning's video, the Dubai structure is weakened significantly with the premium going down to around 141. That's much weaker than where it was just yesterday. And really, the signs are maybe they are, maybe they aren't, and it's a bit unclear at the moment. The workarounds are being found. Remember, they still have a kind of delayed period before the sanctions come into full force on the 21st of November. But that's one to definitely keep an eye on. Plus, of course, the kind of rebuttal of the super glut narrative that's going on from many of the speakers who are seeing strong demand and not such excessive supply growth as is being forecast by some of the international agencies. So those are the things to keep an eye on, and make sure to look at the official's Twitter page to get our final data Brent and physical differential assessment tonight.